Hello, good morning, good evening, good day, wherever in the world you are. Welcome. Thank you for joining our second annual SmartCon Summit. We have a jam-packed 3 days waiting for you, featuring the best speakers, technical demos, and cutting-edge research in this industry. First, what an incredible year has been since the last SmartCon. I mean, ChainLink has come so far. The lockdowns didn't stop us from welcoming new advocates to join the ChainLink community. We now have new Southeast Asian communities, such as in Thailand and Indonesia, and countless advocates who are creating local ChainLink communities around the world. And you'll see some of them at our watch parties. On the ecosystem side, we welcomed hundreds of new users, blockchains, node operators, data providers to the ChainLink ecosystem. And DeFi, as we all know, really took off, and ChainLink is proud to help play a part in that story. We're securing tens of billions of dollars now in value, helping to build the fundamental DeFi infrastructure. On the product side, in addition to our popular price feeds, we've launched new products from VRF to Proof of Reserves to Keepers, the ChainLink White Paper 2.0, and so much more. We're ever expanding the products and solutions we provide for smart contract developers. And to support this increasing demand for ChainLink and its solutions, the ChainLink Labs team has also grown multiple-fold. And you'll get to meet many of the new faces over the next few days. I am so proud for how far ChainLink has come, and thank you for being part of that growth. Whether you're a developer, a user, a node operator, a community member, or joining our community for the very first time today, your interest and belief in ChainLink has helped take us to where we are today. Your sharing of our vision to bring cryptonomic truth to enable economic fairness for the world is making a difference. So thank you for being part of a community. We wouldn't be here without you. Over the next few days, I hope you discover something new, meet great people, and that you get inspired. I hope that you take what you learn and this inspiration from this conference and share it with your friends, your family, your colleagues, and spread the word for the future that we're building together. So come on, let's go. Let's bring truth to the world and make it a better place. Enjoy.
Thank you so much, Adlin. Again, thank you for that great info. My name is Rory Pines, and I'm the Director of Community for ChainLink Labs. Again, we continue to be a global community with tens of thousands of attendees today joining us here from all over the world. Throughout the conference, we'll show you how this community is watching and interacting with SmartCon via some of our community watch parties, which we'll get to shortly. The ChainLink ecosystem is made up of developers, researchers, the data providers, node operators, and businesses providing the most secure and reliable products and services. This allows developers to build amazing products while relying on the ChainLink network to provide them the services they need. SmartCon will be a great way to learn about and interact with the various groups I mentioned. As with anything, the more you put into the conference, the more you'll get out of it. Remember, you not only have the opportunity to watch, but to interact, network with fellow attendees who share the same drives and interests. By the end of the conference, you will have learned how the ChainLink network is moving beyond price feeds and how new products and services are used by the best developers in the space. Since we are such a diverse community, I think it's important to set forth some community guidelines, along with a few helpful tips to allow you to get the most out of the conference. First, please be respectful to all attendees, speakers, and organizers. Treat others as you would like to be treated, and you should be just fine. Second, let's keep the conversations related to the conference. Always remember, you can always hop in many other social channels to ask a question that may not be related. We want to create an atmosphere where everyone is welcome to interact and ask constructive questions. This is a place to learn, connect, and interact. We invite you to take advantage of that. Here's some helpful information and tips for a great overall experience. We have many interactive sessions highlighted by a developer track on Friday, AMAs, and all types of other ways to be involved. Don't be afraid to get involved, regardless of your experience level. We all have to start somewhere, and SmartCon is a great place to get that start. Let's take full advantage of the networking feature, which you'll notice on the left side of your screen. This is a great place to meet people that share your interests. There's always people looking to build great teams. This is a great opportunity to meet them. You'll also likely run into some people from the ChainLink Labs team, so make sure you put aside some time to network. Lastly, make sure to visit the Expo booth to learn more about some of the projects joining us here throughout the conference, along with opportunities to talk to the ChainLink Labs recruiting team and business development team. Right now, we're ready to create a world where truth is greater than trust. You are all part of that truth, and together we can create a more fair world. Again, thank you for joining us, and welcome to Smart Contract Summit. So without further ado, let's Shane MC of the stage. He'll do a fantastic job of helping you navigate throughout the conference. He's worked at ChainLink Labs for quite a bit of time now. You've probably seen him all across YouTube. Let's go ahead and bring Andy up here to say hello.
Hey, everybody. I am super glad to be here at SmartCon 2021. Last year, SmartCon was my first exposure to the entire ChainLink ecosystem, and so it was such a great experience. I stuck around for more. They kept me around. You guys, the advocates that we just saw around the world, awesome to see you guys again. I've seen many of those people working to share ChainLink YouTube events and the AMAs that we've been doing on YouTube. Feel free to check those out and join those communities. If you're from an international community, find ways into those language communities. We're happy to have you guys join us there. We're going to get started here in just a few minutes. I'm your MC, so I'll be kind of in between everybody, helping people get from point A to point B. I want to make sure you understand what you're getting into with Hopin here. So the platform you're on, you should be able to see on your left side over there a bunch of options. Check out that schedule. There's a couple of different stages. This one is the innovator track. We've got a lot of keynotes. We've got a lot of project founders and things like that. But the other one has a developer tracks and research tracks and all sorts of other options. So take a look and expand your knowledge as you can. Oh, we do have some more people for watch parties. Do we want to bring a couple more up and intro them? Yeah. Bring them on up. We'll say hi to people. Because we got people around the world. I think we've got a group in Romania here. Hey, Catalin, how you doing?
Hey, I'm fine. Enjoying.
Good. I got Michael. We've got an Israeli contingent as well. How you guys doing? Who else do we have on? We've got Joy again from Thailand. I know Jen is there as well. Let's see. Who else do we got? Oh, we got UK. We got UK representing as well. And who's this in the middle? I got to check you guys out. As well. Hey, everybody. Welcome. We're also checking out the chats and we're keeping an eye on the socials too. So if you guys want to tweet at me, you know, I'm online all day and I'll be here for the next 3 days as well, along with these various watch parties as well. We've also got others from the US, Jen, and more people around. So thank you everybody for coming. Oh, that was Uganda. That's Uganda in the middle. Awesome. Brian, welcome to your crew there. Excellent. I'm online all day. And I'll be here for the next. All right, so everybody mute your mics, and thank you for coming on. We're gonna get this spin in. They're excited. I'm excited too. I'm really a bit excited for this for all year, honestly. Last year was so much fun. I'm jealous of all the advocates getting their SmartCon swag. That'll go out. I'll get mine soon enough, I'm sure, as well. But it's great to have you guys here. And I can see the chat in Hopin spinning. We got people from Africa in there. People are up early in California. I see you guys. We're going to try and keep an eye on that. Please interact with each other, meet each other, cross-pollinate, and find those connections. Aspiring developers, enthusiasts, our ecosystem, people who have been building with ChainLink for years. We love having all of you guys here with us. So very much appreciate the enthusiasm leading up to SmartCon, and I am excited to see what happens here. People have been asking me what I'm most excited for. I literally cannot say. I've seen the schedule and I've been trying to help give people priorities. I can't. It's it's so jam-packed with stuff. And I've got the opportunity in the past few months, especially, to talk to a lot of founders. And there's so much gigabrain genius that is coming on to talk to people today. Really excited for all of the presentations, actually all of the presentations. And I'm emceeing, so I don't even get to see all the ones on the other stage either. So I'll have to catch those at a later date. So we're going to get moving here and get started with our first presentation. We'll take a look at the state of the crypto markets. So I'm really excited to hear this next speaker. It is Bobby Ong from CoinGecko. Excited to see what he has to say and his presentation. So we're going to get him up here in just a moment, Bobby, and we'll get you going. Just give us 1 second here.
Hi, everyone. Very good afternoon, good morning, good evening, wherever you are. My name is Bobby. I'm the co-founder of CoinGecko. Super excited to be presenting at SmartCon this year. So I will be presenting on the state of the crypto market today. And yeah, basically a lot of this thing was written for our Q2 quarterly report. So a lot of the data was up to 30th of June, and I'll be happy to present today. So let's see, yep. So the first thing that we kind of talked about last was the Q2 spot market. So the Q2 was an interesting time for the crypto market. Crypto market went up a lot and it hit all the way up to $1.3 trillion and no, $2.2 trillion. But interestingly enough, this was mainly driven by the meme coins. So meme coins took over the crypto scene at the start of Q2. And by the end of Q2, unfortunately, the market has sort of dropped 41% from its peak to $1.3 trillion. This was kind of coincided with Tesla's announcement to stop accepting Bitcoin payments because of environmental concerns. And also, there was a China FUD where crypto was finally banned. Crypto mining was finally banned in China, and a lot of the hash rate was moved out of China. In terms of crypto market dominance, Bitcoin saw its dominance go down in Q2. So it started the quarter at about 60% and it ended about 49.7%. The big gainer from Q2 was really Ethereum, who gained up to 20% in the market dominance, up to 20%. And we also saw Dogecoin gaining a lot in Q2. ChainLink was interesting. It was kind of stable at about 0.6%. And yeah. The next slide that I have over here is actually on stablecoins. So stablecoins continue its intense, fast growth. So we saw a 76% increase up to $105 billion in circulation. Volume, however, for stablecoins dropped by 35% to $73.6 billion. I think the interesting to note is that this UST stablecoin, which is a stablecoin issued on the Terra blockchain, is now the 5th largest stablecoin with about $1.9 billion in circulation. I think it'll be interesting to watch how UST continue its growth in the next few months and to see if it actually challenges DAI as the decentralized stablecoin of choice. I think a lot of the growth in UST was mainly driven by the high yield that's offered on your UST deposits on Anchor on Terra blockchain. So the next thing that we're going to talk about is on DeFi analysis. So on the DeFi market. So I think the interesting thing to note about DeFi is that the market cap, as usual, went down as well in Q2 by 43%. The market cap reached a peak of $150 billion in May before suffering a 55% drawdown. Quarter on quarter, DeFi market fell 43%. I think the interesting to note is that despite going up or going down, the market share has retained roughly about 5% of the crypto market dominance. I think there's some concern that everyone who is interested in DeFi has already purchased some DeFi. So there need to be some sort of a new money coming into the space. And this could explain how a lot of focus on some of these lending protocols like MakerDAO and Compound and Aave to focus on including real assets such as real estate loans for MakerDAO via Centrifuge and Compound offering institutional access to DeFi and also Aave Pro following suit next quarter. I think interesting to note is that DeFi summer happened sometime in summer last year, 2020, where the peak of the market cap was about $20 billion. But if you look at the chart, like DeFi bull run of 2021 was even crazier and even all the way up to $150 billion before retracing since then.
It was in the aftermath of the 2007-2008 financial crisis when this event came to be. And we find ourselves time and time again over the evolution of this blockchain Web3 ecosystem that we really have a lot of significant historical moments that sort of tie in with different major milestones in this technology. So obviously, Satoshi memorialized this in the Genesis block of Bitcoin, referencing the Times from London, discussing yet another bailout of financial institutions by the British government at the time, and have since we've seen this technology evolve alongside several of these different major historical moments, which we'll talk a little bit about more in a minute. So fast forward to 2014, and Vitalik Buterin proposes Ethereum, a system that would make this sort of experimentation with these cryptocurrencies easier, a platform for programmable money, building on the ideas that Nick Szabo had in the 80s and the 90s, and have enabled what we recognize as smart contracts today. In 2015, 2016, while Gav and the team was building out this specification, Gav first started talking about these systems in the context of Web 3.0, this new internet where we're able to build more trusted systems to interact with each other every day. So same in that regard, let's talk a little bit about what the internet looks like today and why it's a problem. So if we look at today's established client server architecture, you can see quite clearly that there's a myriad opportunity for major institutions and centralized authorities to control the information, data, financial transactions that we have with each other, which is problematic considering all the breaches of that trust that we've seen over the past couple of years. Looking into a couple of these, obviously, we're all well familiar. Snowden revelations were really big for a lot of us. We really had very clear evidence that these systems were not being used in a way that was necessarily in the best interest of the citizens and the users of the internet, which is where this Web3 concept comes from, this concept that we need less trust and more truth in the information that we're served online, and to rely on protocols that can't be evil, versus Google, whose motto famously was, don't be evil. I think I credit Blockstack for this line, really an excellent overall message for our industry. So this new web needs to remove the divide between users and service providers, right? This middleman, whether they're breaching our trust by misusing our data or just unnecessarily profiting off of our engagement interactions online. We need network effects without monopolies, essentially. Another key aspect of the web today that makes it quite useful is that, like, our identities are quite well understood across all these web services, meaning that we're able to get a really good quality of service. But the issue there is obviously those identities can be leaked, corrupted. And then on the other side, there's a huge issue with the corporate governance of these centralized authorities. We really can't see inside the boardrooms of Facebook or Twitter, see what leads to the decisions that they make when, say, banning a public figure from their platform or deciding whether or not they want to take political advertising on their platform. So Web3 is designed around a shared truth, an extensible framework for creating massively multi-user, economically strong applications. Ethereum certainly paved the way. Many of us here know today. ChainLink obviously had its start in the Ethereum community, just like ourselves. It really proved that these decentralized web applications, whether it's DeFi or NFTs or DAOs, do have the potential to disrupt both the corporate and internet structures that exist today. However, as we all know, limitations surface that severely hampered many of these projects, as those early projects that I listed there hampered their early success. So obviously, we're very aware of a lot of the low throughput and network congestion on Ethereum, making it very difficult to use and scale these applications. I was heavily involved for a number of years in the state rent debate within the Ethereum community. Very contentious, very difficult to get a fix in, and over time leads to really excessive chain size growth, which makes actually running and operating the network increasingly difficult over time. And then obviously, the ultimate FUD in crypto today from a lot of folks is the energy argument. It is extraordinarily wasteful, even in the smallish scale that proof of work networks operate on today. You can only imagine that if the global financial infrastructure and web infrastructure were all running on proof of work blockchains, we would find ourselves in a very difficult predicament in a very short period of time. And then the last major limitation that we found with our early work in Ethereum is that the EVM is just not an appropriate tool for really complex or really customized innovations. On the left here, there's the list of opcodes, basically these core protocols within the Ethereum blockchain that you can call and code using smart contracts. It's quite a limited number. And we believe that developers today need a lot more flexibility in that runtime or opcode customizability in order to get the really scalable end user products we're all looking for. Custom blockchains emerged as a result. Some have caught on, some less so. Plenty of consortium and other efforts have been made to develop custom blockchains, but I think we're really on the verge of the next generation of these because people have proven that they really do want them. They want the performance, they want the security, and they want the sovereignty of being able to customize their own layer one to their purpose. Now, obviously, there are some challenges that come along with this. There's a lot of overhead. Potentially, if you're running your own chain, you are isolated. You don't have the same composability that you would have if you were all on the same chain, which has led to a lot of the innovations in, say, DeFi. And then obviously security, right? If you spin up your own chain, having it economically secure enough for people to trust it and use it is an incredibly difficult problem. Until very recently, like out of the top 25 or below the top 15 or 25 chains, it would cost just a couple $1,000s to attack a chain. So this is why we built Polkadot, right? We knew we had all these issues in the ecosystem. We had been on the ground for the entire development of Ethereum, seen how it worked, seen development techniques and approaches that worked. So we knew that we thought Polkadot was a really elegant solution to a lot of these problems that we found today. So higher throughput through heterogeneous sharding, lower cost of building via Substrate, this modular blockchain building framework that we've built, highly composable by working a lot on cross-chain messaging, and then working a lot with the governance and treasury, which we'll get into a little bit later, to other massive issues that we found both in the Bitcoin and the Ethereum community. How do you make decisions as a community, and how do you fund development of a core protocol in perpetuity? So here is what's happened so far and where we've come. So I'll just make this a little bigger on my screen because it is incredibly small, virtual world. So we're looking back to the end of 2016 when Gav published the Polkadot white paper, and then the first commits by Rob Habermeyer on November 2017. So we've been at this for quite a long time. Gav said recently in a talk that he gave that he coded the first version of Ethereum himself over about a week, and then it took a team of 2 or 3 folks, him and Jeff Wilkie and one or two other devs, maybe a week or two additionally to get like a sort of a main net up and running. So 2 or 3 devs, 1 or 2 weeks to get Ethereum 1 up in more or less the shape that it's still in today. Polkadot has taken a team of 40 to 50 high quality engineers, 4 to 5 years to go from idea to running network. So along the way, there's been a lot of milestones. I'll share these slides after the fact so you can also take a look. Just a couple of key events that I would call out is when we split Substrate out. So in 2018, April 2018, Substrate was split out. There was a decision made to split Substrate out from Polkadot. So Polkadot is a blockchain built using Substrate to provide this low-level layer 0 interoperability and security for layer 1 parachains, and Substrate became basically its own product as a blockchain building framework for building blockchains, parachains for Polkadot, but also standalone chains like we see teams like Compound doing. So this is our beautiful network visualization of Polkadot. Many of you have seen. I'll do a little brief run through of the different network participants in Polkadot, so I can show you how they interact. But generally speaking, this is what a heterogeneously sharded network topology looks like. So these are the network participants within Polkadot. So when we talk about Polkadot, the Polkadot chain, we're really talking about the relay chain. This is the heart of Polkadot. This is what we call the layer 0. It's also could be considered a meta protocol, and that it is basically only a security and connectivity layer for hosting layer 1 blockchains. So whether those are parachains, which are layer 1s, or if they are bridges to other layer 1s like Ethereum, Bitcoin, or Zcash, they are all hosted on the Polkadot relay chain. This is also where the staking lives currently on Polkadot and where the governance lives on Polkadot, but long-term, or not even long-term, medium-term, there are plans to shift all that functionality from the relay chain off onto their own parachains, giving us more capacity for more parachains on the relay chain. So these parachains are sovereign blockchains that can have their own tokens and optimize functionality to specific use cases. Talked a lot about the value proposition for owning your own layer 1, owning your own blockchain earlier, and parachains are our solution to that. Parathreads, different sort of economic model for a parachain. Rather than buying all your security up front or leasing all your security up front, Parathread sort of pay as you go, more similar to a gas model on Ethereum. Also talked a little bit about Substrate. I'll give a little brief overview about what this blockchain building framework looks like. We have done quite a lot of user research and research overall in the blockchain ecosystem, and we really do believe that Substrate has emerged as the industry standard blockchain building framework, taking the development time for building your own custom blockchain from months to years to weeks to months, or even days for really high quality devs if the chain's not particularly complex. But basically Substrate gives you everything you need to spin up your own blockchain and allows you as a blockchain developer to focus on the runtime. So this is what we call the sort of execution environment for your blockchain. So rather than having to worry about networking issues or consensus issues or all the other nice things that you want to have around a blockchain client, you can focus on, say, in the case of Akala, which is a fairly well-known parachain building on Polkadot, they're building core DeFi primitives, and they really only want to care about optimizing their stablecoin, optimizing their DEX, optimizing their liquidity provisions. Chainlink is another example, right? Like rather than potentially having to run your own chain, Compound's another example, right? Like they are a DeFi team, right? They were looking for a network to build in and a technology to expand their ecosystem, but they didn't want to have like peer-to-peer networking team inside of Compound. So Substrate was a great solution for them to build a gateway. So in the last couple of seconds, a minute or so I have here, let's talk a little bit about where the Polkadot ecosystem stands today. Ecosystem, so builders wise, and I think these numbers might be a month or two out of date, so they're actually quite a bit further along than that, but probably over 1,000 plus repos tagged with Polkadot on GitHub. On the tooling side, well over 100 to 150 products in development, as well as integrations with things like stablecoins that developers need. And then I think at this point, 125 to 150 blockchains in development, vying for a parachain slot or a parathread at some point. Network side, top 5 network by proof of stake, value staked. We're just out about 300 validators with additional 522 full nodes and 22,000 nominations. We've seen that grow tremendously and consistently, which has been great to see. And we funded quite a lot out of the Polkadot and Kusama treasuries. If you're a builder out there looking to build core infrastructure for Polkadot or Web3, please hit up the Polkadot and Kusama treasuries. On the hackathon and conference side, we've had a really great run over the past year or two. Hakusama, Sub-Zero, and Hello World. I would say definitely keep your eye out if you're a dev for Sub-Zero. It's coming back in the fall. And then we're really excited about Polkadot Decoded, which we launched during the pandemic, which has been the largest single protocol virtual conference of 2020 and 2021 We'll see how Chainlink's numbers do. Excited to be a part of it if you beat us out. And then what comes next, if you've been keeping track, I didn't really talk much at all about Kusama today, the Canary network for Polkadot, where we test and prod from day one. Parachains have been rolled out on Kusama. The first 5 have been awarded, and we're in a brief period here where we're going through a number of optimizations and other audits before announcing the Polkadot parachain rollout and then the continuation of parachains on Kusama. So stay tuned. We should have more news about that soon. Thank you all so much for having me today, and really looking forward to enjoying the rest of the conference.
Thank you, Peter. Great chat about Polkadot and where they're going and what's currently happening. Really excited for our next speaker, Igor Baranov. He's founder of XDAI, and really excited to listen to him and what's next.
Model can work. And it's interesting that income from playing games is greater than the minimum wage for many countries, sometimes even advanced developed countries. I think the interesting thing to note about such play to earn games is that it really opens up finance to a significant amount of population that has not been banked before. So imagine the number of people. I mean, so Philippines has a large number of people that are unbanked. They does not have a bank account and do not have access to a bank account because they live really far away from the city, for example. But all of them will have a handphone, have a mobile phone, and they can download an app they call Axie Infinity and start earning on their free time. So I would like to ask and everyone to sort of imagine the number of people in the Philippines who have a digital wallet before they even have a bank account. And if you sort of think about the possibility for everyone across the world in Africa and so on, who do not have a bank account, this sort of really unlock, because once they have an access to a digital wallet, they have access to, I mean, they're earning SLP in this case, but they could have a stable coin, for example. They would have access to all these financial services that banks or the traditional finance have chose to ignore all these people. And I think DeFi is really interesting because it provides all these guys with a chance to have to save and to lend and to borrow for the first time that before this they couldn't even have access to. And finally, I think the last slide that I have on what I think will happen next would be regulations. I think regulations will be the single biggest risk factor for DeFi. How will regulators regulate this space? I think a couple of days ago, the SEC chairman, Gary Gensler, recently came out with a statement to regulate DeFi, and he said it's technologically neutral, but he said he's not neutral on investor protection. How he choose to protect investors is a question, right? Will regulators take on a progressive or a heavy-handed approach to regulations? Regulations will play a big part in DeFi development, whether we like it or not. I don't think when or how regulations will come about, we still don't know. The flavor is still unknown, but I don't think it's going to last forever without regulations. Everybody wants regulatory clarity, but I really hope that regulators take on a progressive approach and kind of think of DeFi as a way to kind of spur a new growth trajectory for the global economy. Just like how the internet industry was sort of regulated in a pretty light touch approach. If the same can be done over here, then I think we start seeing a very interesting golden decade for the next 10 to 20 years with a rise in all these innovations coming up in blockchain technology. I think the other interesting thing to note would be what would happen to Uniswap's grant of $20 billion to the DeFi Education Fund. Will it lead to any successful lobbying on all these regulatory bodies? And if we don't get any regulatory clarity, one of the things that I foresee happening more is that we start seeing a lot more anonymous teams launch because of the regulatory uncertainty in place. So yeah, I think, ladies and gentlemen, that's all the time that I have for today. I presented everything a little bit about state of crypto market that we have, and also some of my take on what's going to happen in the second half of the year. Thank you very much.
Bobby, thank you so much. That was incredibly illuminating to take a look at what's happened this year. And unfortunately, you've given me more questions, so I have got a list. So hopefully I'll be able to touch base with you later on. Maybe we'll talk. The idea of play to earn is a version of UBI that we didn't see coming, universal basic income. Okay, my mind is blown, and I'm expecting more mind-blowing things. So if you guys have comments about that as you're watching, please feel free to interact with us on Twitter, in the chats, find us around, because so much of this content needs to have discussion around it and some processing. So I'm really excited for our next panel as well. It looks like they are ready. So let's keep this moving, shall we? So up next, we have Slowly Then Suddenly, Transforming the Enterprise. We've got David Nage, John Wolpert, York Rhodes, Andreas Dittrich, and Etienne Sardon. David, why don't you go ahead and take it away as our moderator for this next panel? Thank you.
Thank you so much, and good morning, good afternoon, and good evening, wherever you are. We are really happy to be with you today. Thank you for that. Good morning, good afternoon, good evening, wherever you are and joining us today. We have an amazing panel today. Slowly Then Suddenly, Transforming the Enterprise. We're going to be talking about the rapid increase in adoption of digital ledger technology, of blockchains, of distributed and decentralized architecture around the world. We have an amazing panel with us today. My name is David Nage. I am a managing director of ARCA. We are one of the largest institutional asset managers of digital assets in the world. And I am also the host of Base Layer, a podcast that has been running now for over 2.5 years that has featured some of the now most prolific founders in digital assets, such as Sergey Nazarov from ChainLink and others. And so with that, we're going to keep my introduction short because, again, we have an amazing panel here of people in the space, and I want them to tell you about what they're doing and where they're coming from. And then we're going to talk a little bit about this transformation period. So with that, I'm going to bring it to John Wolpert from Consensus.
Oh, hi. It's good to see you, Dave. It's good to see everybody, York and the whole gang. Yeah, I'm John Wolpert. I was one of the founders of Hyperledger and worked over at IBM, and then saw the light that shared databases were a good idea for things, but I was more interested in more public blockchain and what it could do for enterprise. I would call this not enterprise blockchain, but blockchain in the enterprise. How do we use it in a safe, effective manner? And that led to the baseline protocol, which I'm the current TSC technical steering chair of. And in that capacity, we're building a not a chain, not a token, not a coin, not a scheme, not a product, but a standard, a technique, a design pattern that will be now going to promulgation in the new year and to ISO, hopefully, where we can use public blockchain in a way that is safe and effective, where you don't put any data on any kind of blockchain, but you use it for digital integration. We can talk about that more later.
Thank you for that, John. We'll go to York from Microsoft.
Hey, can everybody hear me okay?
Yes, we do.
Awesome. Great to see everyone. Always great to be back with my collaborator, John, for our sparring sessions about design patterns. I was happy you used that terminology, John. So York Rhodes from Microsoft. In 2015, I co-founded our blockchain work at Microsoft. And we've been on a journey through partner relationships, portfolio development of different types of tooling, whether it's developer tooling and collaborations very significantly with the open source community in all the work that we're doing. And then relevant services that we've established during the course of what I would call the very vibrant POC stage of enterprises learning about this technology. And then I think, where we are today, is a really interesting inflection point and tipping point based on what's going on. So I think that's the exciting vision that most people, including myself, had when we got into blockchain was how do you have a decentralized system of trust, and how do you maintain that, and what is the actually end state of that? And from my perspective, what journey allows the enterprise to get there, right? And so having been around sort of through the internet transformation, that's sort of the pattern that I followed. Like, how did enterprise get involved in the internet in a safe way? So anyway, my work today, actually, I sit currently, my day job is in a $60 billion revenue line at Microsoft. It's the cloud revenue. And early in my work in blockchain, realized that supply chains were a very interesting pattern that could be solved by this decentralized technology. So I've had the opportunity for the last 3.5 years to actually steward this project, and a year ago actually moved full-time into the cloud hardware supply chain of the $60 billion revenue line at Microsoft. And so we actually have planted blockchain technology and techniques in our supplier base to actually power the work that we do in the cloud. So it's pretty interesting opportunity, which was hard to pass up from that perspective. And from a successes perspective, we've actually gotten a supply chain breakthrough of the year for this blockchain-based project from Gartner. So from a blockchain guy, getting Gartner to acknowledge that was actually quite a good achievement that I didn't realize I was going to have this year. So
awesome.
All right, so I'll pass it on.
Very good, thank you, York. Moving over to Andres Dietrich from Deutsche Telekom.
Hi, everyone, and greetings from Berlin. It's already afternoon here, and I see it's a little earlier in California. So good morning, everyone. I'm head of Blockchain Solution Center at Deutsche Telekom. We're the biggest telco provider in Europe, and you might know us also from T-Mobile US, obviously, which is a subsidiary of Deutsche Telekom. And I'm heading the unit that takes care of blockchain activities in Deutsche Telekom. There are many different islands, but we are the center of gravity. And we've seen an incredible transformation. We do exist since 5 years, starting with enterprise use cases. But roughly 3 years ago, we really started transforming ourselves to focusing almost exclusively on public blockchains, because we believe that value is being digitized and digital value needs to be managed. And the layer for that is going to be, in most cases, will be public blockchains. So our duty as a telco is to support those networks, right? We put telephone lines so people can exchange thoughts. We are running servers and backbone of the internet so that we can exchange data at scale. And next thing is exchanging value at scale. And that's what we're going to support. This journey has started roughly 3 years ago, and I'm pretty happy that we reached important milestones already last year. For example, we are live on ChainLink since more than a year by now, going live right in DeFi summer. What a ride. And I'm happy to be part of that ride.
Excellent, thank you, Andres. Next to Etienne Sardon from Swisscom.
Yes, so hi all, my name is Etienne. I'm an innovation manager at Swisscom's FinTech unit, where we're responsible for developing new business opportunities in the area of digital assets. So also very excited to be part of this panel, and we'd also like to actually use this opportunity to make a short announcement. So we're very excited to announce that Swisscom has joined the Chainlink network. So as we're speaking, Swisscom has now also an active Oracle node, and we're already contributing price data for the US dollar pair right now. And we're still in the beginning of our Chainlink and DeFi journey, but we do see this as an important step in moving Swisscom towards a more decentralized and open financial market infrastructure. And we're very excited to be part of this transformation, as we see a lot of great innovation potential really unfolding in this space right now. And this is really something we greatly care about at Swisscom, because we're not only a telco provider, but in fact, we're also one of the largest IT service providers for the financial service industry in Switzerland. And in this role, we want to enable the development for better financial services. And we believe that with the help of innovative projects and partners like Chainlink, we can really position Swisscom to be part of this new decentralized financial system that is emerging right now. So very excited to be part of the Chainlink family, and very much looking forward to the journey ahead of us.
You heard it here first. I love it as a podcaster when I get to break news, and you're hearing it now where there is a breaking news. Thank you for that, Etienne. Appreciate that. If we could potentially jump into the subject at hand, that is what we're defining as slowly then suddenly transforming the enterprise, as I alluded to. This is actually very true, that over the last few years, and you've heard from York and John and others, that they have been cognizant in understanding of digital asset infrastructure, of distributed and decentralized architecture for a number of years. But that has taken some time to get to a point of inflection where corporations, enterprises, global conglomerates are using it. And so I'd like to get a sense from John, we'll start with you if that's possible, because I know Consensus works with a lot of corporations out there in the globe. Why do you think it's happening at an accelerated pace now? And would you agree with me that it is actually happening at an accelerated pace now versus the last few years? What is the reason why it's happening today versus the last few years? And then we'll move over to the other panelists.
I'm trying to, folks have heard me talk about, shared databases, and that's, I do think that some things don't go the way the internet. Somebody was trying to convince me the other day that NFTs the way they are today. I was expressing some skepticism about certain kinds of NFTs, and they said yes, but nobody believed the internet was going to be this thing. And I'm like, you can't use that argument all the time. It doesn't actually. I can point to countless technologies that did not go that way. And I think it really comes down to mental models, right? So I think as technologists, we've all agreed, and I'm sure York and I would agree with this, that the technological set of capabilities that have been assembled into what we generally call blockchain has importance. York, I'm guessing you're going to nod on that.
Yeah, absolutely.
Right, but the mental models around that have evolved, and maybe this is why it's slowly then subtly, because suddenly, we kind of go from one not going to work idea to another one, not in terms of the technology itself, but it's like, hey, I've got a hammer. Let's try to glaze glass with that. That's a terrible idea. That doesn't work, right? So let's. I can use it to pound nails. That's a more useful use for it. I think. Anytime you hear people talking about blockchain as a database, even sort of in an inferred way, right? Like I'm going to put data on it. In a corporate environment, company environment, even small companies today, as they grow and get into regulation and importance and grandma's pension and all those things, they're going to wake up one day and realize that putting their internal data on a digital nudist colony, even a private one, it's just a digital nudist beach on a private beach, right? Is probably a terrible idea. It's a gigantic threat surface. So we've seen all these proof of concept projects working that most of the time, they may call themselves in production, but there's a CISO in there somewhere that's going to put the kibosh on it and say, no, wait a minute, are you crazy? Don't do that, right? So you can get a certain distance on that. And I was part of that wave. I thought of it as a database in 2015. Mark Andreessen thought we were dumb. And we used to call this the Andreessen's revenge, right? That I was like, Mark Andreessen's smarter than me. What does he know that I don't? And then, a couple of years later, I'm like, oh yeah, he was smarter than me. And I didn't have the right idea. It's not a good database. It is possibly good middleware. An always-on, tamper-resistant state machine that resists people taking it over, locking you out of valid transactions, is a powerful thing. It does not scale. A singleton can never scale to be the back end of everybody's application all the time, everywhere. Dfinity, you'll see, is a bunch of subnets. It's competing against a cloud. It's not a blockchain. It might have some blockchain sauce in it, but it's not a blockchain. So I think a singleton cannot scale, even without consensus layer, cannot scale to be everybody's backend. It's not a world computer. It might be the internet's state machine for hash management and ordering. It could probably scale to do that. And that would be an extraordinarily valuable thing, because that way we don't have to spend capital expense setting up integration buses over and over and over again and paying IBM $1 million a year to do it or whatever. And so that would be a nice addition to the internet. And it's really boring, but extraordinarily powerful. So I think when things get boring, things get faster in corporate use of things like this.
York, to you.
Yeah, no, and I think that's a really, really good jumping off point, because like innovators sometimes can feel the boring encroaching on what they're innovating on and start to get bored, right? Because they're like, this is becoming very mainstream. And I certainly have those hairs that stand up on the back of my neck when I get there. And I have to just remind myself, in this category, we're very early and there's a ton of work to do. But I think, just taking a slightly different approach, to me, I think the big things that have really driven the speed of recognition of the value from a non-participants perspective is really twofold. One is the unicorns that have happened, like the IPOs, for example, Coinbase, that always wakes up some investors. You can see the $2.2 billion Andreessen Horowitz A16Z fund, right? That's a pretty big statement in the market. So I think the realization in the financial, sort of markets is one. Secondly, the realization that DeFi is a new fintech, I think is a very high percentage of that market. And that's also a big recognition. And then the other main thing that I think has really driven this is like, those typical tipping point things that you just don't realize they come out of nowhere, like NFTs, right? That have been around for a while, right? And Pattern certainly has been around for a while. But just they got this zeitgeist moment, right? Where all of a sudden, there was a ton of interest coming from non-blockchain protocol people, right, into the value proposition of an NFT, right, for creators and consumers alike. And those two areas, NFTs to me represent essentially the new digital e-commerce realm. The other is obviously all in the finance and the fintech space. And I think when you hit on a consumer meme and on a fintech unicorn revolution, that drives a lot of people to act. So I think that's what's going on from my perspective.
Thank you for that, York. Andres, I want you to address the same question, but I'm going to add a extra piece there because I heard you in your introduction speak more specifically about public chains. And so there has been for years a debate, especially in corporate worlds and corporate circles. Could we actually use public chains, or do we need to use private blockchains that protect data? So why, again, do you think we are seeing accelerated growth of interest? And then why specifically did you hit on that public chain aspect?
I'm not making the argument that John made already again, which is look at the 90s. And we've had this before with the internet. I truly believe that there will be niche applications for enterprise or permissioned blockchains, but the real power lies in public decentralization and tokenization. Right, so that's where the bulk of the value will be managed, and that's public blockchains. And by the way, I have two timers here, and one just went off 9 minutes ago. London upgrade on Ethereum, EIP 1559 going live. That's what's happening outside, and that's just one news. I mean, that's big news now, but those news are on a weekly basis. We have insane announcements. And going back to your original questions, slowly then suddenly, well, it's about time, enterprises, right? Get on track already, because startups are taking up the space. And if you don't move, you will be out. And that's what you see in different industries, but especially the financial industry is really being disrupted. So it's about time. And it's about time for another reason. For now, there's a lot of regulatory legal gray zone when providing services on top of public blockchains, obviously, or on top of any blockchain, to be honest, right? And this risk at the moment is being handled by startups only, right? Mostly, at least. And they can't really do anything about it. They're just having the risk. They don't have the power that enterprises like Deutsche Telekom, Microsoft, you name it, have to do lobbying, to force better regulation, to make this a viable place to do business as well, right? So slowly but suddenly, I think we've been waiting too long. We've been focusing on allow me to say that bad use cases, bad blockchain use cases for way too long in the traditional industry, basically trying to do our business models just somehow with blockchain in the name without changing anything. That didn't work, and we've been left behind in a sense. And this is the chilly wind that we really felt 3 years ago, when we felt we're doing the wrong thing. This train is leaving without us if we don't transform quickly. And that's where you get the speed, right? Once you've understood that, you get a sense of urgency. You don't only need to act, you want to act because of all those exciting opportunities. Think of Q1, Ethereum again, will have the merge to proof of stake. And that's just Ethereum. That's the biggest news on Ethereum. I could tell you dozens more, right? So that's what's happening, and let's do it.
Thank you for that, Andres, and congratulations to the Ethereum team with the release of EIP 1559. It is a hallmark moment for them, and something that for all of us that are on the inside have been watching, and congratulations on the work with that launch that is coming just shortly here. Etienne, the question to you again, slowly then suddenly, why do you think we are progressing at an accelerated pace of adoption today versus the last few years?
Yeah, so maybe also to turn around the question a bit, also what has been blocking adoption a lot. I think really, I mean, and some points already have been mentioned before. I think really the biggest challenge really has been that with a lot of these decentralized systems like Chainlink and also DeFi, they don't easily fit into existing mental models of an incumbent or enterprise because they just so radically differ from its core business. So I think really incumbents are challenged to rethink their notion of value chains, business models, value capturing, and so on in the context of a more decentralized world. And the problem really is that incumbents, they tend to want to have full control and ownership of systems or businesses they operate in. And I mean, for obvious reasons, that's just not possible in a decentralized world. And I think while incumbents acknowledge or have acknowledged that DLT is quite a powerful technology, they're like still struggling to find their spot in public and open blockchains. And I would say that is actually the perfect example of the innovator's dilemma described by Clayton Christensen, where he says that the attributes that make disruptive technologies unattractive in established markets are often the ones that have the greatest value in emerging markets. So a key takeaway from this is really to develop new technologies with the right customers, not necessarily the existing ones. And now looking also at DeFi, I think it's becoming quite clear that there's like a real market with a growing customer base that is starting to be delivered financial services in a radically new way. And we can see this is really also taking off in objectively measurable ways, just looking at, let's say, lending protocols like Aave and so on, where you can really see substantial growth in the total value locked in these protocols. And I mean, what's really fascinating about this is that a lot of these DeFi platforms are essentially doing what open banking always wanted to. So they turned the open banking idea into reality, but a lot faster and also without requiring regulators to drive this change. So I think enterprises are seeing the impact that these projects can have. And I think that's kind of the accelerator or the catalyst for the tipping point.
Thank you for that. And so I want to jump to thematics and narratives that are becoming more and more important in the industry and the asset class that has evolved over the last few years. And I think, as Andre said, alluded to this, back around 2016 and 17, you had founders who wanted to just create replacements to pre-existing architecture and systems, to social media apps, and to lots of different things that we use on a daily basis. And then we started to see this new evolution of DeFi, roughly about 2 years ago, 2.5 years ago, that was effectively creating a new financial system. We then saw the rise of NFTs. However, for those that are familiar, NFTs were around in 2017 with CryptoKitties. And as Don probably knows very intimately, the effect of CryptoKitties on the Ethereum ecosystem at the moment in time. We've also seen Ashton Kutcher's new CryptoKitty kind of emulation, his NFT out there, also doing very similar things the last week or two. I'm curious from the panelists, what narratives, what trends, what aspects of this new industry are you really locked into right now for the current, the present, but also for the next 6 to 12 months. And York, with your permission, I'd like to start with you.
York might have froze.
Is frozen.
I think you broke up a little
The
bit.
question was so mind-blowing that we froze.
He looks happy.
Oh, I was gonna impersonate York and give you his answer, but no,
I believe York is back with us. York.
Oh, wait. Were you asking me a question? I'm back. Yeah.
Yes. Yeah. Again, to address what themes, what narratives, what trends, such as DeFi, such as NFTs, what specific trends and narratives are you currently focusing on today, and that you believe will be impactful for the next 12 to 18 to 24 months?
So I actually think the sort of realization of what NFTs are is just starting to dawn on people, and so sort of in some sense, that technology is going to drive a whole nother wave of innovators into the space, whether or not they are actually keeping the promise of what NFTs are, supposed to do from a consumer and creator value proposition perspective. There are folks running around in the NFT space, particularly in the blockchain gaming space, basically trying to recreate their favorite startup, right? And saying that it's an NFT and that they've solved all the world's problems with blockchains and that they're doing it better and it doesn't have to be decentralized, right? That to me is a risk, right? But I do think that this particular space, in addition to the DeFi space, but I think outside of the DeFi space, NFTs just represent a pure digital e-commerce opportunity. And you can just see that across many different layers, including recognition from Toby Ludicky of Shopify that he should actually have capability in his marketplaces to represent NFTs natively.
I will kick it to John for a second, but I will say that the play to earn models that we're seeing with Axie and with the support of startups like YGG, I think are revolutionary. I think are going to change the landscape of a 3 billion gamer population around the world. So I do think that that's something that we are going to watch happen today. We are watching happening today, and we will see in the future. John, you had something that you wanted to say?
Yeah, I think that it's important. I was setting up a punchline earlier, right? I was like, hey, blockchain's boring, but the answer that if used properly is not boring. And NFTs are not useless, but putting raw in the clear or even encrypted data in a blockchain for commercial or company. I mean, imagine if you were a hedge fund and you went into something, and it's pretty hard to keep that from another hedge fund, another competitor, if you do it in the wrong way. So I think Paul Brody and I came to an accord about this. Tokens are good, but in a company's perspective, you need to keep the data in that token to effectively a pointer or a hash or something. And that's very valuable. What you don't want to do, so you can use tokens and you can get exposed to DeFi. And in fact, that's the work that we're doing right now, is to say, hey, you know what, if you baseline protocol your invoices, we will buy them from you for a really low rate because we think that they're more likely to get paid because you have assured consistency between your somebody's accounts receivable system and somebody's account payable system. Don't put the invoice on the blockchain. But you can roll them up into tokens and do DeFi from there.
Right. Well, luckily we have the advent of zero knowledge proofs and some other aspects of privacy sharing L2s that are out there that are starting to facilitate that, making it easier. Andres, again, trends and narratives. We have about another minute or so, and then we'll go to Etienne. So trends and narratives you are watching for the next 6 to 12 to 18 months.
Very quickly, basically what we're doing, I think, is a model for other companies as well, running infrastructure for blockchain networks, public blockchain networks specifically. And this is kind of funny because we're doing a traditional IT service running a node securely, but in fact, we're providing financial services. So we're transforming us while we're running such services that we used to do for decades. And we won't remain the only ones. It's important that others jump on board because this means we will make the basis for all the applications on top of those networks more attractive, more stable, and so on. This goes in parallel with more investments coming from big corporations. I would expect both on the infrastructure investment side, a lot more activity. Again, just to make those a better basis for decentralized applications. I'm not the guy to tell you which is the killer application in 3 years. I'm not that visionary. I can tell you what we are focusing on, and when it comes to use cases, and this is mainly around the topic of digital sovereignty. I don't want to have a login with Google button, login with Microsoft button. Sorry, York. I want to log in on my own behalf with my own credentials and have full control over it. And the German
Andreas,
government,
by the way, we agree with you on that. That's why we've spent so much time in decentralized identities.
Exactly. And
Andreas,
European...
Yes, just quickly wrap up, and I need to get to Etienne very quickly.
Wrapping up, this is heavily pushed also by the European government, which is great to see that public players are asking for DLT-based solutions to handle identity management.
Very good. Etienne, very quickly, your thoughts?
Sure. So yeah, I think actually not so much a new narrative, but a revived one probably. I think the whole topic around self-custody is very, very important. And I think it's also now very crucial in the context of DeFi because it's really the gateway to DeFi. And I think we can see this very interestingly with also companies like Ledger, where you have really a growing user base, and also Square now considering hardware wallets and moving into that space. And I think just making hardware wallets or self-custody more fashionable will just be a huge game changer. And maybe also as a closing remark from my side, also what you guys mentioned, John and David, in terms of privacy preserving features, I think that's a super relevant area as well. I think networks like Oasis, Vala, or Secret are on a very important mission. And I think it's still one of the biggest hurdles for public blockchains, and also especially for DeFi, making markets more fair and to kind of counter combat things like front running. All of these things are actually very unique features that privacy preserving systems can bring to the table, and I'm very excited about that.
Excellent. Thank you for that. And thank you all for participating. Great panel. Obviously, we could talk for hours, and maybe we will one day again. Thank you all for joining us this morning or the afternoon or evening, where you are in the world. And I'll kick it back to Andy and the team there.
Thank you so much, David, and to all the panelists. What an illuminating conversation. Fantastic guests and so much information. Don't let the Etienne's Swisscom announcement get buried. Chainlink community, go look up Swisscom and find out what they do and how they do it as a telecom provider, as an IT service provider to the financial industry. Huge news, and I'm very, very excited about that. Thank you for bringing that to us today, Etienne. And also the London upgrade has gone live. So congratulations to the Ethereum community. The blocks are populating with the new London upgrade. So that's good news. We're going to keep an eye on Ethereum throughout the day. I'll try to keep an eye on the news and let you guys know, although you're probably all over the internet as well, but I'll do my best. Up next, a speaker that I'm incredibly excited about, Balaji. I follow on Twitter. I follow a lot of your ideas, and I'm very excited to hear what you have to say here. And I was thrilled that you agreed to come and talk to us. So Balaji Srinivasan on the Ledger of Record. Your keynote is next. Go ahead, and I'm excited to hear from you.
Okay, great. Can everybody hear me?
Yeah, we can hear you.
And see the screen? Tell me when I've got the screen share. So ready to go?
Yeah, we're good. Go ahead.
Okay, great. So today I'm going to talk about something I'm calling the Ledger of Record, basically the transition from argument from authority, where corporations and centralized institutions say what is true, to instead argument from cryptography. So basically BTC over NYT paradigmatically, right? And what exactly do I mean by this? So as I'll go through, our information supply chain is broken. I want to introduce a concept called the Ledger of Record and show how we can use it to transition from what I call fiat information to crypto information, where data is much more audited and provenance is actually tracked. And the first application of this is measuring inflation. We've got actually $100,000 prize for doing this, as well as a $100,000 grant in collaboration with Chainlink that we'll announce at the end. You can read about it at 17trillion.com/inflation if you want to skip ahead. But so first, our information supply chain is broken. So every leader, looks to their feed for information about what's going on in the world today, but the feed just tells you what is popular, not what is true, right? And, so for example, we just like over the last 18 months, everybody remembers, what happened, what has happened, what is happening with coronavirus, where at first, the Chinese government said there was no evidence of human-to-human transmission, and people reported there was no risk, and the Surgeon General told us to not buy masks and whatnot. And so, these three levels of research, reporting, and regulation, basically academia, media, and policy, were basically all broken. And so this supply chain of information, insofar as our society is supposed to be based on science, there's just something where it's not actually getting through, or it's not being audited, and people are just repeating it without verifying it. And these bad feeds can kill us, right? Like, it wasn't just a one-off. We're talking about, all the misinformation that got out there. The flu is more serious, and travel bans are overreacting, and avoiding handshakes is paranoid. Like, Recode had this whole story, like mocking people for it. It wasn't just that people were wrong. They were very arrogantly and condescendingly wrong in a dangerous way that did lead to people dying. And so the issue here, though, is you can't just say, oh, everything is wrong, therefore I'm just going to trust anything, put your hands over your head. We need to actually figure out, engage with the non-trivial problem of building a better information supply chain than the one that already exists. So how do we do that? So the most important tool for this, and I'll go into how this applies, is something I'm calling the ledger of record, by reference to, the paper of record or distributed ledger. That's kind of a merger of the two concepts. And so it starts with the observation that many articles are actually wrappers around numbers, right? Sports articles are basically wrappers around box scores. Financial articles are wrappers around ticker symbols. And political articles increasingly are just wrappers around tweets. And so, we can see this more clearly if you zoom in on what a tweet actually is. It's a data structure. It's literally numbers that underpin the words. The articles are actually superimposed on top of the numbers. And Twitter is the most important, feed of data that people write articles and so on about, but it's not the only one. You have the feed of coronavirus data from like the COVID tracking project. You have weather data. You have real estate data from Zillow. There's all of these event feeds around the world, but they're all siloed right now. There's different corporations, entities, nonprofits, et cetera, that have access to them. And, an important concept is that Satoshi actually figured out how to create a better feed. One way of thinking about a blockchain is it is a feed of events. And the Bitcoin blockchain essentially included cryptographic checks on the integrity of what was happening on that feed. Basically the who, the address, what they did, they debited Bitcoin, from this actor to this actor. And when it happened, the timestamp, those three things are protected respectively by digital signature protects the who, the mining algorithm, Nakamoto consensus, protects what happened, and when it happened comes from, the timestamp. And so this is something where you don't just have a feed of events, you actually have some computational checks that are, on those events. And while Bitcoin is a feed of very valuable facts, it can be generalized, right? So the feed of data on the Bitcoin blockchain represents changes in BTC ownership, but we can represent any scarce resource on a blockchain, like tokens and digital assets and even identity and other things. So we can get a universal feed of financial facts, but can we generalize it further? So one generalization, as everybody in this audience is aware of, is the concept of crypto oracles, right? An off-chain entity that writes cryptographically signed assertions about arbitrary data to a blockchain. And these assertions can then be used in smart contracts, which is what they're currently being used for, or they can be referenced in research, reporting, and regulation. So, right now, mainly this is like price stuff, but it could be sensor data or, whether a door is locked or unlocked or, like policy, decisions, other kinds of things, arbitrary internet data, right? And today, oracles are mostly price, but they can be so much more. Now, price is a good place to start for all kinds of reasons. Everybody in crypto understands it. And the thing is that they're a good place to start for another reason, which is that they're perhaps the most valuable kind of information to manipulate. So if you can get reliable price feeds, you can make reliable feeds of other data types, right? If you can get a false price on chain, you can make money in a very direct way. So there's a strong incentive to corrupt and falsify this. So if we can solve the oracle problem for price, we can probably solve it for a lot of other things. So it's actually a good place to start, even if it's not that obvious. And so eventually what we want to do is transition from people merely posting online to posting anything important on chain, right? Like basically this concept, just as, social network traction went, crazy from, a few million people in the mid 2000s to a few billion people today. I think that basically this concept of posting on chain, anything that you're really asserting for the record, you would post it on chain via Crypto Oracle, and that concept encompasses newsletters, testimony, paid data feeds, and more besides, right? That information you're putting on chain becomes a possibly monetizable Crypto Oracle. That's both humans and machines. And so the advantage of this approach is now we have separated fact versus narrative, right? So the facts, and the assertions, this is the data, and then the narrative is just a layer on top of these facts and assertions, right? So, the facts, basically in the Bitcoin blockchain, it's mostly just facts because, it's something where, this is the public address of the person who sent it or entity that sent it, and this is like a pretty high confidence timestamp. If somebody used OP return to put a message on chain, then that's an assertion where you can't say whether that assertion itself is true, but you can with high confidence say that this entity with this digital signature, put it on chain around this time, basically on this block, right? So the facts are on the metadata, the assertions are the data, and then the narrative is a story that you write on top of that. And a human can write that story, a machine can write the story, but we actually started to separate out, just low level facts and then opinion. And what I call this is the transition to oracles and advocates, right? Oracles and advocates is how our information ecosystem gets factored, where oracles have some cryptographic checks on what they're saying, at least on the metadata. And advocates then write narratives based on what is happening on chain. They're the layers on top of that. And this can be a human. It can actually also be a machine that just reads the blockchain and writes things out. Now, today, the kinds of things that you can prove are who did what when. But tomorrow, as we have other kinds of proofs, like proof of location and proof of solvency and proof of this and proof of that, each one of those proofs expands the scope of the ledger of record. That is to say, you can now put more kinds of, facts on chain, not simply assertions. And each such assertion, each such fact then basically enables a whole new class of kind of verifiable reporting and verifiable research. And so that's a ledger of record. It's a collection of all on-chain cryptographically signed data feeds. It replaces Reuters as a globally accessible, machine-readable, decentralized wire service, and it cleanly separates narrative and fact and assertion with a narrative layer on top. Okay. So now with that as a tool and as a concept, we can talk about the transition from fiat information to what I call crypto information. So if we recall that original broken feed, there are actually three broken components: the research, the reporting, and the regulation, right? So the raw scientific data was incorrect. How that was talked about to the public was wrong. And then the official policy response was also wrong. We had failures at all three levels. Now, the thing about this is actually the data integrity was actually a big piece of it. Garbage in, garbage out. Why did WHO report this incorrectly? Well, because they withheld, China withheld data on coronavirus from WHO. It wasn't just China. A lot of people got things wrong, but it was something where there was like either falsified or withheld or whatever data. So there's actually a fundamental data integrity problem. And if we're making big decisions on things, trillion-dollar decisions like, the fate of the economy and public health decisions, life-threatening decisions, we need extreme auditing of data provenance, not trusting on faith. Certainly, we want to spend as much effort digging into the raw data of coronavirus stats as we do into like the various kinds of silly things on social media. So if this is the fiat information pipeline, right? This guy from a prestigious institution says it's so, and this guy from a prestigious institution says it's so, and this guy from a prestigious institution says it's so. That's just all centralized. That's why we call it fiat information. It's just, some, centralized actors asserting by fiat that something's true. The alternative paradigm is crypto information, where we replace all three levels of the stack. The research is on-chain data and code. This is actually a whole area where you can write a whole thing on this. And basically the concept of reproducible research, for example, where you don't just release a paper, you release the code and the data required to regenerate that paper. And truly reproducible research would put all of that on chain, of which V1 is, the crypto oracle, right? So research via on-chain data and code. reporting via international, possibly pseudonymous influencers using on-chain data. So it's a small screenshot there, but like Willy Woo, for example, is an analyst that uses on-chain data from Bitcoin to actually write analyst reports. And the thing about that is that's not a small thing, it's actually a big thing, because that's actually verifiable. You don't have to trust him as an advocate. You can go to the raw oracle, the on-chain data, to confirm what he's saying. You can link to a block explorer. Yeah, it's possible the block explorer could falsify it, but then you could actually go and clone the blockchain yourself and look at it, right? There's multiple block explorers, so you can double check, triple check what he's saying, right? So now the reporting has fundamentally changed because the raw data has fundamentally changed. It's censorship resistant, it's published pseudonymously, it's globally accessible, it's free, it's incorruptible. The raw data has vastly improved in quality. We've gone to the very base level. That's why crypto information, it's not a small thing to reporting on on-chain data. It's actually a very big thing. And then the third step in terms of regulation is, rather than just trusting one government, we have N. Right. So, it's a big world out there. The thing I put in the lower right corner, for example, Wyoming is smart enough on Ethereum and crypto and Bitcoin to have DAO legislation, right? Some governments will actually understand that the crypto information supply chain is better potentially than the legacy supply chain, if only because you can validate every single premise, right? You may or may not agree with the assertions at the base level, but you can see who made them, what time they made them. You can at least get facts, metadata about those assertions that you can verify, right? So this is a fiat information versus crypto information supply chain. And you might say, well, look, the COVID disaster is ongoing. It's already happened. How is like price stuff going to impact that? Well, that's a great question. So the first application, I think, of this, the first successful thing is going to be measuring inflation. Okay. This is the first application of the crypto information supply chain, because the official misinformation on COVID has already happened, but the official misinformation on inflation has begun, is about to begin. It starts with the CPI. It goes to, reporting, back in May, the inflation scare doesn't match reality. Then a few months later, oh, well, actually inflation is actually happening, but it's only temporary, right? The taper may start by year end, okay? And this is where policy is based on, in my view, false or at least questionable reporting and research, right? And these folks just don't have better data than that. Nobody has better data than that, because basically people will just say, oh, inflation looks like it's happening. The price of vegetables or the price of lumber and so on has gone up. People have individual snapshots that make them believe this. And often that intuition is correct, but it's not simply enough to, data is not the plural of anecdote. You need to actually systematically correct it. You need to essentially outcode, outreport, outresearch the folks who are claiming that inflation isn't happening, right? So this is something we're very well positioned for as a community, because essentially it proves everybody right. It proves Bitcoin people right. As an early Bitcoin holder, one of the things about it is inflation and seizure of assets. It proves Ethereum people right, because you're going to need a dApp and you're going to need a smart contract to actually calculate that inflation. It proves for folks like Chainlink, right? Because you're going to need crypto oracles to report that. It's a synthesis of many different pieces. It's going to probably lead to stable coins. If you can actually calculate where things are inflating, you might be able to invert that to get a stable coin. So for all these reasons, we are announcing a $100,000 competition at 17trillion.com/inflation. Chainlink is participating in this and is offering an additional $100,000 grant if you use Chainlink to code a decentralized inflation dashboard. So you can read all about it if you go to 17trillion.com/inflation. As I mentioned, I think this is a perfect test bed. It's important, but it's also just a price, or really just about prices. So it's like a small amount of information that carries with it a huge amount of importance. It proves everyone in crypto right in different ways, which is kind of funny, right? It's basically like the BTC narrative and the ETH narrative and the Chainlink narrative, and every narrative actually kind of has a piece of this, right? And a good dashboard would be refreshed 1 million times per day. Like, this is something where a truly decentralized inflation dashboard that's applicable not simply in the US or in China, but around the world, would be something that certainly people in Venezuela would look at, people all around the world would look at. And it would be the next, in my view, the next CoinMarketCap, the next DeFi Pulse. It would probably be a pretty valuable thing in its own right. But it's also something which, sort of unites the clans, because we're going to need a bunch of different pieces. Bitcoin to hedge against that inflation, and decentralized apps, I think, to get the word out. So that's what we're doing. We've got this prize. It uses Chainlink, and it uses a bunch of different technologies there. We go through a lot of details on this in terms of how you'd actually potentially build this and some of the, gotchas. For example, scraping the data is possible, but it's not that easy to do. If you scraped a basket of goods, for prices over time, you have to be conscious of the fact that merchants are putting up various walls against scraping, trying to trick you in various ways. You can also try to partner with companies, to download the data. We think probably the best approach is to work with crypto merchants, merchants that are selling things in crypto, even if that's a subset of the full basket of goods and it's vectored more towards things like VPNs or digital goods, those folks are very friendly to the concept of an inflation dashboard. And so you might get better quality data that way. So all of these details, you can go and read this, almost 3,000 word post. The competition is going to go for 90 days. Going to, email it and tweet about it. You guys are seeing it first. And Chainlink has graciously agreed to co-sponsor it with, as I mentioned, in addition, this $100,000 prize is for investment. Okay. And then there's a separate $100,000 grant in Link tokens if you use Chainlink. So go get them, centurydown.com/inflation. I can take any questions, I guess. Go ahead.
Yeah, Balaji, thank you so much for coming on and discussing this. We will have plenty of additional resources about this for people who want to learn more about it. There's blog posts and tweets and such things coming out. But while I have you here just for a minute, let me ask you a couple of questions about this data. A little while ago, I've noticed on your feed, you've talked a lot about this information asymmetry. Is it really COVID that has kind of kicked this off? People have really noted that there's a lot here, or this goes back a little bit further? There's plenty of other examples as well.
Oh, absolutely. It goes back very far in time. In fact, there's this really amazing book called The Gray Lady Winked, which many people in crypto have read The Sovereign Individual, which is kind of about the future. It's a really good book. And The Gray Lady Winked is about the past. And it is, by an Israeli journalist, and it goes into how, the New York Times company has actually gotten not just that the COVID story wrong or the WMDs in Iraq story wrong, but they reported, for example, that Poland had invaded Germany in World War II. Okay, stuff like that, right? They'd gotten the Ukrainian famine, they'd covered that up. They had reported, misleadingly on Castro. They reported incorrectly that rockets would never happen. They said, 2 months before the Wright brothers flight took off, that would never happen, and so on and so forth. So this issue has basically gone back very far. And so it's something where, the first step is kind of to get that undeletable history. And then we can start actually kind of going in retrospect. But if you want to see the depth of the problem, go get that book, The Gray Lady Winked. It's on Amazon now.
That awesome analysis. You're thinking on a global scale, really. Inflation is this massive sort of issue that has a massive data set. So you can pull data from a lot of different places, which is kind of necessary to this. One of the other issues in journalism is local journalism has declined recently. So people are having a harder time like digging into their issues because there's not funding for whatever reason, for whether it's centralization in ownership of media platforms or whatever it happens to be. So is this a first step? And then if we can get this good data about inflation, what are some of those next sort of on the horizon places where we can find consensus and information?
It's a great question. And I think basically the reason inflation is so good is it's not simply, it's something where just the whole thing lines up. It's like a solar eclipse, right? Our community, the crypto community, has been culturally prepared for this for 10 years. It's not just about the technology. It's something where people are familiar with, for lack of a better term, this narrative that this can happen. And, it's something where, it's just a price, right? So it's something that, the price feed stuff that we've built, it's not that far to reach, right? Something like health data or something like that, that'd be a far reach, even if we can sort of know that, COVID misinformation was put out there. We don't yet have, good crypto genomic stuff. We don't yet, there's not that much health data out there. It's too much of a reach for the community at this point. But I think if with inflation, you can essentially have a better form of information than the fiat information supply chain out there now, then, generalizations are fairly straightforward. One obvious next step would be for all stock market kind of stuff to go on chain, because what you've essentially shown is that you can get better information than a government, right? You can get better information than, an academic, researcher who's part of the establishment. I mean, there's lots of academic researchers, and some of them would actually like something like this. They would, the Billion Prices Project, for example, at MIT is really good. It's kind of an inspiration for this work we talked about in the post, where, as it sounds like, they just scraped 1 billion prices from the web as sort of a shadow statistics alternative to the CPI, the Consumer Price Index. And, the thing is that it's 2021. Do we think we can probably do better than the CPI? Yes. But the thing is that, it's something where if we don't do better, if we just kind of grumble and say, hey, prices are going up at the store,
considering this as well. And now that there's these links between DeFi and financial services, price feeds and all these things, it again is a nice combination there.
Yeah, that's right. And basically you just kind of need one pretty good provider of, in a privacy preserving way of data, right? It could be somebody who has data on a lot of merchants. It could potentially be somebody who has anonymized transaction data, like, like a PayPal or a bank or something like that. You just need something where you can get a time series of a representative basket of goods, and the key is all of those things should be parameters and disclosable such that, as we discussed in the post, people can punch in their own basket of goods or have it like sort of read from data or something. I drive, I buy oranges, I use, computers, whatever. And then you see whether your personal basket of goods is going up or down in price. But in general, what it appears is that, all the commodities like lumber and so on, those are rising in price because physical goods are scarce. The digital stuff will be flat or even down because, that's actually, the marginal cost of delivering another byte is not that much, but the marginal cost of delivering a block of lumber is quite a lot. So it may be something where we see physical inflation, digital flatness, or even digital deflation, and that will push people towards much, much less physical consumption, just staring into their screen all the time because that's really cheap. So I think that is actually a part of the future, but at least we can sort of call that out in advance, predict it, show that the state is actually wrong in its stats, and then maybe build something better.
And by, putting this call out to the community, there's you suggested, is there a better measure of CPI? Maybe there is. Inflation doesn't always happen unilaterally across society, right? Different social levels experience it very differently. So maybe there's different indicators. Balaji, I could talk to you for hours about this, but I'm not going to. Thank you so much for coming on and chatting with us about this and taking a few questions at the end. Again, the resources to go find information about the project will be available online. Follow everything on Twitter. And I appreciate you coming very much.
Okay, thanks, guys.
Everybody, we are going to take a 5-minute break in between now and our next presentation as our presenters get ready and we get all of the slides and everything in order. So stick with us. This is SmartCon 2021, SmartCon #1. Again, I'm Andy Boyan. Come back very soon. Stay here. In fact, you stay here. I will come back very, very soon and introduce our next presenters. Again, thank you to Balaji for coming on and giving that great presentation. Hey everybody, welcome back. I've got an exciting panel for you today. It's a Q&A session with some friends of mine. Alexander Leonard Larson from Axie Infinity will be speaking. Axie has been mentioned a couple of times today already, and so now let's get into a Q&A. So up next right now, we have Alexander Leonard Larson from Axie Infinity and journalist Andrew Thurman.
Thanks, Andy. Yeah, as Andy said, he joined here today with Alexander Leonard Larson. He's the co-founder and COO of Axie Infinity, and Sky Mavis, who are the creators of Axie Infinity. First, Alex, I want to congratulate you. Axie is just on this unbelievable run right now. For the month of July, the game generated $196 million in revenues. That is up from just $100,000 in revenues for the month of January this year. You can do the math on the percentage there, but it is insane. Daily active users are nearing 1 million. Axie is comfortably the most successful NFT game, and Ronin is the most active ETH sidechain, Ronin being Axie's ETH sidechain, for NFTs. I think a lot of people knew that Axie had room to grow, that play to earn was real. But this is explosive expansion. I don't think anybody could have predicted this. What do you think the primary cause is? Is there one, like some reason that you're particularly proud of? How did this come to happen in such a short time frame?
Hi, Andrew, and thanks for having me here at SmartCon. So, yeah, everything you said there is correct. It's been a pretty wild ride the past couple of months, but you know, from our point of view, it's just getting started. I mean, the game that people are playing right now, we originally released it early in 2020, and there was just a significant amount of pent-up demand because the current battle game is actually also dependent on the breeding game, which then was dependent on Ethereum. So there was all this pent-up demand from people who actually wanted to play the battle game. The current player base that we had, they loved it. But they couldn't breed new Axies without leaking a significant amount of maximum extractable value to the miners on Ethereum. So that's why we created the Ronin sidechain. And once that was released, well, that's really when we started to see this insane run that's happened. So for us, that what that tells us is that there is a significant amount of demand to play these type of NFT or play to earn games, and there is a massive opportunity to introduce crypto to the mainstream by playing games, basically. And that's what we believed in since the beginning, right? That's when we founded our company early 2018. We felt that there's an opportunity here. It's going to take some time, but we didn't really understand just how long it would take to get to this point. So I mean, when we got started, there wasn't even DeFi. There wasn't really much of anything. Everyone had this belief that probably games and DeFi, some of these things are going to find product market fit. But, these latest numbers just tell us that if you can truly find product market fit, it's going to go pretty crazy, pretty fast.
Right. And yeah, I think you can see that, right? But just as impressive as the sort of internal metrics are some softer metrics that might be a little bit tougher to track. The ecosystem around Axie seems to be growing just as much as the game itself. You have full-time streamers now like Bryce Cent, who are making a real name for themselves, almost 50K followers on Twitter. And Axie is nearing top 50 games streamed on Twitch, which I think is just a stunning number. There's real world interest coming now. And you also have things like Yield Guild Games, another third party which provided scholarships to help users get over the initial cost barrier to playing. How important are these third party contributions, and is there one in particular you want to shout out?
Wow. Yeah, I'll try to not shout out a specific content creator because it makes all of the other ones that we have a little bit jealous. But there are too many to say specifically. Actually, I love to see how many amazing artists we have, for example, who are making amazing art pieces. They make memes, and that's the one of the things that helps spread Axie Infinity outwards. It's not only the game. Like Axie Infinity is a combination of both game and community and economy. So you know, the community, they touch on all of these things, like artists, that's more on the community side specifically. And then you have businesses like, you know, White Yield Guild Games, who are creating their own scholarships and other guilds that are in there. So they've been tremendously important in actually going to market in various jurisdictions, because it's quite expensive to get started playing Axie right now. So what these guilds actually do, some of them had many Axies from before it got expensive, and then they're kind of distributing them out to many different accounts, and then they are onboarding players like that. So it's sort of like a light franchise model, which I don't think anyone could actually foreseen, because everyone's like, oh, Axie Infinity is too expensive, we're just not going to start to play at all. But then you see that the community actually finds solution to because it's basically created using our existing account system that enables these scholarships. So we don't only have that, but we also have, you know, game developers who want to make Axie Infinity games, and that's one of the opportunities for NFTs. And in general, when I see all of these profile picture, you know, projects that are popping up in the ETH space right now, I'm like, wow, this is perfect for, you know, other games in the future. And that's also, you know, kind of where we started in Axie. We had these NFT game assets that, you know, we had the idea that we wanted to put them in various games, and then eventually we just started building. So I think in the next couple of years, it's going to be super exciting. And in Axie, of course, we even have podcasts. I think there are up to 5-6 different Axie podcasts that are specifically tailored to the Axie community. So it's just great to see how fast things are growing there. But everything is coming from this, you know, early traction that we had, that solid foundation. That pretty much the only way to do that is to, you know, keep building through a bear market, because that's when you find the true believers, the evangelists. It's quite similar to what you know, actually Chainlink did the last bear market.
That's a great comparison. I love that. 6 podcasts as well. That's an insane figure. Let's talk a little bit about the FUD then. I think a lot of Axie's success comes from this really elegantly designed economic flywheel. New users coming in drive demand for the Axies. That then drive demand for Small Love Potion, which you need to breed more Axies, and that leads to yields from the game as players earn by doing in-game activities, which then, of course, brings new users in. However, it seems like that flywheel stalls out if there isn't this constant explosive user growth. I'm wondering how the game maintains momentum when user numbers begin to contract, and how can the economy continue to flourish in more adverse circumstances?
Yeah, it's a very common question, and I totally understand why people have some concerns around this, right? For us, it's totally fine to be growth focused for now. So we see Axie Infinity as more than a game. It's actually a network where the more players that we have in the network, the more connections they are making with each other, and actually the more value that's being generated inside the network. So that's why we can afford to give these tokens out for a period of time, you know, while Axie Infinity is growing. But at the same time, you know, what happens if we have too many Axies that exist in the ecosystem? Well, we need to find ways that we can basically give them more utility. So everything is tied to the utility of the Axies. The more games you have created in your ecosystem, the more players will want to hold onto the Axies or potentially use them. And those use cases, well, some of them might be even releasing Axies into the wild so that you actually reduce the supply. So that's something that we have, you know, spent a lot of time thinking about, and it's not something that we are too concerned about right now, because I would say maybe only 15% when it comes to the development of Axie Infinity and how this game can evolve over time. Of course, you know, this is something that, let's say that we would prefer if there wasn't such insane rallies in prices, just because it's always better, kind of in our opinion, that it goes just slightly up and up and up and up, rather than this very, you know, bubbly and then it crashes a little bit. So we're trying to keep more of to trail the economy a little bit and then react if we see that things are getting out of hand. So sort of like the invisible hand, just not quite the same way.
Can you that's a really interesting point, and I'm curious how you approach something like that. Is this simply by introducing new features that also serve as a kind of economic policy making? You know, the new mini games themselves can have an economic impact, right? So when you talk about potentially curbing growth, does that come from these hypothetical Axie burn mechanisms? Can you give us a little insight, maybe an example of what an economic policy enacted in Axie might look like?
yeah, a very easy one would be when we are looking at, the SLP issuance that a player can earn every day, right? There is a set amount of SLP that they can make, but if we want to reduce the pressure, the sell pressure on SLP, we can basically reduce the amount of SLP that they can earn per day, and then at the same time we can also increase the amount of SLP that's required to breed. Of course, these are very things that we need to be very careful with. If not, people lose faith in the currency as a whole. So yeah, that's a very easy way for us to change things.
Really interesting. Changing topics a little bit here, I want to talk about the metaverse a touch more broadly. Something that's been nagging me recently is that a lot of the new projects, perhaps Axie competitors that are starting to come out, they always talk about building a metaverse, which in its language seems to me to be fundamentally antithetical to the notion of the metaverse, which is supposed to be this persistent universe that's fully interoperable across multiple game worlds and can overcome licensing and IP barriers. You touched on this a little bit, talking about folding in profile pick projects, bringing in third-party developers. I'm curious how Axie is approaching bringing in outside content and whether or not, Lunasha's borders will remain closed.
Yeah, another good question. I think we have to go back a little bit to answer this question. When we started Axie, we were very collaborative. I mean, Axie NFTs, they were initially purely on Ethereum, so we could collaborate very easily with the other project, and we even did that. What it turned out that it takes a lot of development time, and it's actually sort of a distraction until you have found that user base that it actually makes sense to collaborate with existing projects. So we actually took a step back and decided that we're just going to focus on our core, belief and what we think we need to do, and that is to make a good game and a good project so that we can actually get many users in that aren't already inside crypto. And that's exactly what we're doing. So we're making a fun game, and then these players, they come in to play Axie Infinity, and then eventually we can take them on a journey where they can play many, many different games, and then eventually take part in a broader Axie Infinity game universe where you can do many different things. So that's how we view the world at first, and then eventually, who knows if we can open that up to other IPs in the future, or even, it's natural that people will be able to use their Axies in other games as well. They are NFTs, they should be open. So that's definitely coming. But for now, we're in this kind of hybrid state where we actually need to take care of the current user base that we have and just be laser focused on that. So we don't spend precious developer resources on other things. And I think this metaverse meme where everyone is bringing it in, well, I actually think it's going to come from the community first. And it makes perfect sense to me that it would be a group of crypto whales who have a lot of money, who've made money in Ether or maybe in some other project before, and they've learned some things, and then they come at it from a more altruistic perspective where you actually want to provide a service for the entire ecosystem. The real challenge there is, how do you actually balance out the value of each profile picture project or Axie or Punk, or, how strong should they be inside that meta universe? And what is the gamified way to participate in the meta universe? Because people don't only want to, being social is a part of it, but people also want to do something. You can't just be social. You have to I play a game, or, there has to be some kind of mission. So I think we're very a few years out of that actually happening.
But it sounds like that's certainly on the roadmap. And, if an outside developer was willing to do the legwork, that's something that Axie would be open to?
Yeah, so we want to open up Axie Infinity, the game universe, so that people can make their own Axie Infinity games and put that on top of Axie Infinity Land. That's the first step. In the future, using Axie assets for other type of games, that could happen as well. It's just not something that we see as very feasible in the very short term, because there's so much on the infrastructure side that still needs to be built out. And all of these challenges in terms of what is composability, and these are challenges in DeFi, but in NFT world, it's just people are just starting to realize that, wow, this is actually going to be a major challenge.
Yeah, I think it's easy to look to the future and imagine what you want, but not kind of overlook the technical hurdles. Speaking more a little bit about the metaverse, though, I think you now have a big competitor coming onto the scene, to put it lightly. Facebook's Mark Zuckerberg, CEO over there, announced in a video he sent to employees that the social media giant is pivoting to become a metaverse company within the next 5 years. So far, he's playing nice. He's publicly said that Facebook will work in tandem with other companies and entities to build out the metaverse. But I think many people rightfully fear that they'll become these digital land barons in a walled garden. How does Axie, how does the permissionless metaverse compete and win against a giant like Facebook?
Yeah, I actually retweeted this today by one of the co-founders from Foundation. His name is Kayvon, and he said, and I totally agree with it. He said that it's increasingly clear that big tech will attempt to co-opt the term metaverse. So in my opinion, we should fight for the integrity of the word and what defines a metaverse. Like those would be that the digital items and the digital objects belongs to the people, and that they are portable. They can be used across many different games, for example, or many different applications, and that they actually hold some value. Now, I have serious doubts that Facebook or any other, big tech company will want to share all that value, because why would they? They are making money on us, right? They are making money on selling our identity, our data. So, I mean, I'm not so worried that they will succeed, because I hope that people are getting smarter. And that they will be able to see, the true benefits of something like Axie and other decentralized applications where you truly own your game assets. And that's the way it should be. It's just, once the genie is out of the bottle, it's really hard to put it back. So they might try it, but I don't think it's going to happen.
I agree, and I hope that's the case. Last quick one, because we're running out of time here. It's been a pleasure talking with you. But a lot of the things that we touched on today would ideally be, these major decisions would ideally be done by a DAO. Deciding on how much SLP emissions there are, choosing partnered projects. How quickly is Axie going to move towards full governance decentralization? And is that another sort of long-term roadmap, or are there clear objectives on the horizon?
Yeah, so we take a very, how can I say it, pragmatic approach to decentralization. I mean, our idea here is we actually need to make sure that there is a stable foundation first, and then eventually we can start to progress into decentralization from there. So how long it's going to take specifically, I mean, I think we could talk even a decade until Axie Infinity is fully decentralized. The reason for that is because making a game is really, really hard, especially when you're building on bleeding edge tech, and when you are trying to put all these pieces together, like not only the economy, the community, everything that's around a game like this, and even working with the larger, the larger game studios in the world, or the larger distribution platforms. So that actually needs there needs to be a core team in place. It's a little bit different from a DeFi application where you can actually just put a smart contract out there. I mean, we could decentralize the marketplace contract right now, but that wouldn't mean Axie was decentralized. So pragmatic approach first. Let's make something that people love and then care, and then have a clear roadmap that this will be decentralized, and that's going to be happening through a token. I think that's what we're willing to commit to at this point.
Great to hear. Well, Alexander, thank you for your time. I'm sure you're incredibly busy building comfortably the world's largest and most impressive play-to-earn platform. Really appreciate you taking the time with us.
Yeah, thanks for having me, Andrew, and thanks for letting me come on to SmartCon once again, to the Chainlink team, and I can see Sandeep is coming up, so should be very interesting to hear what he has to say as well. Okay, thanks, guys.
Thank you so much, Andrew and Alexander. Always great to hear from Axie and about their incredible community as well. So up next, we've got Polygon. We're excited to hear from Sandeep Nailwall. So everyone hang on. We're going to continue SmartCon 2021. So Sandeep, the floor is yours in just one moment. You're on, Sandeep. Go ahead.
Okay. Hi, guys. I'm Sandeep. I'm one of the co-founders at Polygon ecosystem. At Polygon Technology, and I take care of the the business side of and the ecosystem side of the things. And this this session is focused around getting to give everyone an update on where Polygon is, and and especially also focusing more on because it's been still like 6, 7, 8 months since we kind of expanded from Matic Network to Polygon. So conveying the idea of Polygon and what we are going to do over there. So first off, like what exactly is Polygon, right? So previously, if you see, we were building, if you can see my pointer on the screen, that we were doing with Matic Network, we were doing building a Plasma, which is one kind of scalability solution for Ethereum. And what we realized along our journey is that there is no one solution fits all for all the people who want to build on blockchains. Secondly, not everyone is looking for same trade-off. Some people want more scalability, where and then they are okay with little bit of less security and decentralization. Not like a complete lack of it, but little bit less on the spectrum. We say decentralization is a spectrum. And then similarly, there would be some other players who would want extreme decentralization and extreme security because of the, let's say, high value being traded on their application. So, and then there will be some enterprises who would want like complete separate chain for themselves, and they want to, use it for their applications and whatnot, and need privacy and whatnot. So it was very clear in our mind because, as many people would know, that Polygon today, after Ethereum, is the most adopted solution in terms of the number of applications that are building in the whole world right now. And like from all the blue chips of DeFi to gaming and metaverses and whatnot, like most of the applications that you would see, they would have a Polygon store already. So we are very well known for adoption, and we have been speaking to so many developers over the last many years. And we realized that in order to create a long-lasting protocol which is used by a huge number of developers, we need to cater to multiple demands, right? So that's when we expanded from Matic Network to this whole whole diagram that you see as Polygon, which is a multi-chain, Ethereum's multi-chain ecosystem. Basically, there will be the thesis is that Ethereum is eventually going to be the ultimate settlement layer, and on top of it, you will have these various constellations or various kind of chains who will be connecting directly back into Ethereum. And we have actually already announced or kind of delivered multiple of our solutions. We are, for example, our proof of stake and Plasma chain, which is like extremely adopted. We also launched the Polygon SDK, with which the developers can launch their own chains. We recently announced a data availability chain, which is going to be very crucial as the layer 2 rollups become more and more mainstream, and in order to reduce the transaction cost on those rollups, because they have to commit data back to Ethereum, which can be very costly. So data availability chain. Similarly, on the enterprise side, there is a lot of things going on, and one of our biggest bets, as a platform, would be on the zero knowledge technology, where we believe that in the next 2 to 3 months, the homework that we have done in the last 5 to 6 months, we will be one of the powerhouses of zero knowledge technology and research in the space. Essentially, if you want to think of Polygon, it's basically an aggregator for multiple scaling solutions. It can cater to various different kinds of decentralized execution demands for the developers. So that's about the technology and what we are building. And our journey has been pretty long, and we started in 2017, and we did our IEO on Binance on 2019, and then our mainnet was launched in 2020. And since then, there has been a huge wave of adoption. And some marquee investors like Mark Cuban and all that invested in Polygon. We recently announced the Polygon SDK, and Polygon Studios also was announced, which is specifically our division to focus on gaming and NFTs. And as you would already know, in terms of the Web3 gaming, many of the, unfortunately, we don't have Axie, but apart from Axie, like if you see the number 2, number 3, number 4, like many of those, in the top 10, you would see many of those applications use today Polygon as their home for their scalability needs. And we believe that this will keep going up, especially in the Web3 gaming. I'm pretty sure if you speak to 10 different games, a random set of 10 different games in the space, you will hear from, probably 6 or 7 that they are using Polygon for their scalability needs. And then in our Q4, we expect to launch Polygon Avail, full launch of Polygon Avail data availability chain. And apart from that, rollups and, standalone chains, like more secured and more, kind of robust versions of the standalone chains. Basically, the goal is to convert Ethereum into this multi-chain ecosystem, which caters to the needs of dApps and as well as settlement requirements. Some of these stats might be a bit older, and the markets have also, changed, but, we already have 500 plus dApps onboarded. And if I include the number of applications which are already building on the platform, it would go into probably now 4 digits, probably, north of 1,000, because there are just so many applications building on Polygon. The DeFi TVL, I had checked a few days back, it was like around $8.5 to $10 billion. And depending upon market conditions, it keeps going up and down. We have around 7 million plus transactions every day, which includes like many of the blue chip applications and all that. And many of them like Compound, Aave, and Aave, and many of the other protocols use, for example, Chainlink very heavily for their DeFi, protocols. And, we are seeing a large number of such applications. Recently, 0x protocol also announced their stats. They have done, I think, $1 billion plus in the transactions in the last 3, 4, or 4, 5, 6 weeks since they launched. We are fairly decentralized. I would say that in terms of Ethereum secondary layer solutions, Polygon is probably the most decentralized with 100 plus validators. And the market cap also, although is, keeps changing, we are around this one. And then, some of the stats you want to see, that, number of user wallets and, the transaction costs and everything. The key differentiators of Polygon is like basically, we focus very heavily on the user experience. And we are very long on Ethereum ecosystem. So we keep all our solutions very ETH compatible and interoperable. And then the main reason is that basically to provide these multiple scaling frameworks for the developers, which they can easily use for their solutions. And then, this is basically a snapshot of our ecosystem. I think like there is now an updated version of this, which is even more overwhelming. There's like just a huge number of applications and ecosystem providers. And we also, believe in, creating a production ready chain. So we take pride in having that. And, today, if you see in terms of the wallets, most of the wallets, support Polygon. Most of the tooling providers, for example, Infura, which provides the RPC for MetaMask. And, I think Ethereum is Polygon is the second chain after Ethereum, for which they are providing RPC solutions. Alchemy and, all the other big players in the space provide RPC solutions to Polygon. Similarly, on the on-ramp, like fiat on-ramp, almost all the top players have launched native on-ramps. And the biggest thing is like, also all the top tier exchanges, including Binance, Huobi, OKEX, and much more are coming in the future. They all have natively integrated Polygon mainnet. So you don't even need to exit to Ethereum. You can move your funds into exchanges and move in and out just via the Polygon mainnet itself. So these are some of the highlights from our side. And hope it was, informative for you guys for Polygon ecosystem. Yeah.
Thank you so much, Sandeep. Appreciate your time here. I have questions as always. So let me ask you one real quick while we have you. You mentioned native on-ramps, how many projects are building these already. Is that what you guys are seeing? What are you seeing more of? People coming from a bridge like Ethereum or onto some of these native on-ramps, or is it too early to tell really yet?
Yeah. So see, if you go by the traffic right now, of course, the larger traffic is via the main bridge, because that's where the massive amounts come in. But what the help of these on-ramp solutions is basically, especially for the gaming and NFT use cases, where the developers want to provide lucid experiences where the user doesn't even know. Like we always keep saying that one of our goals by providing this tooling is to make blockchain invisible. So on-ramps is a very important part in that, where as a user you are playing a game and you are swiping your card, you buy some NFT, you do purchases, play to earn, and those kind of things. You kind of earn more stuff, and then you have off-ramp where you can directly take your money off the platform, right? So I mean, those are the things, those are the user experiences we want to achieve with the level of tooling available on Polygon.
While I have you here, you mentioned multiple scaling options for developers, and you also mentioned composability. In your team's longer term vision, are those things that stack that developers will use multiple of, or is it like pick and choose one, or do you have a vision of that yet?
Yes. So we believe that all these scaling technologies are going to be commoditized, like you have, let's say, on AWS as a developer. When you go, you have various different kind of server technology, operating systems on which you can launch and build your applications. We believe that all these infrastructure technologies are going to be eventually commoditized. And what we are building is basically a one-stop shop for a decentralized shop in that sense for the developer, where developer can simply come and based on some parameters, he gets to know that, okay, this is the most appropriate platform for me, whether it can be a standalone chain or it can be a public chain which has integrations to exchanges and whatnot, and then he simply goes ahead and deploys that. The next level thing, which could be at least like a few years away, the next level thing could be where people are able to build these interfaces where developer simply comes and presents his code and all that, builds his code and simply says, okay, these are my parameters, deploy. And the developer doesn't even need to know where exactly the code is getting deployed, which solution is being used, as far as it fulfills their trade-offs. And that would be like the kind of the super cycle of a developer adoption. But I think that's pretty far away. But in the short run, yes, developers will be able to choose based on parameters which solution suits them most.
It's okay by me to talk a couple years out, because I got into crypto a couple years ago, and now the things that everyone was excited about, cross-chain compatibility, layer 2 solutions, those are real, and you can transact. You can bridge to Polygon, and you can track on, do transactions. So stuff does come to fruition. London upgrade just happened, so those things do happen, even if they take some time. Sandeep, thank you so much for coming and presenting this vision of Polygon and the Polygon ecosystem. When games go live on Polygon or any project, send them to me. I want to talk to them as well, so we can feature them on some YouTube channels and things as well. Thank you very much.
Thank you so much. Thank you so much for having me here.
Our pleasure. Everybody, we are going to take another short break as we prepare for a special presentation from Sergey Nazarov, co-founder of Chainlink. I'm sure you all are excited, so stick with us, listen to this fantastic intermission music. People are commenting on it and jamming, so put your headphones on and jam with me as we get ready for an upcoming session. We'll be right back. Welcome back. And thank you to all the presenters and panels that have gone previously at SmartCon 2021. But without further ado, it is my absolute pleasure to introduce co-founder of Chainlink, Sergey Nazarov, with a special guest.
Hi, everybody. Thank you for joining us. I'm thrilled to be joined by Jonathan Ehrenfeld, who's responsible for security strategies at Swift. Jonathan is, one of the most thoughtful people I know from the institutional finance world, and he's had a lot of background in both how securities infrastructure evolves over time and how, blockchains and other systems might be able to fit into that. So I'm truly thrilled that he can join us and share his genuinely insightful point of view. Thank you very much for speaking with me here at the conference, Jonathan.
Thanks for inviting me. I'm happy to be here.
Great. Thank you. My first question is, and this is one of the topics we discuss once in a while, and I'm sure everyone would be thrilled to hear your point of view as well, is how do you see global financial infrastructure evolving over the years to come? And what role do you think blockchains might possibly play in that evolution?
Right. So, Swift is sort of at the center of the financial industry, right? We do have conversations almost every day with big investment banks, asset managers, market infrastructures, and it's part of our role. It's also part of my role personally. And so we follow these trends sort of as quickly or rapidly as any big consulting firm. And so, but I will try to do some sort of personal opinion about it. So I think, first of all, financial services industry needs to catch up, right? If you think about how they work today, it's sort of, we continue to be in a hybrid mode where you have a big mixture of digital and very analog processes, right? So we haven't made the choice between digital or traditional assets. There's still paper-based assets. We haven't made the choice about automated or manual processes or workflows. So you cannot imagine the number of faxes that you continue to see in the financial industry. Even, I'm not talking about small firms, but about big firms. And then I don't think there's still a clear line between what are the things that today are done on premises versus the things that are done on the cloud. And those are things that some other industries that are as big or as important as financial services have made the choice to move to the cloud, to be fully digital and fully automated. It doesn't make sense that financial services continues to be in sort of that 50% of processes that are in one or the other. So that's one thing. The second, I do think that more than ever, asset managers and wealth managers and pension funds, everybody that is very close to people, because market infrastructures and custodians and brokers are not really serving people, right? They are serving corporates, they are serving institutional investors, or they are working for the asset managers. So I do think that is a big role for the asset managers, the pension funds that are actually working with the money of actual people. I would say that you have seen in the last few years a real focus on new customer demands, and those customer demands are, the same that you see in other industries. It's you need to be green, you need to be socially responsible, you need to have the right corporate governance, you need to invest in responsible innovation, et cetera, et cetera, et cetera. So I think banks, asset managers, pension funds, everybody in the industry will need to go and know their customers again, because we think we know our customers, but I don't think we do. And one of the big shifts that will happen is that a lot of the millennial generation, which I'm part of, and a lot of the generation that is coming afterwards, is going to inherit a lot of money from grandparents and from their parents. And these people, all of these millennials are not going to invest in the same products, are not going to invest their money in the same way that their parents or grandparents did. So if banks don't change that, and if the pension funds and asset managers don't change that, this is going to be a hard time for them. And I don't think it's just about just having an ESG fund and saying this is green. I do think it's going to be more than that. So that is something that will be nice to see. And the last thing is that there is the right combination of drivers today. There's enough regulation, there's enough cost pressure, there's enough technology, there's enough sort of digital models coming out, and that is going to accelerate the shift and the change for the industry to be better. And I think, we don't like to use a lot about the pandemic because it's just 1 year or a year and a half, but the volumes that we have seen in our network and the volumes that our customers have been able to cope just shows that, this is not going down, and this industry is still there to stay for a long time.
Makes sense. Go ahead.
Yeah. No, the second part of your question was how do you see blockchains playing a role in this system? Which, for me, it's not the role that blockchain will play. I think it's everything around blockchain, right? Blockchain is one technology, and as one technology, you can compare it to any other technology that has come into place. I think it's everything around it. There are elements that are blockchain based or that are part of the blockchain environment, which are truthfully interesting for us, right? One is the fact that assets could be digitalized, and we can talk about it later about what does that mean. Smart contracts, it's so basic but so important that in the past we used to have future or options that were not programmable. With smart contracts, just be able to define prices, to define conditions based on anything that you want, and define it in such a standardized and simple way. And then the fact that you can also have programmable money or cryptocurrencies, that those three things are smart contracts, digital assets, and cryptocurrencies, which are part of the whole blockchain hype, will probably have unprecedented impact into the industry. And we can discuss further, but I do think it's not blockchain itself, but everything around it.
Right. So when you say everything around it, I think you mean all the value and utility people get from what they can do on a blockchain, right? Like all the outcomes they can get from it.
Yeah. Yeah. And again, I think if you break down blockchains as being, all right, there is a smart contract component, there is a digital asset component, and there is the cryptocurrency component, those three things are more important in combination or independently than that blockchain as a whole.
Got it. Yeah, I agree with you. I think it's not just a matter of here's a blockchain and it holds some kind of state on chain and that's great and that's it, we're done.
Yeah,
I think
exactly.
You're absolutely right that it has to create a smart contract, it has to create a real world settlement, it has to create some kind of valuable transaction in ways that wouldn't be possible before. So I completely agree with you.
Yeah. And on my side, now that we're talking about blockchain, right? And this is something you and I we have discussed many times in the past, but blockchain is going to use many new technologies and new infrastructures, but how do you see like existing infrastructure, right? Any infrastructure that exists today or that has been there for a while, how do you see that interfacing with blockchain today?
Yeah, so I think that my point of view on this for many, many years now, I think for over 4 or 5 years now, has really been that you already have PKI systems, private key signing systems. You already have messaging standards. You already have a lot of interfaces that people have built within banks. Those interfaces then flow up into other user-focused applications. You have a lot of infrastructure that can essentially send digital commands, right? So if they're not cryptographically signed commands that could be input into a blockchain, that's their only real limitation, right? You can still define a lot of interactions digitally. And so that level of digital interaction is something that already exists and is something that a lot of people are trained on. And there's a lot of systems like Swift that already enable that very well. And so my point of view has always been that you should use the systems today that work well for what they do well. And then you should allow the additional properties of blockchains and smart contracts and oracles to be added to that. Because what you're really trying to do is create a stack with focused components. And if a part of that stack already exists and can already sign messages using some kind of PKI or some kind of messaging system or standard like Swift's messaging system and standard, then that's fine, right? That's not the necessarily the innovation of blockchains or the innovation of smart contracts. The innovation of blockchains and smart contracts is these cryptographically guaranteed agreements, these cryptographically guaranteed state changes to settle transactions and move value and control all of these critical things in a transparent way. But the actual ability to send a command to those systems can absolutely come from a digital system, right? So it can come from a system that already has some kind of HSM infrastructure to hold private keys, some kind of PKI scheme to sign transactions and put them into a system that can possibly reformat them into many different blockchain transaction types. And this direction to me just seems like the most efficient direction, because you already have a very large part of the world that uses these standards, uses this PKI, uses this private key signing infrastructure. And if we as a community, as the blockchain community, really want to see blockchains and smart contracts adopted as the state storage and contractual mechanism, then we want as many systems as possible influencing that and being able to interface and enact those types of systems, right? To enact the useful aspects of smart contracts, for settlement, for transactions, for whatever they can be used for, global trade or securities or whatever topics.
Yeah.
And yeah, so my point of view is that the existing infrastructure can absolutely and should absolutely be used using the existing PKI and the existing messaging standard of systems like SWIFT.
Yeah. Yeah, I mean, not everybody is sort of on the industry that we all are, and all the fintech companies has realized that, right? That the fact of using existing infrastructure and very old technology like PKI that you were mentioning, just messaging, it's not about just starting from scratch and building on top of a white paper. You need to build on something that already exists, and the fact that PKI certificates and a messaging network is used by, I think today we're more about 12,000 users today. It's not something that you will be able to achieve just by starting with a blank sheet of paper.
Yeah, I completely agree. And Jonathan, when you say 12,000 users, I've always understood that's 12,000 actual banks. So that's the vast majority of the world's banks. So
it is
right, and each of those banks then represents hundreds of thousands or millions of individual users, and that's really the user base that on the front end is using SWIFT through the back end relationships that the banks have. So I really don't see that the interfacing or the messaging standard for digital commands or the ability to have a PKI that signs transactions securely through an HSM or some other private key secure storage model is what needs to be innovated here. It can definitely be innovated on. It can definitely be improved. There's multi-sig. There's a number of great security properties that you can get from improving PKI and increasing its security, which I know you guys are always thinking about in great detail. But the reality is that isn't the innovation of blockchains, right? The innovation of blockchains is all those useful outcomes you described. And I think if we're able to, I think really if we as an industry are able to interface with all the useful systems out in the world, we can actually make blockchains and smart contracts useful for everybody much, much faster.
Correct.
Because the fundamental goal, once again, isn't reinventing the user interface that the user interface isn't going to change. It's going to be on the web. It's going to be a website. It's going to be a bank middle office application that sends a digital command, through some message routing, probably using Swift Alliance access to trigger something somewhere, right? Those things don't necessarily need to change. The thing that needs to change is where that goes and where that ends up as a final state and as a transparent way to settle and as a transparent way to do global trade and all these other things. So I think there's just this kind of idea that somehow there's all of these goals, just reinvent everything. I think if you have a very focused goal and you want to reinvent how the system works on the back end, then the interfaces that can plug into that back end and allow it to be more adopted more quickly is actually a huge accelerant for its adoption, right? And that's always how I've intuitively viewed this. So from your point of view, Jonathan, how do you see DeFi, decentralized finance, evolving to become included in the global financial system? And what do you think needs to happen for DeFi to become included in that global financial system?
Yeah, it's an interesting question, right? Because I think in the end, much of that depends on who finds DeFi useful and why they find it useful, right? I think many people believe that any DeFi project, it's going to draw a lot of users, right? And that means that, any application makes financial services a little bit more inclusive, a little bit more democratic for more people to have access to such platforms, and think about what Robinhood did a few months ago. So I think in that sense, that idea of democratization rather than decentralization, it's probably where the success of DeFi will come from. What is interesting about DeFi too is that sort of when we're talking about blockchain is that DeFi sort of expands the usage of a blockchain beyond just the transfer of value, right? And a lot of the applications that are being built on DeFi today are touching, core parts of the securities industry or the financial industry, like loans, insurance, or parts that are derivatives, or parts that are more retail oriented, like, crowdfunding, betting technologies, etc., which in most cases use like a central control power, and this decentralization sort of changes the game. And one of the things that will take, of course, in my opinion, for this to be accelerated and to be adopted and to be integrated into the full ecosystem, I think one thing would be for the regulator to sort of, put some sort of canvas to it. And I think that has happened already, at least in the US. So you have the SEC recently has approved a few DeFi companies or environments to work. I think the latest one was Arca, which is an Ethereum-based technology that was approved by the SEC. So it's a fund in the end, and Arca is fully based on DeFi. The second thing is it's how asset managers are going to use it, because coming back to my point that I was making before, for me, asset managers are the main actors of the industry, right? They are the ones driving how things change. They are the ultimate customer of the big banks. And so they are an important piece of the puzzle. And if they start to take DeFi seriously, that is going to change the game. And I think the most prominent recent case on DeFi being adopted by asset management is the foundation of Grayscale, which I think it's now sort of the largest crypto fund, right? And I think that's an interesting. Now, one thing that I would say that DeFi needs to do, and it's probably not DeFi as a whole, but I think everybody that is writing blogs or talking about DeFi in conferences and articles and papers, etc., is this idea of trying to cut the middleman. Every time you come with the idea that let's get rid of banks, let's get rid of greedy corporates, and let's just cut the middleman and make the middleman disappear. That's not the primary advantage of DeFi. And to be honest, I mean, if you cut the middleman, another middleman will come. So I don't think that should be the pitch. The pitch should not be about cutting that sort of big bad wolf. It should be about what are the advantages that DeFi have, more on the democratization side, the access for everybody, and to be able to participate in the industry, which is not inclusive today, but trying to get rid of banks or trying to get rid of central infrastructures just for the sake of it, I don't think it's going to be the pitch that will save them.
Yeah, when I look at this, go ahead.
No, that was it.
When I look at this, I really see a number of existing institutions, whether those are banks or asset managers or fintechs, that have a user base, right? And they basically have a user base that they have so far been curating assets for and catering to well in the current kind of digital securities environment, right? And what I think is very natural, and I think has already started to actually happen through PayPal offering the purchase of cryptocurrency. I think really that's the thing that kicked a lot of this off and made a lot of people kind of stand up and go, well, if something of that size starts to offer this as a key piece of real estate on their interface, then there must be some kind of future here. And so I don't necessarily think that every single middleman and every single participant in the current global financial system is just going to, poof and disappear and just become obsolete and irrelevant. I think all of these, fintechs and banks and all of these and the digital banks that are coming out now because the hurdles to making a bank are getting less and less and less. I think all of those market participants really just have a new market to go after. And the ones that go after that market successfully will see the benefits of going after that market successfully. And that's really just the simple way to look at it, right? If I already have a fintech application, if I already have a bank relationship and that bank offers me access to internet banking 20 years ago or 10 years ago, then I stay with that bank because they have internet banking. And if it doesn't offer me internet banking and I need internet banking to pay my bill or do whatever I need to do, then I stop using that bank, right? And that's just kind of the simple reality that I think is going to be much more fundamental than, are you a bad middleman? Are you a good middleman? I think fundamentally capitalism just forces people to adapt, and it's going to force the large institutions, the asset managers, the digital banks, the fintechs, everybody who wants to own a user relationship, it's going to force them to adapt to all this. And I think that adaptation will actually come in two forms. It'll come in the form of them needing to interface with all of these systems. So they're going to need to interface. And in the more advanced institutions, in the larger places that already have an existing infrastructure, they are going to want to do that through their existing systems. So I think at the end of the day, it's about the fundamental value of our industry and the demand that generates from consumers, and then the banks and the fintechs and everyone else in the global financial system that gets behind that and provides an interface into all of that value for their users. Then their users will stay with them, and they'll go into their next chapter of growth. And the people who ignore it, I mean, it'll be akin to ignoring the internet, right? It'll be very similar to saying, hey, the internet isn't going to happen. We don't need to worry about the internet, right? Which obviously isn't, in retrospect, is obviously a ridiculous decision. But there were very clear periods of time where those were very serious discussions by banks and others that like the internet. Hey, not a big deal. We can ignore it. So I think it's a very clear analog to that.
Yeah. I mean, in the end, there has been, even before blockchain or DeFi, there were big initiatives in the market that were not driven by technology. They were driven by regulation or by efficiency. I mean, one of the good old ones, T2S in Europe, when T2S was actually launched in Europe, this huge settlement engine that actually settles securities across any European country, everybody was talking about disintermediation, and custodians will disappear and sub-custodians will become irrelevant, because then a German investor can go immediately into a French CSD, and why the hell would they use a sub-custodian? And nobody has disappeared, right? Everybody has adapted. Everybody has changed their models. Some people have lose some things that they used to make money out of it. A lot of these lucrative inefficiencies, and that's a good point too, is that if you're making money out of an inefficiency, that's something that will disappear. Whether it's because of technology, regulation, or customer expectations, you're not going to be able to make money out of failure or exceptions or stuff like that. Those things will probably disappear with technology. But for the rest, everybody will readapt, as you said. I mean, it's just a logical evolution of the banking system. But you and I have worked many times in this type, and we have had many discussions. I remember, I mean, you were just a few people in your company before the first time you collaborated with Swift, and throughout the years we have had many projects together. You have been part of the Inner Tribe sort of alumni, which is our innovation hub. You have presented in front of our board, which is 25 directors from the biggest banks in the world, and they have been impressed about what you guys have been doing with smart contracts and with ChainLink and everything else. But I was always wanted to ask you the question of what attracted you to work with Swift, right? Because it's not every fintech company is wants to work with Swift or with the sort of the incumbents. But so, what do you think that we bring? Is it the member-owned model we were talking about before? Is it something else? So, what exactly did attracted you to work with us?
Yeah. So my thinking about Swift was always that it's something that powers a lot of the world's transactions and value, and that there has to be a number of reasons for that. It's not just a coincidence that something like this continues to exist and be critical to the global financial system since the 70s. So I don't know if a lot of people fully understand, the history of Swift or the value it's played or how it's been able to continue playing its role in the global financial system. Now my view obviously isn't as educated or informed as other people's at Swift or at other places that know the fuller history. But as I understand it, I think there are fundamentally, three things. I think the first thing is that Swift created a lot of efficiency, basically taking the world from something called telex machines and something like faxes and this paper-based model. So Swift was really at the cutting edge of digitizing the movement of information about value, back in the 70s. So there really isn't an organization with more experience around digitizing value than Swift, in that it was doing that before the internet was even a realistic construct that people could rely on to send low value, unencrypted, plain text messages about their cat or their dog or their vacation or whatever. So Swift in that sense has a long history of experience. The second thing is that Swift is fundamentally a kind of standard, which I found fascinating when I actually understood it more. That Swift isn't necessarily just its own proprietary technology. It's actually a standard that people can use globally. So it's a global standard for how to message about transactions and define the role of different financial systems with each other. Now, once again, I'd never really believed that is what needs to be reinvented. So I don't think we need to reinvent how we message commands or the private key infrastructure, which I also knew Swift basically had the largest institutional public key, private key infrastructure for signing transactions, signing something to the order of, quadrillions of dollars in value, right? So these types of systems that sign quadrillions of dollars in value over the last 50 years, they have something that is right about them, right? There's something about their security model. There's something about their PKI. There's something about how they work that has some kind of value. And once again, I don't really understand why we would not use that part of the stack as essentially a signature layer and a messaging layer to issue commands into blockchains, right? So it's completely unclear to me why we would say, hey, let's get rid of this private key infrastructure. Let's not use it for whatever reason. People already have it. It already secures large amounts of value. It already secures very high value transactions on a regular basis. It already has a messaging standard to which you can add a new message type about blockchains. The only piece of the puzzle, in my opinion, that's missing is the ability to efficiently interface with multiple chains, because that is what's going to need to happen for all of the different kind of environments that the 12,000 member banks want to work in to be done efficiently, right? So if we want all of the member banks that have Swift PKI and Swift messaging standards directing how their systems operate today, suddenly interfacing with multiple chains, they already have the PKI, they already have a messaging standard, they can add some new message types to. I think what I always thought, even from the beginning, was how can we possibly make this infrastructure used for interfacing with blockchains? And I think what that will result in is actually a massive influx of value and liquidity into all of these different blockchains that do become integrated into bank systems. Because once again, I don't think the problem to solve here is the private key signing, HSM security of private keys problem. I think there's a sufficiently robust infrastructure that can be expanded with multi-sig schemes and other schemes that are more attractive to blockchains. And even a lot of the multi-sig providers out there, I know they use existing hardware and existing, SOC 2 and other standards for securing their systems, right? So even the multi-sig providers are using certain existing hardware, existing processes, right? That isn't what we need to reinvent. What we need to do is take all the world's value that is controlled by systems powered in those ways, with private key infrastructure and HSMs and all that infrastructure, and we need to accelerate the speed at which it can interface with DeFi, with decentralized insurance, with decentralized global trade, with all of these applications. And in my opinion, once that integration happens, and once banks, insurance companies, global trade companies, and everyone else can interface with the various on-chain contracts, that's when the amount of value accessible and placed in those contracts will go from billions to trillions pretty rapidly. That just really seems like a very logical path. And so from the beginning, my question was always, how can I work with the existing infrastructure to funnel its value into these blockchain smart contract systems in order to make them more useful for society quicker? Because that value is in those systems, and the speed at which we can get it into the blockchains and smart contracts is the speed at which those will become valuable and useful by whatever path we might take. And this is probably the quickest, most efficient path to just let people with existing systems use that. The final thing that I realized in the process of working with Swift, is firstly that everyone at Swift is actually a really nice person. You guys are in Belgium, right? You're really nice people. You're pretty relaxed. I actually always had a great time working with everybody at Swift to begin with. I'm a big fan of Belgium, big fan of a lot of the people at Swift that aren't in Belgium also, but it's just a very relaxed kind of nice group of people. It's not some kind of very very aggressive banking type of organization. So that's the first thing that I found very positive. And I always really enjoyed about working with you guys, and also how collaborative everybody is. And then the final thing that I realized, mainly a few months into working with you guys, was that you're member owned. And so what I think many people don't understand about why Swift has existed for 50 years, why it has moved quadrillions of dollars in value every year for decades, it's because it's actually, very similar to a DAO. It's very similar to a member. It is a member-owned cooperative. So if you actually looked at the governance structure of Swift, it's not some complete for-profit private entity that somehow creates a monopolistic advantage for any one bank or any one group. It's completely member-owned. The directors, the board of governors, whatever sets of different processes and layers of processes they're actually directed by the Swift member banks in proportion to their usage of Swift. So the degree to which a bank uses Swift actually resets their ability to direct Swift. And so there isn't even a set committee of member governors or member kind of people directing the organization, in that it purposefully adapts to usership, which really in my view is quite similar to the DAO and proof of stake and other models, where the degree to which you use a system is the degree to which you should be able to have sway over how it evolves. And the fascinating thing is that Swift has been operating this way for over 50 years and has been able to insulate itself from competition to a certain degree because of this, because all the member banks know that they aren't going to put some kind of monopolistic company in between them and their counterparty that then is going to eventually become a monopoly rent-seeking technology provider. Because as I understand it, Swift even returns fees back to its members if those fees surpass a certain threshold, so that the members are never having monopoly rent extracted from them. And so that's a fascinating model, because it's actually the model that a lot of DAOs and a lot of organizations in our industry aspire to arrive at. the organizations in the DeFi industry and in the blockchain industry want to arrive at a governance model where, decision making is decentralized across all interested parties. Decision making can change based on people's interest in the network, and Swift's ability to change its member voting based on transactional usage is exactly that. And it's been working for decades. So realistically, when I saw how the people at Swift operate and when I understood the member-owned model of Swift, and that it wasn't just, the standard for-profit monopoly rent-seeking organization, it became clear to me that, this is the type of thing that realistically should and can continue to just own the PKI and the interfacing into all of these systems, because the members of it want to use it because they have the type of relationship with it that DeFi and other blockchain systems aspire to have with their user base. And I think this thing has never really been that clear to people in our industry. And when I understood it, it was kind of eye-opening for me. So between those two first things and the third one about being member-owned, those are the things that have led me to kind of actively pursue a working relationship with Swift to the degree that I can, because I just see all of these clear benefits, both to what the technology does and the infrastructure that already exists, and to how the organization operates and how it relates to its members.
Yeah, and people underestimate sometimes also the power of that standards piece that you were mentioning before, or they relate it too much to the messaging side, which usually sounds a little bit old. I think one of the first or second POCs that we did together with you back in 2017 was the fact that we show how the same messaging standard, which is ISO 20022, that it's used today to just write messages in XML, can actually afterwards be used to write a smart contract. Today, we probably have billions of APIs that are reading today or circulating in our network that are also reading in ISO 20022. So you can take everything that you said, you can take the messaging component out of it, and it still work, right? You just need a medium of communication. It could be a smart contract, it could be an API, it could be a message, it could just be different nodes communicating with each other. And that standard, which is open source, it's often underestimated, and it will have huge benefits if people start using it more. But great explanation about Swift. It's even better than I think everybody within Swift could have done. So thanks for that.
Yeah, of course. I think it makes a lot of sense, and I think at the end of the day that people who make open source standards, people who create member-owned systems, people who have a PKI that has all this value already successfully secured, that's a useful, valuable system, right? There's every reason why the blockchain industry and the smart contract industry should be able to benefit by getting all of that value efficiently transitioned onto multiple chains, right? By basically connecting that PKI, that messaging system, that messaging standard to hundreds of different chains, and then overnight almost you will see banks, insurance companies being able to transact with a multitude of different chains, and the amounts of values that they'll be able to transact will be in orders of magnitude higher than what we see from other applications. Not to say that they won't be useful. I actually think that interfacing, using that standard and using that PKI will accelerate the amount of value that can flow from institutions and enterprises into DeFi, into decentralized insurance, into the protocols that are being built in the public blockchain world today. So it's really a win-win for everybody. It's a win for the enterprises and the institutions in terms of their ability to interface with this technology, and it's a win for the blockchain applications because they suddenly have immediate access to a massive user base, as long as there's a way, maybe through something like ChainLink or some kind of system that enables the interface to all the different smart contracts and blockchains out there from this existing world. And so that's the body of work that we're working on and excited to be pursuing very, very actively. Once again, Jonathan, it's been a real pleasure to chat with you again and to get your feedback on all this. I really appreciate your thoughtful and insightful point of view on how the financial institutional world and the enterprise world will eventually be interfacing with the blockchain world in meaningful and important ways. And I think you're right. I don't think it'll be getting rid of everybody. I think it'll be a question of who is able to adapt and provide their user base with access to this new type of experience, these new types of systems. That's that's really what innovation and improvement is all about in the financial industry as well as in every other industry. So I'm thrilled that we had a chance to chat through all this. I think your point of view makes a lot of sense. And I'm very grateful that you took the time to speak with us about it here. Thank you very much.
Of course, thanks for the invite. Always a pleasure to talk to you, Sergey.
Thank you.
Well, thank you, Jonathan, and thank you, Sergey, for that fantastic discussion. Awesome to see that connection and discussion happening. We're going to take a brief break again with our nice beats on our rotating cube screen. So stick with us. We'll be right back in a few minutes with Stani from Aave. Welcome back, SmartCon number 1, 2021. Glad to have everybody here. We just heard Jonathan and Sergey, Sergey from Chainlink and Jonathan from Swift having a conversation. Next, we're going to be speaking with Stanny from Aave. Stanny's going to give a brief keynote, and then we're going to move into a panel session. So stick around for these two interconnected events. Looking forward to both of them. But right now, Stanny Kulichov from Aave.
Hey everyone, welcome to my talk today. So today we're going to give a presentation about cross-chain Aave protocol, and the idea is to kind of like give briefly introduction on what Aave is as a protocol, as a community-owned protocol, and also how does the protocol work in terms of like cross-chain functionality, and what kind of interesting things this cross-chain ability brings, and how it actually empowers the whole ecosystem, and also kind of like how Chainlink plays in role what we are as a community constantly building. Yeah, so those who probably you all know, many you might, and many you might be newcomers into the Web3 space. So Aave is a decentralized liquidity protocol that is currently the biggest one in decentralized finance. And what it means is that as a liquidity protocol, you can deposit and supply funds into the protocol and then draw liquidity against your funds that are being there as a collateral. And it's a way to create a yield market on chain that then other developers can actually build different kinds of protocols and products on top. And that's how the Aave liquidity itself comes to the protocol. So Aave is very developer-friendly protocol. And because of the reason that we've been building a developer-friendly protocol, it has grown quite substantially over this year and last year. And currently, it's the biggest DeFi protocol out there, and quite substantially important Web3 kind of like a piece of component in this space. And recently, we have included also not just the Ethereum market that we have, where the protocol has been deployed on Ethereum, but also in other markets, such as now as first is the Polygon. And we will, during this talk, kind of like assess how do you evolve something that has been deployed in one particular blockchain and governed there, and how do you actually can expand your community across multiple networks, and how does the Aave community solve these challenges. So essentially how the protocol works is that you supply assets into the protocol, and then as you supply and generate yield, that particular deposit becomes essentially also a form of a collateral, which allows you to draw other kind of assets from the protocol as well. And you can, of course, delegate that kind of like a drawing power to someone else, so someone else can actually draw on behalf of you and create this kind of like a trust network as well with this credit delegation feature, which is something that we are currently experimenting, and hoping that more developers get interested in that feature, and building more trust-based DeFi applications on top of this feature. And also there's a component of liquidators also as market participants in the protocol, who are the liquidator network is decentralized, the same as the supplier participants and the borrowers as well, which means that liquidators are running autonomously and competing to liquidate unhealthy collateral positions within the protocol, and that way keeping the protocol healthy. And this has been very resilient way to keep collateralization and position management across DeFi, especially when assets are volatile. We've seen the Black Thursday a year ago, and now during last May, when the asset prices decreased substantially, which caused a lot of liquidations, and the Aave protocol has been very resilient towards that. So it's interesting to see, mainly because there's so much liquidity and because of automated market makers and flash loans that kept the DeFi protocols solvent during fluctuations. So this is the base concept, and of course, most important part, especially to me, is that Aave protocol is owned by the community and its users. So what this means is that the team has originally deployed the protocol and built it, but now anyone, any part of the world can actually contribute and do contribute on continuing building the protocol and improving it. And at the same time, when you have some kind of like changes, whether it's new builds or new features, all of this, or risk parameter changes, all of this has to go through a decentralized governance, meaning that the original team or any other development team can't arbitrarily change the protocol, and it has to go to the governance process where the token holders come together and vote on matters that are important to them, either for or against. And of course, what's fascinating is that this decision-making power can be also delegated, either the proposition power to put proposals on chain, or voting power to other participants. And we've seen for the past year that a lot of universities have become very active in DeFi governance, and it's fascinating to see this kind of movement where stakeholders are delegating their proposition power to protocol politicians, universities, and other entities. And this is kind of a very, very good direction. And of course, the Aave protocol has so-called safety module where you can deposit the Aave tokens, and then against incentives, you are pretty much backstopping the potential risk of the protocol, such as if there's some sort of a failed liquidation or some sort of smart contract vulnerability. The protocol itself has been audited by 5 different auditors and formally verified. So it's been working for quite a long time. But in case there is something, there's this safety module as a backstop mechanism. So this is how essentially the whole protocol governance and the backstopping works. And the Aave version 2, which was deployed last year, December, the market itself has been growing very much as the whole DeFi ecosystem. So we see where we are at the gross value locked in the protocol. This means how much of the value of those deposits are and supplying is in the smart contracts, and what is the amount of borrowing from the protocol against those collateral assets is happening. And especially for the past year, DeFi has grown substantially, and Aave, of course, has been growing as DeFi is growing, but also because of the fact that the protocol has wide range of different assets that are listed. But compared to other protocols, the asset parameters are very conservative. So there's specifically the governance votes on how much you can actually draw liquidity against which kind of an asset, depending on their risk profiles. So that's the kind of like a key metrics on the main market. And we deployed with the community in a market in Polygon, and Polygon essentially is proof of stake sidechain, which has EVM, which is Ethereum virtual machine, kind of mimics the same functionality what Ethereum itself has, meaning that you can run the same smart contracts there, pretty much with the same configurations, but just different network settings. And that has the easiness of deploying to Polygon has been kind of like also driver, not just for Aave, but the whole DeFi community to experiment there and try try kind of like grow their user base in Polygon network. And Polygon is interesting because of the proof of stake. The transaction costs are fractional compared to what we have on Ethereum main network. And I think the takeaway about that being a cross-chain protocol is that by tapping out different kinds of communities, especially in Polygon where the transaction fees are low, you reach out to a wider audience. And we have in the protocol currently 72,000 or so active users, and in the Polygon market over 140,000. So this is just showcases like the amount of users when the transaction fees are lower. And interestingly, more liquidity is in the layer 1. So it's kind of like a way to create more inclusiveness as well when you deploy to another network where you have less transaction fees. And this is kind of like a been very good approach for Aave to be cross-chain, and has also urged other protocols to do the same. And we can compare, for example, the numbers I showed previously on the layer 1 and layer 2. But the key component is that deposit amounts are actually smaller compared to what we have in layer 1, but way more users. And this is also interesting because in the future, when you govern the market, you somehow need to include those smaller kind of like a transactioning sizes and users that are participating in governance also be able to vote on the Polygon market with low gas fees. And we have been researching quite a lot on the fact like where, as a cross-chain protocol, where the community would like to move next to. And pretty much the sentiments, what we have been reading is that there's sort of interested in a few of different kinds of chains. For example, there is Avalanche that actually has very fascinating consensus mechanism, but it's EVM compatible. There is proof of stake like Polygon, and other examples is Optimism, which is L2, which means that you're using the kind of like Ethereum security, but you're transactioning on a separate layer and then rolling up the transactions back to the main network and using that security where you lower transaction fees. Whereas if you go back and look at the Avalanche, for example, it's a completely separate chain with its own kind of fundamentals. And then we have example Arbitrum, which works similarly as optimistic rollups, but it has EVM, which means that it's easier to deploy there from technical perspective. And there's of course other solutions, sidechains such as Solana Neon and the ability to have EVM there as well. And I guess like most importantly, what it boils down in terms of like being cross-chain protocol is that security is very important. And when you have to build things from scratch, that means that you kind of like need to rethink on the security aspect of the protocol itself and how that will affect the deployments. Because building something like Aave protocol is very cost heavy, not because of the reason that it takes time to develop the actual code base, but because you have to put a lot of effort in the due diligence. And EVM compatible chains that's the reason they're easier to deploy for the Aave protocol. And of course, cross-chain governance. So that's important. So if there is a Polygon market, how the governance can be, how those markets can be governed with a way where you participate as a token holder and governance member. And this is something we've been researching and finding solutions on how we will be able to actually create mechanism of governance where you can vote on the layer 1 on decisions on Polygon market, or let's say Arbitrum or Avalanche, and then we propagate those results into those particular markets via governance bridging. This is something we're going to release in soon and discuss a bit more once we understand more about the rest of the structure that what we're doing in the cross-chain governance. yeah, of course, other things are the gas costs. I mean, voting is still too expensive, and this is something where we're looking into optimistic voting, where voting is off chain, but then someone takes the vote and puts that actual result on chain. Essentially, that's something we're looking kind of like to make the governance more inclusive. Thank you everyone for listening, and I want to thank Nicolo from the Aave team as well on helping these slides, and I hope you all have a very good time during this conference, and there's sort of interesting talks going on. Thank you so much.
Well, Stanley, don't go anywhere. I'm going to have you back on. Thank you very much for the presentation. Some great information in there. Excited to see Aave on everything. I am, at least. Now we've got Stanley back to have a conversation with Sheila Warren from the World Economic Forum, moderated by Zach Seward. Come on up.
Love the space vibes of those tunes. Very nice. Welcome, welcome. We're going to chat about things. Soliciting some questions from the chat, so I'm going to get straight to it. Stanley, thank you very much. That was a really informative keynote. Cross-chain future for Aave, certainly very hype. Sheila, we're going to talk to you as well. Let me get some answers, Stanley. I'm going to ask some questions from the chat. Just kind of take it in order, sort of. All right. So first of all, you mentioned sort of this cross-chain future. I guess let's go from the general to the complex. I'm going to start from some of the general questions that we got from the chat from viewers who are watching the keynote. First one, I think, is actually a good, simple question. How is Aave different from Compound in your view, Stanley?
Yeah, I guess it's not just a question related to how Aave is different from something very close to what we have, but also like the other DeFi protocols that might kind of like serve a different kinds of functioning, because there's always differences in terms of features. I mean, feature-wise, Aave has collateral swaps in the protocol, flash loans integrated as well, and we have a kind of like a different way of calculating yields, and also there's the stable borrowing rate as well instead of like only variable rate. But like I guess like for all of the DeFi protocols, essentially what they are communities that are assessing and selling risk to their kind of like risk and reward to their users. For example, the Aave community has a different kind of I would say risk assessment framework, and also like way to manage risk compared to, for example, the Compound or MakerDAO's model or any other protocol that is in DeFi. And that means essentially that the community comes together and votes on risk parameters on, let's say, what kind of asset could be listed, what kind of risk there could be, and that's essentially what differentiates every protocol from each other. And in terms of like Aave protocol, it has quite conservative risk parameters, so you can't draw liquidity against your collateral that high. You don't get that much of collateral out of the protocol. But at the same time, the community lists quite wide repertoire of new assets into the protocol. So that's the kind of like a difference, in my opinion, across DeFi.
Okay, cool. So I'm hearing a little bit about the onboarding process for new tokens. So I'm going to skip that question. Good question, Matthew B. Thank you very much. One question I did want to ask, you talked about sort of this multi-chain future and this idea of Aave everywhere, which is really interesting. What's your view of the Polkadot ecosystem at this point in time?
It's very interesting. Since I kind of like saw Polkadot first time and started reading and getting myself introduced on what they're building, there's so many components there. Like pretty much, of course, like what fascinates me is the ability to kind of like use like the main network and secure parachains, and you can spin up a parachain and kind of like have decentralization there to any kind of like extent is very fascinating, and what we are at Aave also kind of like researching, but also the ability to use different languages and then which is compiled into assembly and WebAssembly from technical perspective. That's very fascinating to us. I think the ecosystem isn't fully ripe yet, but I think once it's very ripe, I think it will be very interesting to the whole Aave community to deploy there's something, or maybe there could be even like another party in the Aave community that could just focus on actually Polkadot, because it's a ecosystem that definitely will be thriving in the future. That's very interesting.
Definitely, yeah, definitely early days there for sure. All right, couple more questions, and then we'll get to the Zach and Sheila questions. All right, I got to ask this one from Chainlink God, Twitter legend Chainlink God. He wants to know, how important is Chainlink price feeds and Chainlink keepers to the future of Aave?
Yeah, I mean, increasingly important. So every second that the more value that our protocol captures, not just on Ethereum layer 1, but for example in Polygon and elsewhere where Chainlink price feeds are used, and they're used pretty much everywhere where Aave is. That would be kind of like I would say even like a gate into data for the protocol itself and the whole DeFi ecosystem. And it also showcases like how not just like valuable the Chainlink is for Aave and rest of the DeFi, but how important and responsible role it's playing, and kind of like how important it is that as a DeFi community and Chainlink community is looking towards like not just kind of like a brainstorming the future of these price feeds, but also how all this risk management and everything is improved in the future because of the importance of Chainlink. So it pretty much touches all the assets that we have in the protocols. It's critical infrastructure, and that is something where we need to put more and more focus over time.
Gotcha. All right. Well, thank you for answering those questions from the chat. I want to zoom out a little bit because I think there's a lot of really interesting material that we can cover here. You mentioned, DeFi by some metrics is a $70 billion subsector of the crypto economy. Aave, obviously the leading platform at present. I want to talk about DeFi's next chapter. And I think we're hearing a lot about institutional DeFi in the market these days. You have an institutional product that you've been working on. I think it's called Aave Arc now. Are there any updates as to when that is going to ship?
Yeah, Aave Arc is fascinating product. So as currently the Aave market, of course, it's deployed. The protocol is deployed in Ethereum, Polygon, and we're looking into other networks. But also within Ethereum, we're experimenting with the Aave Arc part of the protocol, which is essentially a separate private market on top of Ethereum, which means that there's a whitelister in the market that can be in the multiple whitelister in the future, which the Aave governance chooses. And this whitelister can then whitelist and backlist suppliers, borrowers, and liquidators within the protocol, meaning that you can create completely new market with additional requirements. And with the Arc market, actually, you can deploy them multiple, depending on what kind of requirements you want to have. But also, the first one is based on kind of like a compliance requirements that the whitelister wants to uphold for the users, meaning that essentially you can create a market that just has higher compliance requirements, meaning it's more institutional friendly, meaning that the institutions that otherwise have difficulties in participating in the kind of like permissionless DeFi, they can try the Aave Arc market and kind of like get used to the smart contract execution, have the same transparency that Ethereum as a public blockchain ledger provides, meaning that every transaction is auditable, seen every single second, every single block. And also you have, instead of paper transactioning, you have smart contract execution, so you can trust that the smart contracts executes as they're built. And also risk parameters set by the Aave governance. So essentially, it provides pretty much like a soft launch for institutions to use DeFi where they have higher risk appetite. But also it allows to spin up a new Aave Arc market for some other particular reason. Might not be compliance, but maybe you want to create a private market with some particular assets that are not listed in the main market and are special for some particular reason. So it's a very fascinating product.
Yeah, I definitely want to talk more about sort of these parallel tracks of DeFi in a second. I'm certainly guilty of this. I often talk about institutions as this monolithic sort of faceless mass. When we talk about institutions in the context of Aave Arc, who are we talking about? Who's going to be the first institution that really gets its hands dirty on these DeFi protocols? Who are you? When you say institutions, vaguely, like who are you referring to?
Yeah, the concept of institution is very, very wide, right? So as you know, Zach, and I think like for us in the first Aave Arc market, there's going to be Fireblocks, Galaxy Digital, and a few other Fireblock clients. So it's going to be starting very small in the beginning, just to kind of like build up the liquidity. But also we're talking at the same time to the biggest banks globally and smaller private banks as well. So there's a lot of interest out there. Of course, like the thing is that we can't fit all of these like interested entities into the same Aave Arc market, because everyone has their different kinds of like compliance requirements or other requirements in terms of like counterparties might not be compliance reasons at all. And that is why the future kind of will be that there will be this kind of like Aave Arc markets, this kind of like a pods, and you will have a few counterparties between different, depending on the requirements. And probably the first Aave Arc market will be the most scaled one, essentially. And especially as we add more as a community, the whitelisters there. And I think that's the kind of like institutional scale, but mainly it will be targeted to kind of like a bigger funds and hedge funds, and over time maybe the banks and the Coinbases of the world. But it will start slowly.
Okay, that really primes the pump for Sheila. So thank you for doing that. Sheila, I think this is a really fascinating question. This idea of sort of regulated DeFi or more regulated DeFi or whitelisted DeFi or KYC DeFi. From the folks that you talk to sort of in the orbit of the World Economic Forum, is that something that's appealing? Are people nervous about that? What is sort of the conversation? What's the pulse check when it comes to institutional DeFi here at this point in time?
Yeah, well, thanks, Zach. As with anything, it depends on who you ask. There are a variety and multitude of opinions. I think there is definitely a feeling that there's something about DeFi that is going to necessitate regulation. I think the views on the timing of regulation are highly divergent. I think some people think that, we should just take everything we already know, take KYC, port these things directly over into DeFi. It's not a view that I agree with at all. I think that regulation at this point is pretty premature because we're still at a really pretty early stage of the innovation arc. And so any regulation really risks cutting off innovation that I actually think could accomplish some of the goals these regulators are trying to achieve, namely consumer protection, fraud prevention, financial inclusion, et cetera. If you regulate something before you really understand it, before it's had a chance to shape itself, then what you're really doing is pushing it into a particular model that may or may not achieve the ends that policymakers are trying to achieve in the first place. So that's my personal view, but certainly views on this differ. And there are, as we see, there are regulators who are very eager to get in there and start shaping the space and kind of make it into a mold that I do think more resembles traditional financial institutions than I think most of us would like to see or think is appropriate.
Yeah. So how do you shape that conversation? Because I think like when we talk about regulating DeFi, it really is sort of like square peg, round hole. A lot of these frameworks don't work in DeFi. And we're seeing that in conversations with the FATF and all sorts of regulatory conversations happening both in the US and abroad. So this is still with you, Sheila. How should we advance that conversation with regulators that, hey, we might need a rethink when it comes to some of these decentralized lending platforms?
Yeah, well, my personal view, and the kind of approach that we're taking with the team here at the forum is to do a lot of education, to really try to encourage, to say that it's not enough to kind of understand the applications, the services being provided here, because again, our minds can only often tend to sort of put things into boxes we understand. So you think about credit, and you have an understanding of how credit markets work, and then you assume that any kind of new credit opportunity is going to mimic essentially those offerings without necessarily being able to imagine or fathom what other things might look like. And so we try to encourage that technical understanding is really important, and understanding not just theoretically what decentralized finance and the protocols can do, but actually what's actually happening and what the growth curve is really looking like. Not not the growth curve in terms of dollar value or market cap or any of that, but the technology growth, like what's really scaling here and what the opportunities could be. And I think that as with the early days of the internet, and I think we're in a similar time, there was a real concern at that, however many years ago, 20 years ago, that there was going to be this, again, I call it premature regulation that was going to cut off innovation. So we try to really spotlight that this is a space that is operating. It's not the Wild West that people are making it out to be. In some cases, the media or others who might have an agenda. It really is a space that is growing and emerging and has principles underlying it. And those principles really are to provide a more democratized access and more inclusion into financial services, essentially. So we try to do a lot of that. I think we also try to, generally speaking, leaving aside even crypto or blockchain, just talk about regulation as a general frame and say, is it the case that our regulatory models are going to translate into what we call the fourth industrial revolution? Like as these new convergent technologies, I'm talking AI, increasing use of smart devices, mobility considerations, like all these things come into play and start intersecting. Should we expect that our regulatory systems and the models that were built under a very different understanding of the way the world operates, a very different understanding of the digital economy, in many cases before the digital economy, should we expect them to just kind of flop over into this new world? I don't think that we should. So what are some new ways we can encourage collaboration between industry, the private sector, public sector? We can get the more of these conversations happening. We facilitate a number of these behind the scenes, connecting people. And what are ways that we can open up our models of regulation to ensure that the principles as a society we care about, some of the ones I mentioned, right, protecting vulnerable populations, more enhanced inclusion, equity, how can we make sure we're baking these into new regulatory models that are forward thinking in terms of the direction of travel with these various technologies?
So be my boots on the ground, and I'm going to ask for a 1 to 10, a scale of 1 to 10 on the level of sophistication and nuance when it comes to the questions that you're being asked about DeFi right now. Where are we? Are these questions savvy? Are we at the one end of the spectrum where it's like real basic, really silly? Are we at the 10 end of the spectrum where people understand the promise and potential of these technologies? Just give me that rating. Where would you say we are?
I mean, when you asked me that, Zach, I literally pictured a 1 to 10 number line, and I can plot a person on 1 to 10.
Well, you're free to name names. You're absolutely free to name names.
It widely varies, right? I think the more that policymakers understand the need to have some technical understanding, the closer they are to the 10. And those who are really just kind of looking at the media and looking at, what's kind of being reported or maybe on Twitter or whatnot, it's really more towards the 1. But I will say, and I think it's important to note that a lot of policymakers are really trying. They really are trying to understand. They are trying to get up to space very quickly get up to speed very quickly in a space that is extraordinarily complicated. I mean, I wouldn't even say that a lot of pundits that are crypto pundits deeply understand DeFi, right? Like they might have some other thing they understand really well, but this is a challenging space. There's a lot going on. So I do want to give credit where credit is due to those that are really making an effort to try to get out there, have a lot of conversations, read a lot of, more sophisticated kind of offerings and get to an understanding.
Fantastic. All right, Steny, I'm jumping back to you. I think this idea of democratizing financial access often means going through sort of mainstream gatekeepers. And Uniswap let slip the other week that they had been talking to PayPal and Robinhood and E-Trade as these traditional fintechs look to incorporate DeFi in some capacity to their suite of services. Who are you talking to on that front? You don't have to name names, but if you do, that's great. When it comes to the conversations with the world of traditional fintech, who is Aave talking to about some of the things that DeFi can offer their user bases?
Yeah, I think we have, Aave has a lot of exposure because of the fact that how big it is today as a protocol. Aave is the biggest protocol now, and it's cross-chain, meaning that it also kind of like taps into audience that isn't necessarily in the main Ethereum network. And we actually have, as a protocol, more users in Polygon, which is a proof of stake network, twice as many. So it definitely reaches out in a wider kind of like a demographic. But also, I would say in terms of we don't have especially any kind of let's say an outreach to financial institutions or traditional market participants. There's a lot of inquiries and more of like a education that we do, and we have discussions with probably the biggest banks and investment banks, and also like consumer banks as well. We do a lot of discussions with fintechs, custodians, pretty much like almost every big household, fintech we have been talking to, and the major banks one way or another. So even like as a small team, and kind of like what we want more is not just like, these entities being able to reach Aave and learn more about the Aave protocol, but also like having more on, like, I would say like entities where these entities could reach upon and just like learn more from the community. So basically, like what we will want to see is more like a community run entities that are trying to educate more traditional financial institutions. And I think that's the kind of like a missing part, because there isn't that much of a value if financial institutions are reaching out to Aave and thinking like how they can learn more, but more of like understanding the whole space in general, and also understanding the community aspect and the sentiment there. But especially with the Aave ARC market, there has been more and more interest there. And I think for me, what's important is that two things is well understood. One is the properties of decentralized finance, because decentralized finance for me is important because it brings inclusivity, in the sense that if you use these protocols, you can use them globally with similar kind of like an access and to the markets, but also that you can access them and you see the transparency. Each and every transaction, everything is auditable every second, compared to banking systems that are kind of like a black box in terms of markets. And being able to also build new things and iterate quickly and build innovation is very interesting. For example, from the perspective of RegTech, smart contracts are very powerful, because not only you see everything, all the transaction, you can build better risk management tools, but also you can trust that the smart contracts execute the way they're programmed. Because in paper agreements, you can agree upon many things, but the execution might lack for one or another reason. So that's the one thing. And the second thing is the community ownership. So many of the institutions, they actually understand that the protocols are owned by their communities, meaning that they are making decisions. There isn't like a central party or anyone kind of like there making the decisions. And secondly, that they understand that by providing liquidity, you get also as a user that community power and participation. So those are the things that have been well communicated, and I think are powerful.
So I'll ask this of both of you, and I'll start with Stanny, because I'm interested in your perspective on this one. If I were to, posit the thesis that these protocols will sync to the background behind various abstraction layers that people will use Aave without knowing they're using Aave, is that thesis smart or dumb? Do you think that's going to happen, or do you think that Aave, Compound, Uniswap, these will be the big brands of the future of finance?
I think the protocols will always run in the background, and they will be governed by the community, and probably over time, as the protocols will be evolving, maybe they will be even renamed depending on like what kind of functionalities. But the as a brands, I would say Aave as a team is just a Web3 development entity which aims to just build part of the Web3 until there's more and more people building. And what it means for us is that as we're building decentralized finance, our next thing, and this kind of like a financial graph, our next thing to build now, where we have allocated a lot of resources, is to build a social graph, and kind of like a social media type of a protocol where kind of like we're moving towards one thing building to another, and completely different, because we see blockchain as a store of value, meaning that you cannot just store like, let's say, monetary value or any kind of value, but you can also store relationships linking to art, or what we have, for example, with NFTs. and I think like the brand will stick on Aave being able to build secure protocols, which is important, and have this kind of like a composability. But also like essentially those protocols will run by themselves the same way as Ethereum is running by itself and governed by the validators. In Aave's case, it's the users and the community.
Sheila, what's your view of whether DeFi will sort of sink to the background and I mean, the question is, this is still used by a fairly small subset of the world population. There are potential benefits to a wide subset of the global population. What's your view in terms of how DeFi will be used should it approach mainstream level adoption?
Yeah, well, I think you asked a number of different questions there, Zach, so I'll kind of tease them apart a little bit. And so one is, the extent to which DeFi is going to become a phenomenon that is commonplace. I think, yes, I do think that is very dependent, of course, on the way it is regulated and on the enabling environment, that surrounds it. And so with that caveat, I think that yes, and my hope is that yes, we'll move in that direction. In terms of whether the protocols will become brand names, I think or sink into the background or whatnot. I think it's both. And I also think it's too soon to tell. It's going to depend a lot on decisions that, Stani and Leshner and Hayden and others make. Right now, if you think about the current moment is really honing in on building and perfecting the infrastructure with applications on top of it as well, then you can kind of imagine that there's going to be a suite of services that really start to thrive and take off, which is already slowly starting to happen. But you're going to see more emphasis on that kind of thing. Teams that are more product kind of oriented, doing that kind of thing. Who's going to do that? I mean, you're talking to somebody on our panel, right, who's got the foresight to probably understand that's going to happen with Aave, and others are going to know and make decisions there as well. It's going to depend on the extent to which these protocols, the companies that are working with the protocols, of course, which are distinctions that are important to make, are focusing on protocol maintenance or whether they're focusing on building this giant suite of services. And I am certainly not the person that could predict that. So that's why I kind of say it's both and a bit too soon to tell.
Gotcha. So Stani, as someone in the belly of the beast, what's the next big DeFi milestone that you are looking for that signals to you that DeFi has taken that next step?
I think the Aave Arc market kind of like working as designed and creating maybe kind of like inspiring institutions to kind of like look at decentralized finance as a software could actually be very good software to replace or be part of the software stack that we have now in other places in finance. I don't think the protocols are anything like businesses or anything like that. They're pretty much software, what I see. And if we are able to use this more efficient software, which is governed by their users and not companies that are building, that will be like a more fair, democratic way actually of governing something which is very important, which is financial infrastructure. So that's like one thing which is I'm looking forward to.
Got it. And so Sheila, what's the milestone that that you're looking toward, to signal that that next step in the evolution of DeFi?
Yeah, I was trying to remember, Zach, the last time you asked me that question, what I said, and I don't remember, but I imagine it was the same answer.
I should have dug it up. I should have dug it up and just put you on the spot.
I don't remember, but I'll tell you what I'm going to say now, which is I think some kind of clarity around the direction of regulation. This remains one of the biggest challenges, I think, to growth in the space and to the amount of energy people are going to put into it. And so once I think this has died down a bit and there's a little less, let's call it less regulatory turbulence, I think then we're going to really see that everything take off and we're going to be more confident, I think, as a community that we can really deep dive and start pushing a lot of the things we all want to do forward.
Fantastic. Well, we're going to wrap it there. Thanks so much, Sandy, for the keynote and the additional thoughts. Thank you so much, Sheila, for conversing with us here. This has been great. Thanks to the folks in the chat for participating and suggesting some really great questions as well. I'm Zach Seward from CoinDesk. I'm going to toss it back to Andy. Hope everyone's having a great day, and we'll see you soon.
Thank you.
Thanks.
Thank you to our presenters. Hey, thanks, Zach, for coming on. Really appreciate your insightful questions. Pulling from the audience, we appreciate that. I want to take a moment and talk to our audience as well. There have been a few questions that I want to tell you guys about. Some people have asked, Will the videos be available later on? Yes, we are working to make sure those are posted and available at a later date. So if you miss a segment, or if you need to go back and take a couple of notes on something Balaji said or Sergey said, that will be available to you. In addition to that, we're working hard to release content that kind of corresponds with many of these sessions. So you should be able to follow along with Chainlink on Twitter and see a lot of those announcements, or if you follow any of these other organizations as well. So please feel free to do that. While I have you guys here for just a minute, the Hopin interface is also really cool. If you guys kind of check out, this conference is more than just a couple of stages. First of all, we do have 2 stages. This is the innovation stage. We're talking to many great founders and amazing projects, but there's also the Chain-Linked stage, which is another stage featuring a lot of developer content, some research content. So we really have a 2-stage conference in this SmartCon. So check out the schedule and make sure to check those out. There's some really great content over there. I'm not seeing any of it, so I'm going to count on those videos being up later on to make sure that I can catch up. On the Hopin page, as you're watching, there's some things on the left bar as well. There's stages and sessions. That's like a schedule you can go and check out. There's a networking event as well. It'll randomly pair you with somebody else around the world watching SmartCon, and so you can start doing some of that networking. I haven't been able to do it this year because I've been doing this, but last year I met a couple of people, and so that is a cool thing. And I know some of our Chainlink advocates from around the world are doing that as well. So please check that out. And then the bottom tab is the Expo. A number of supporting projects that are supporting the conference are there, including Chainlink Labs BD team. So if you're a developer thinking about integrating Chainlink, go and talk to those folks there. They're there to meet with you and start those conversations. And also the Chainlink Labs careers team. If you're thinking about a career in Web3, in blockchain and smart contracts, come talk to our careers folks. They will help you out, direct you to the right places, and start you down that path. That's what I did, is I started talking to them, and hey, that's how it happens sometimes. Okay, we're going to keep rolling shortly. We're going to take another short break and listen to some of those sick beats, as you guys like very much. And we're going to have to find that track and put it out on Twitter. I'll work on that because people like it. So for another few minutes, pop on those headphones, get into the groove, and we'll be back in a minute with Clark Parsons. Welcome back to SmartCon. It's me, Andy Boyan. I am your MC. And I mean, you may have noticed over the course of the day, we've taken a slight little turn. We're starting to talk a little bit more about government tech, and CBDCs are coming up. So I'm really excited to hear this presentation about the digital euro and a path forward. So up next, we have our speaker, Clark Parsons from the Internet Economy Foundation, to give a presentation. Thank you.
Thanks, Andy, and thanks everybody on the Chainlink team. We're really excited to be able to present to you guys today. I'm going to talk just for 10 minutes, a quick keynote about a study that we're about to publish in a few weeks that we've been doing in partnership with Chainlink about the digital euro. But first, to give you some idea of who the heck is talking and a little bit of context, I introduced the Internet Economy Foundation, which is the foundation that I've been running for 5 years. And it is interesting, Andy, as you mentioned, we're sort of moving a little towards regulation. The panel just a moment ago, Sheila Warren, really appreciated her comments about this notion of innovation versus regulation, and where are we on that scale with the development of DeFi. This is something that the Internet Economy Foundation has actually been grappling with from the beginning too. So a little bit about the IEF and what we're about. We're an independent think tank. We're based in Berlin. It's important to know that we're actually not funded by any government. We're not a trade federation. We're funded by founders and funders, actually from the internet scene. And also important to know in the world of think tanks, we don't have any money from our beloved Silicon Valley companies, Google, Apple, Facebook, Amazon, Microsoft, or any of our Chinese friends. It's really important for us to maintain that independence, but we do see ourselves as a link between the web industry and the policymakers. It's, as Sheila said, some are at 1 and some are at 10 in their understanding of where the web is. And it's really important, I think, to have organizations like ours trying to help the politicians that do want to understand. We're working from a European point of view, and if you could boil us down to one word, it would be competition. We really are trying to keep Web 2.0, 3.0, DeFi, whatever stage of web or tech you're working on, we want to keep it free and fair and competitive. So if you look at the Web 2.0 race, which I guess has been running for the last 15 years, this is the way most Europeans would see how that's been going. That's sorry for all the white males in the picture. It's not a very diverse drawing, but the point there is that Europe has been huffing and puffing. The solution is, of course, not to just overregulate and hope that somehow that'll make champions. The Internet Economy Foundation really was born to try and help Europe compete on a fair playing field. A bit of some of our activities over the past 5 years. We do a lot of studies. We do a lot of background discussions, trying to translate the world of the internet to policymakers, and then actually help them decide where should they regulate, what should they regulate, and if so, how. And just to give you see some of the stuff we've done, disinformation was a big topic a couple of years ago. It's now feeding into the Digital Services Act at the EU level. We focus on 3 main areas. One is infrastructure, which for us started as things like 5G and broadband and cloud computing, but now, of course, crypto and blockchain for us are key, huge pieces of the coming digital infrastructure. And one study I would highlight here, one of our earliest ones, we looked at the platform economy. It was it's a subject that's really been a lot of the speakers today have touched on some of the principles that we were talking about when we looked at the platform economy. This chart is actually 5 years old. But it could be from yesterday because the market share portions of most of the dominant players are still the same. And that's kind of one of the missions of the Internet Economy Foundation is where there is market dominance, we want to try and break it up or find a way to bring competition in there. And this is something, again, that discussion that was just in the previous panel about should we regulate, should we not, should we let innovation flourish? 20 years ago, the US government said, let's let innovation flourish. 20 years later, we have some market dominance in some spots. We actually created a chart for how to spot a gatekeeper, if you will, or how or when to regulate a gatekeeper. This was something that we think is right now being discussed in Brussels with the Digital Markets Act. And as you can see, just to give you some examples, I mean, Uber or Lyft, those are platforms, they're aggregators, they're multi-sided markets. But in competition terms, they're not hurting anybody in terms of being a gatekeeper or a marketplace that could dominate the others. So we tried to keep this sort of scale where you could judge, okay, is somebody mission critical? Is someone market dominant? Are they a gatekeeper? Are they a bottleneck? And ultimately for us, it boiled down to things like search engines, operating systems, app stores, pretty common examples that most people would agree on where market dominance has led to abuse. I mean, you look at the way the advertising technology market is running right now, and I think we're all in agreement on that. So that's just some thoughts about the IEF. Why do we care about crypto and blockchain? Well, for a couple of reasons. First of all, deep tech, as it is defined, is really something where Europe is placing a lot of its poker chips. And you could argue, this is a slide from a few years ago, the Slush State of European Tech survey, where they looked at different countries and what emerging deep tech elements were best poised for certain countries. And as you can see, crypto blockchain, I would actually disagree. I think, ironically, the German ecosystem, if you see, Ocean, Fractal, the Polkadot ecosystem, Kilt, there's a lot of really great stuff going on in that marketplace. So we've got a study coming out, and so this is a bit of a preview of it. And in fact, there's a panel right after this on CBDCs who will do much better deep dive on the issue. But to set the table for that, we've teamed up with Lakestar, ChainLink, and Economy, and we want to really try and again have a study for someone like this gentleman here, who's from the European Central Bank, saying, hey, don't worry, we'll protect you all from that crazy DeFi world. We'll bring a digital euro out that'll sort of be safe and protect your privacy, but we promise it won't be too crazy innovative. We'll see where that goes. We want to accompany this process. We think there's a huge opportunity for all CBDCs, especially the European one. It has a lot of potentials. Interestingly enough, you could even correct some of the birth mistakes, if you will, of the way the euro was designed. But bottom right for us is, of course, the most important one, and the most important for the Chainlink ecosystem and all of the DeFi world is, if you can architect your digital currency properly, you can enable much more digital innovation to flourish. And for us, that's the key. That's what this is all about, is if you get it right, you can unite the best of all of these worlds, because as we heard from the great talk between Sergey and Jonathan earlier from Swift, this old infrastructure isn't going anywhere. I love Jonathan's phrase about the lucrative inefficiencies. Yes, of course, they'll go away, but a digital euro has the opportunity to enable a lot of great new innovation to sit on top of the existing ecosystems. So this pyramid, if you will, is for us what the key to our study will be, and I think it'll be the key to a lot of central bank digital currency discussions and debates in the coming years. What are the design choices that are going to need to be made? What are the architecture choices that will have to be made, and what will that lead to? And actually, in this pyramid, you actually sort of work your way up from the bottom to say, okay, how do we want to do this? Do we want to make it account-based or token-based? Think of, a credit card versus cash. One is a token, one is an account. And as you make these design choices, you can work your way up the pyramid and potentially enable whole new levels and ecosystems of innovation to sit atop it. So in our study, we're of course not making all of these choices right now for the ECB or others. We're trying to lay things out so that everyone can understand what's at stake, because those are really the key elements for how to make sure that an innovation economy can sit atop this system. So final slide, and the key one, if I was able to talk to Ms. Lagarde of the ECB, these are the recommendations that we, together with Chainlink and Lakestar and Economy, are putting out there for the ECB to have in mind while they're designing a digital euro and starting this process. Obviously, European financial sovereignty is a huge issue. For those of you who aren't familiar with it, in Europe, we're quite aware of our weakness. Visa and MasterCard are not European systems. thankfully, SWIFT is like a DAO, wonderful, but a lot of the payment and transaction world and a lot of the existing banking systems and payment systems worldwide are not in European hands, and that makes a lot of people nervous. So we want, a digital euro to reinforce the euro's position. We obviously want it to be designed with a more secure future, but for us, the number 4 and number 5 are the key elements here as part of our recommendations. You really need to have form, follow, function, and build something for the innovation ecosystem, and especially tailor it to meet the needs of the startup, scale-up, and DeFi ecosystems. Because as you can see from today, what's going on here with SmartCon, there's an incredible future here for IoT, for smart contracts, for machine-to-machine transactions. And I think if we can get a digital euro that helps us harness all that, then the sky's really the limit, and SmartCon 2 will have double again in terms of the numbers of people here. So thanks again. Thanks back over to you, Andy. Looking forward to the CBDC panel coming up. And thanks again to the great Chainlink team for this opportunity. Next slide, final one, please contact us, stay in touch. We'll have not only this digital euro study coming out, but others on this subject. Please keep in touch and we'll make sure you get a copy. And thanks again to the Chainlink team.
Clark, thank you so much for joining us. If I can keep you for just 1 minute, I got a question for you. Have you noticed, 5 years ago, the talk of antitrust was, some fringe lobbyists and think tanks who are excited about it. But now it seems like it's entering into the public consciousness more, especially in the States, but then across Europe and around. Have you noticed that shift?
Oh, good Lord. Yeah, I like to think I was part of that shift. We were very lonely 5 years ago, when we put out a study and said monopoly or gatekeepers. So definitely that shift is there. But ironically, the shift didn't really happen until we saw a lot of the negative consequences of monopolies or market dominance. On the disinformation side, several elections happened and people started suddenly realizing, why do we have so much market power in the hands of a duopoly in global advertising? And so that shift is there. And I guess the message is, what sounds or seems like a fringe group or kind of crazy now can be the middle of the road in 5 years. I'm old enough to remember when there was competition in search 25 years ago. And when I see the DeFi space, when I see crypto blockchain, it sounded and seemed like a kind of a fringe thing a few years ago. Mm-hmm. It's now obviously right in the middle of things, as you can see. And I think that's what's exciting, is that if you develop this nose in technology that most of us have, this love for the new, things that seem a little crazy or wild can, within a matter of time, become absolutely a dominant force.
Thank you so much, Clark. I appreciate you taking a little bit of time, a curiosity of mine. And to the audience, I just want to tie some of the threads. If you take a listen back to some of the things Sheila Warren is talking about, to the SWIFT presentation as well, and to what Internet Foundation is also working on, like there are themes coming. And so sometimes it takes a lot to get the flywheel of change moving, but we're absolutely seeing some of that. So Clark, thank you again for your time today and bringing us these fantastic ideas.
Thanks, Andy. Thanks, guys.
Coming up next, we're going to take, again, just a tiny break, but then we're going to bring on a panel about CBDCs. So we're going to learn a little bit about that from an expert panel of academic researchers. We'll be right back. SmartCon 2021.
Hello, and welcome to the panel on central bank digital currencies and blockchain, organized by the Smart Contract Research Forum, or SCURF, as part of the Smart Contract Summit. I'm Eugene Leventhal, the operations lead here at SCURF, and I have the pleasure of moderating today's panel. You'll be able to learn more about the panelists through smartcontractresearch.org/T/623. We'll also add the specific link at the end in case you didn't catch that. With that, I'll pass it off to Andrew Miller to kick us off with introductions before we get into the moderated discussion.
Thanks, Eugene. Very happy to get started. So I'm Andrew Miller. I'm an assistant professor in computer engineering at the University of Illinois. There I lead the Decentralized Systems Lab, and my research mainly focuses on cryptography, programming languages, and blockchain designs, a lot of smart contract programming, and so the very technical side of cryptocurrencies. I've been in the blockchain space for about 9 years. I was in, I think, the first cohort of folks who did PhD dissertations focused on cryptocurrencies. All that is to say, I think I have a good grasp on the technical side of blockchains and maybe on the cryptocurrency ecosystem's view of narratives and how finance works. But I'm very new to basically learning anything about how mainstream finance or central banks or real world banks work. I think that I'm on this panel because I co-authored with some other folks at the Initiative for Cryptocurrencies and Contracts a paper on design choices for CBDCs. I mostly have some perspective on what kinds of programming interfaces CBDCs might have and what kinds of privacy issues and techniques that they would have. And interested in learning and some much weaker perspectives, I would say, on the kind of institutional and organizational and policy issues of CBDCs. I think you asked to give an explanation of what is a CBDC as a short one in this first pass. So to me, the developer's perspective or the blockchain perspective, I think has to be pretty loose. So I would call it a CBDC, whether it has just as really centrally operated and directly retail customers to a central bank, or something that's more hierarchical with member banks and commercial banks involved. In either way, to me, what makes it a CBDC is if it incorporates any kind of blockchain technology, whether it's cryptography to provide privacy, smart contract programming to provide extensibility. And what I kind of expect is likely to emerge as the real promising pattern is the idea of the central bank providing an API platform for programming with some kinds of rules or regulations or constraints built in at the platform level, but then a very high amount of flexibility for commercial banks and member banks to be able to customize their own applications through this programming interface, and then compete on the kind of functionality that they could offer. So it's really the CBDC as a platform kind of view. So I'll yield there.
Thank you, Andrew. Ariel, do you mind going next?
Sure. Thanks, Eugene. My name is Ariel Zetlin-Jones. I'm an economist at the Tepper School of Business at Carnegie Mellon University. My research focuses on how information and technology shape financial markets and the implications of financial markets and financial market regulation for the broader macroeconomy. Lately, I've been studying the role of blockchain in disrupting financial markets and thinking about what economics can shed light on for kind of blockchain and the computer science aspects. So thinking about how to harness economic incentives to improve consensus on distributed ledgers, or how to use economic incentives to improve, in theory, to improve, say, the design of stablecoins. With a training in macroeconomics and monetary economics, I've thought a lot about the role of government and private payment systems in the macroeconomy. And so the perspective I'll try to add is kind of the interaction between what monetary policy and central bank digital currency may or may not achieve in changing our payment system. I guess I have a very similar perspective to Andrew in terms of what a central bank digital currency may be. I think the critical distinction is whether we think a central bank digital currency is going to be only accessible by financial institutions or accessible to retail customers. And I think the most interesting aspects, as Andrew suggested, is that what's new about CBDC is offering access to, say, a savings account at the central bank for retail customers. And whether that's an account-based system or a token-based system are interesting questions. But I think that's the newest aspect of a central bank digital currency. And then the question is, how will this impact our payment system? How will this impact the traditional banking system in good ways or bad? And what does it imply for monetary policy? And so those are, I think, all interesting questions to start thinking about.
Great. Thank you, Ariel. And Philip, do you mind jumping in next?
Thanks. Yes, my name is Philipp Sandner. I'm working at the Frankfurt School of Finance and Management, which is a small university in Germany. Not everybody might know this university. As I said, it's a small one. We have 400 business faculties over here in Germany, and the Frankfurt School belongs to the top 10 over there. So people over here know it, but it's a tiny one. Therefore, not everybody out there might know our university. I myself am into blockchain now since 2013 when I discovered Bitcoin, which became some kind of hobby in the beginning. And 5 years ago, we have set up the Blockchain Center at the Frankfurt School. And since then, we are doing with our team of 10 people full-time blockchain, crypto, DLT. But we also moved away from enterprise solutions towards decentral systems, cryptocurrencies. That's where my heart lies nowadays with on-chain analytics and so on. And an interesting topic we are currently investigating is what kind of tokens are out there. You have utility tokens, payment tokens, investment tokens, this tokens, that tokens, and bringing some kind of structure there is one of our mission in our research. And historically, I studied a mixture between business and computer science. And from a research perspective, I did a lot of work in the area of entrepreneurship and also venture capital, always with empirical data. And now concerning CBDC, I think I would follow your explanation and your definition. Definitely, I would try to define CBDC as some kind of, let's call it, digital modern ledger where a central bank tries to re-establish the direct relation to a customer. It can be mediated through financial intermediaries such as banks or payment providers, but not necessarily. And absolutely right, CBDCs can be DLT based, but they do not have to be DLT based. They can have smart contracts, but they do not have to have a smart contract functionality. And therefore, there are good reasons why blockchain technology makes sense, but central banks around the world are also experimenting with non-blockchain CBDCs. And therefore, I think my perspective is that CBDC is only one sort of digital money of the future. There will be other sorts of money. Some of them will be fiat-based. Some of money will be not fiat-based. And for example, in Germany, we discuss it a lot, how, for example, to leverage blockchain and the euro in smart contracts, how to leverage the euro in smart contracts as soon as possible, because the ECB, yes, tries to build a CBDC, but the ECB is lacking quite strongly behind when you compare it to China. And the CBDC produced by the European Central Bank might be with us by 2026 or 2028. And this is opposed by the European industry, companies like Daimler, Bosch, Siemens, who are urgently demanding a digital currency. So there needs to be other forms of the digital euro for these years, because the CBDC is a big project, and apparently the ECB is not the fastest organization out there.
Great, thank you for the three of you introducing yourselves. And we also have Richard Brown joining us, who's the founder of Scurf as well. Rich, if you want to just give a quick intro too.
Sure, I'll make this super brief. Richard Brown, co-founder of Scurf, most recently head of community at MakerDAO. If I have any experience that's relevant to this conversation, it is that we produced a stablecoin, and there's some obvious similarities between that and some of the proposals for CBDCs. I'll be co-moderating with Eugene, and as I'm a neophyte in the space, I'm looking forward to the conversation, but I don't think I'll have much to add, but I'm looking forward to it. Thank you, Eugene.
And so to get us started, I kind of want to follow up on the kind of definitions that you all laid out and zooming in on that idea for a moment, because I think trying to create a baseline of sort of what is a CBDC in relation to, does it need to be using a DLT or smart contracts or some of these other, blockchain technical components or not? And really thinking, I know, Philip, you also mentioned the idea of hybrid CBDCs when we were getting started at the beginning of this. So I guess as an immediate question, Philip, do you mind just mentioning what you mean by hybrid CBDCs, what those are, and then we'll kind of springboard into what we see as the minimum design requirements for something to be a CBDC versus another type of tool that central banks might be able to have at their disposal?
Yeah, exactly. So there are multiple design options out there for CBDCs. Typically, you call it direct CBDC if we as citizens have direct access to the central bank, but this would require the central bank to really do IT. It also would require the central bank potentially to run an online app, like a smartphone app, to give me access to the euro or the US dollar. And I think central banks are not the right organizations to supply such IT. Therefore, the topic of hybrid CBDCs popped up. This means that the central bank is supplying the money originally, but it also relies on existing banks and payment providers to process these payments, to also onboard customers, to do KYC processes and AML checks. So this way you have a multi-tier system with the central bank in the background and some banks and payment processes in between. And the most important point here is that the central bank is supplying the money originally with inflation, without inflation, it doesn't matter, but it's supplying the money, and the money can then be taken up by banks and be forwarded to us as citizens, but also to companies and so on. And most important on this point is that there are also payment processors such as credit cards and banks who are then themselves supplying citizens and who are also supplying companies like Bosch, Daimler, Siemens, all these companies, they also need cash for their payments. And here I think it's very important that the central bank is not necessarily always bridging the entire line from a central bank to the citizens, but that it supplies money which can also then be used by other payment processors who then themselves make money available to the capital market, to the industry, to the upcoming economy of things, and so on. And that's why the topic of hybrid CBDCs could potentially make sense. And the last point I would like to make: in Germany, we have this discussion going up on how what we can do to supply companies with some kind of digital currency, with a digital euro. And here, for example, banks are developing so-called payment adapters, which are sitting in between their legacy payment systems and smart contract systems, and they are reconciling this blockchain. They are trying to reconcile the blockchain system and the balances there with the money in legacy payment infrastructures in the bank accounts, and these payment adapters are then trying to synchronize the legacy world with the modern blockchain-based payment infrastructures.
Great. Ariel, did you want to jump in?
I do. I just really appreciate Philip's perspective about this possibility of a hybrid system. And I think it's important to recognize we sort of live in that system already, at least in most advanced economies, right? Where central banks provide physical currency that are used directly by retail customers, but they also provide reserves indirectly to the commercial banking system, who then supply their own form of private money supported by those reserves to private customers. And I think what Philip's describing is that the role of these banks may look very different when the central bank issues its own digital medium of exchange that is in principle accessible by customers, that maybe they're platform providers of some way to give a better IT experience, better access to central bank currency than just creating their own private monies. And I think that tension is an interesting one. And I think the big challenge from a central banking perspective of thinking about creating a digital currency is exactly the fact that right now the intermediaries play two different roles. They're payment processors, but they're also the people who extend credit, the institutions responsible for extending credit. And so, the big debate in the economics literature right now about CBDC has really been focusing on disintermediation. The idea that if you give retail customers direct access to the central bank to store their savings, will they no longer save in the commercial banking system? And I think that's why in advanced economies, you're seeing a push for some kind of hybrid approach to make sure that we can leave resources in the banking sector to keep extending credit. Because I don't think central banks are interested in using these deposit reserves to extend credit themselves. And so that's why I think Philip's perspective is a very interesting and useful one. The question is just, will the role of these intermediaries change if we create this new kind of digital medium?
Yeah, of course. And Andrew, did you want to jump in here as well?
Yeah, so I like the kind of framing of your question as what would be a minimum viable CBDC, or what's the minimum amount of blockchain technology that could be added to it and still call it something blockchain based or a digital currency. And so, I mean, one thing that I would mention is that I think it's unlikely that you would have CBDCs built on top of a public blockchain, for example, or built on top of proof of work, anonymous consensus systems, for example. It's quite more plausible that it would be some sort of consortium consensus protocol, or even something that doesn't even resemble a consensus protocol and is essentially centrally operated and looks a lot like an ordinary database system. I could give some examples of potential technical crypto benefits that you might get even in an essentially centrally administered database that I think still are very much kind of responsive to the things that are desirable about cryptocurrencies and blockchain. So the example that I will give is the idea of auditability and transparency for records. So to the extent that people are interested in being able to audit from a public viewpoint, otherwise opaque systems of how much money is being printed or how it's going around. Some of the kind of technical toolkits in blockchains, like hash-based data structures and commitments, for example, could be used to essentially make a public account record of all of the main movements or changes to parameters or changes to interest rates or other kinds of things that might change over time. And some of the technology that blockchains use today in the cryptocurrency world, like zero-knowledge proofs, could be a really good fit for that as well. Like you might be able to provide a very good open transparency record that's essentially a proof that a certain policy has been abided by the central bank or by the member banks. You'd get some cryptographic proof that the rules that were set were followed to a T. And that's something that's new. I think right now in an opaque central database system, all you can do is take the administrator's word for it. Cryptocurrencies show that there are, some alternative approaches that could be better than that. So even in a world where it's low, to say nothing of the programmability frameworks like smart contracts or of the distributed trust like consensus protocols, even if nothing else, I could imagine CBDCs incorporate some of the cryptography components that blockchains use for better auditability.
Yeah, and I appreciate what was mentioned so far, especially in terms of many of the conversations from pure, DeFi protocols or anyone that's purely in the blockchain space is just disintermediating the existing financial system. But then if a central bank deploys this technology, there's the added dimension of, well, how do we actually keep the stakeholders in the loop and as part of this new future and not disintermediate them away? So that was just an interesting thread that was mentioned there. But Rich, did you want to jump in and mention something?
Sure. There's some interesting things to unpack here. So it's the blockchain space sort of disintermediates, and then the banks or central banks issue CBDCs, and then they re-intermediate themselves. But the distinction that DLT is not a given, it's more of the paradigm and the assumptions that come along with this new sort of blockchain world that we live in, that the banks are now competing against the private sector, which is offering programmability and greater audit trails and perhaps more responsiveness to transactions. So it's the banks waking up to this new world that there's expectations that they will provide platforms. And so does that turn traditional banking into more of a fintech model where the banks are the settlement layers or the token minters, and normal banks that we're familiar with become fintech platforms? Is that the new world that we're looking at?
Philip, I know you had your hand raised. I don't know if you want to respond to that one or follow up on a previous thread.
Well, I think that's a very, very interesting thought. Like doing a finance platform and basically providing access to money could also be other monies, it doesn't need to be one currency, it can also be foreign currencies and so on. Makes extremely much sense for a bank. And I think the governments around the world, they will always want to have organizations in place, such as banks, who are doing identification of customers, who are doing AML checks and so on. And I think if you are seeing a world where governments are requiring this, somebody has to do it. And I think this is a task which is basically, as in the past, also loaded onto existing financial intermediaries, even if potentially in the future you are taking the possibility of providing loans away from banks. But I would like to add one more point to what Andrew has said. I think one of the very interesting point of blockchain technology, which very often is not really understood, is that you have one ledger and you have multiple assets on top of the ledger. You see this very nicely happening in the Ethereum world with DeFi, right? But in case we are talking about money and central banks of the past, then the ECB and the Fed and other central banks around, they are simply operating their silo, and they don't really care what's happening with the euro or to the euro or with the US dollar. So they are simply supplying the euro or the dollar, and that's their silo, right? But if you are doing transactions, security transactions in the capital market, in case you're purchasing a product or a service from an industrial corporation, then you are giving money and you're taking something. So there is a give and take taking place, and this give and take in the capital market is operated by clearing houses, right? And once you have a blockchain system which is token based, and you can have the euro, the dollar, securities and other forms of assets on top of one and the same platform, then you can get rid of clearing houses, because the clearinghouse function is then done and executed by smart contracts. That's exactly why DeFi works so extremely well, because you don't have clearinghouses in forms of organizations doing this, but you simply have smart contracts. And this is an angle in my mind where blockchain technology for CBDCs really, really makes sense. But central banks around the world have to accept that they in the future not simply operate their silo of money, but they are deploying some kind of currency on one ledger where potentially there could be other assets as well, because only if you have a multi-asset platform, then you can leverage smart contracts, settlement by smart contracts, and then you can get rid of clearing houses with all the efficiencies and costs and time and insurances and risks and so on, which you then do not have anymore once clearing houses are not needed anymore. I think that's a very important point, which is very often, not fully understood.
Yeah, and that also generally makes me wonder about the importance of how much pre-planning and standardization needs to be done to enable interoperability on a global scale versus how much, as with many crypto projects, of we'll build first and figure out the details later around some of these things. But Ariel, I know you wanted to jump in.
Well, I just wanted to raise there are risks of interoperability across currencies, and making currencies very easily tradable on the exact same platform jointly with, say, goods or services, capital being traded, creates risks for independent control of monetary policy. And so we could see resistance to this usage, as Philip's describing, of a central bank digital currency where you're creating a single platform. And there's some academic research already showing this, of what do global digital currencies imply for risk of independent monetary policy. I did want to follow up on one of Andrew's points, though, about using the underlying technology features of blockchain in a CBDC, perhaps in a centralized ledger way. And what I thought was fascinating of Andrew's perspective is that CBDC could be used as a way to gain transparency into monetary policy. The flip side perspective is the ability of a central bank to gain more transparency into the use of its money by its retail customers. And that creates an interesting tension of where is the real value in additional information? Is the additional information getting transparency in what the central bank is doing in terms of monetary policy, or gaining information into how users use currency? And we've seen this in private institutions already. We've seen innovations in the private payment space, say Venmo trying to gain more information, more data about its users' transaction records, thinking that data is valuable. So I wonder if CBDC could also offer some value in terms of generating more data about how customers use a given currency, and whether that would improve monetary policy or not. The tension there, of course, is perhaps consumers, retail customers don't want to give all that data away to their government. Certainly in the private digital currency space, that's one of the big concerns of why we want cryptocurrencies, perhaps, as opposed to central bank currencies. So I think that creates an interesting tension about how do we design central bank digital currencies in a useful way that will actually be adopted privately. I view it as, we usually think more information is a good thing. So, in today's world, especially in the U.S., we're seeing this advanced, opening of the macro economy, and we're seeing lots of choke points in different consumer goods, and that's leading to very confusing perspectives on what's happening to overall prices, which is the key objective of the central bank. One of their two key objectives is to manage overall prices. Would having big data on a CBDC improve that in some meaningful way or not? I think that's the perspective I was trying to question, that perhaps the CBDC gives them more information. Does it come with other costs? And one of the costs, there's a very old debate about kind of discretion versus commitment in monetary policy. And Andrew is saying perhaps we want to tie the central bank's hands, tie them to the mast to pursue their policy, but maybe that's costly because it doesn't let them react in the ways where discretion could be valuable. So I don't have concrete answers, Richard, for you, but I think that's sort of the tension I was trying to get at.
So I think there's a very big risk of privacy falling to the wayside. And so I want to try to give a perspective here that really comes from, we worked through some of this in that CBDC Design Choices paper, and really the insight is just to recognize how open-ended the design space is. The scope of what you can do in terms of defining monetary policy and defining your disclosure or privacy rules. Nothing is baked in from scratch. Like you with a clean slate design, you aren't constrained really in any way. What you can do with the blockchain technology is quite flexible. I think that a lot of privacy mechanisms that we have, even checks and balances in privacy today, aren't the result of design. They're kind of happen by happenstance or come from like the legacy institutional separate silos. You see this not only in finance, but in things like fingerprint databases, where just by having evolved separately, different government agencies, for example, don't have compatible database formats. And that translates into a sort of firewalling, privacy mechanism, even though it wasn't designed that way on purpose, it just kind of happened that way. And so I think that there's a risk of assuming that privacy will work well in the future in a CBDC, even if it's not designed for it, in the same way that some of today's institutions provide privacy by accident. And I think that that's not the case at all. I think that if there's not a policy choice that says that privacy is a first-class requirement, our human rights require it, our statutes or whatever requirement, and so that must be built in, I think that there's a risk of, by default, all the data will be available for ease of visibility, which has great benefits of efficiency, but also potentially bigger risk of data breach and all of that. So my hope with CBDCs is that they do incorporate privacy as a first-class design goal, and then select from all of the appropriate technologies, from zero-knowledge proofs and other cryptography that might be employed to ensure that kind of privacy. But it's not something that should be taken for granted. It's not something that's like built into blockchains, for example. Quite the opposite. If you use an off-the-shelf blockchain, it's probably going to involve replication of all of the data, which is worse for confidentiality or risk of data breaches.
And so I wanted to follow a thread that started getting alluded to in the last couple of comments. And part of that is exploring the question of what problem are CBDs looking to solve? Because also to think about, Andrew, as you're alluding to, the important design considerations, and I personally very much agree with the privacy one. And I know maybe if we have time, Philip can give us some color on the EU-based projects with the ECB and how they're thinking about some things. But I guess to start off, what do you think is the core problem that something like CBDCs are solving? And on the back of that, what are the important things to keep in mind to make sure missteps aren't taken with a new technology experimented for those use cases?
Well, I can speak to what people are proposing, and I do think there is a tension that our current payment system does not work perfectly. International remittances are very expensive. There are lots of unbanked individuals and households, say even in advanced economies like the US. And so I think there's a perspective that somehow CBDC might be a solution to that. There's a slightly more cynical take, which is that there's a role to preserve monetary sovereignty. That if a Facebook creates a digital currency, that could pose a risk to, let's say, the Federal Reserve in the US's ability to manage prices and employment in the economy. Which of those is the right perspective, I'm less clear about. I do think there's a fundamental kind of challenge in answering your question, Eugene, which is, if we believe there's this demand for private digital currencies, that's one thing a central bank can't compete with, right? If the goal is I want a currency that's not issued by a central bank, then creating a central bank digital currency is not going to resolve that problem, right? The way to resolve that problem is through traditional regulation, basically ban owning these currencies. And so I think we need to get at a core source of what is the demand for digital currency, private or central. And Philip alluded to in the EU case, especially on the business side, why there's demand for new types of central bank digital currency that is not just we want something not issued by the central bank. And so I think you have to resolve that issue in some way. So I'm curious to hear what Philip thinks.
Yeah, interesting perspective, and I also agree. I would like to add 2 more points here. I think there is some kind of international contest going on between regions, between countries, and I think there is some kind of contest or competition going on between potential other forms of monies, potentially also including Bitcoin, right? We see this happening in El Salvador, right? So there is some kind of competitive pressure. And I think central banks have had the monopoly for issuing money and controlling monetary policy for quite some decades. And this is now being contested, I would say so, by Facebook's Project Libra, by Chinese central bank, which is really pushing these topics now since here. They're basically launching next year, apparently. Then we have potential competition coming from decentral currencies. That's the case of El Salvador with Bitcoin. And therefore, I think central banks now find suddenly in a space where they feel, maybe they don't know it yet, maybe we all don't know it yet, but there is a feeling out there that in the future payment might be different, because at the end of the day, we as citizens would like to somehow keep our purchasing power. I can store gold, I can store euro, I can store dollars, Swiss francs, or Bitcoin. At the end of the day, I don't really mind, but I would like to be able to purchase my daily food and my rent, and I would like to keep my purchasing power for the future. And in case central banks cannot deliver this in the future, then I think there is the, let's call it threat, but it could also be a chance that citizens are turning away from this. And I think we should keep this kind of competition or contest in mind, which is in my mind now starting, and this contest could go on for the next years or maybe even decades. And another point I would like to make is the following with CBDCs, and now I'm referencing the Chinese version. They are now trying to build a solution where you can transfer the money across cities, persons, even across countries within a couple of milliseconds, right? So given the speed of the transaction is some kind of competitive relevant metric, then suddenly, for example, take an international corporation such as Siemens. Maybe Siemens chooses to onboard to the Siemens as a German company chooses to onboard to the Chinese system, because then they can transact money around the world within a couple of milliseconds, whereas they cannot do it in Europe, for example. So the competitive pressure of the performance of payment infrastructures can also drive central banks to move towards CBDCs. Another facet here would be programmability. In case one central bank or one currency is providing programmability for financial constructs in capital markets or for devices in the economy of things, in case companies are demanding this programmability, then they would like to have it. And in case, for example, the ECB is not providing this, then they turn towards programmable stablecoins or towards the programmable US dollar or to whatever currency out there, because they might want to have the programmability, because suddenly the programmability becomes one performance criteria where a currency and a central bank has to perform and deliver. And therefore, I think this could be a new area of competition which is going on, and we see this with Facebook's Project Libra or DM. Actually, nothing happened here, right? They have a technical infrastructure in place. They have done a hell lot of PR and work, white papers. But at the end of the day, up until now, in the last 2.5 years, not much happened in terms of real action and real solutions, right? But still, central banks are really kind of upset. They are now really investigating this topic, and that, in my mind, has been driven by Facebook's project 2.5 years ago.
Yeah, it's really interesting to think how those competitive pressures might be getting more groups to be thinking of this, and then directly them having a problem to solve that this is the best solution for.
I think I have an answer to that. I want to build on the a comment about where programmability fits into CBDCs. I think that the structure of central banks is quite interesting. When I was getting into how cryptocurrencies work and then learned about finance just by some low quality YouTube videos, it was very simplistic, like central banks are just central. But there's really a lot more to it. They actually are kind of closer to DAOs, the way they're organized. Like there is a central bank organization, but member banks and commercial banks as part of them have a lot of sway. So it's a lot more nuanced and complicated than that. And what I think this fits into is, I think that there is room for a really nice design of what I think would be called a hybrid CBDC, where this is kind of just expanding on this notion of CBDC as a platform. Like I can imagine that the central bank would essentially act as a platform and set some bare operating rules, maybe some system invariants, like no programming error for an application will be able to inflate in an unbounded way the base currency that the central bank is supposed to be managing. But in much the same way, like in the Ethereum blockchain, the rules of not printing more Ethereum are, no EVM smart contract you could write can inflate the amount of Ethereum currency it's built. Like that is an invariant built and maintained at the platform level. So I could imagine that the central bank would define some base rules like that, possibly for safety, possibly for regulation, possibly for base monetary policy. But then what a programming smart contract interface could do is leave it up to the member banks to be really flexible in terms of what kinds of extra functionality they define or monetary policy for their own tokens that are backed in some way by the central bank's base layer money. There's really quite a lot of flexibility that's available there. So I kind of imagine that may shape out into the role that this plays, where the member banks are responsible for the innovating, and that takes place in a programming layer of the infrastructure. The central bank is responsible for setting safety rules or regulatability rules or even just fair play rules, and that those would be enforced at the protocol level. So that seems to me to be the most, I don't want to say I could guess that that's the most likely, but somehow that structure just appeals to me and kind of makes sense.
Yeah, and I know we're getting close to time, so I'm going to let Ariel respond and then just ask a final question before we wrap up.
So I also want to follow up on Richard's question, which is, and if we look at experience in monetary policy, so where a digital currency has been extremely successful, say in an emerging market like Kenya with M-Pesa, it was a digital currency filling a role where there was a lack of institutions and infrastructure for doing payment services, especially not within a village, but across villages or across the country. There we saw a lot of success, and I think it was natural it came out of a private company, right, the cell phone providers, because they had established the technology to allow for these transfers. So it didn't quite make sense for the government to take on this new role of creating a whole new infrastructure to allow people to do better payment services. I think it's a very different question when we look at financial inclusion, say, in an advanced economy like the US, right? We have to really have a deeper understanding of why we have a large group of unbanked people in the US, right? If they're unbanked because they don't want any records of themselves, then we have to ask, and this goes back to Andrew's earlier point, right? What are the right design choices of a CBDC? And is that consistent with the US government's willingness to create totally private currency? You hear a lot of this, Treasury Secretary Yellen said this early on in her tenure recently, that I don't like cryptocurrency because it seems only used for nefarious purposes, and you paraphrasing. And you sort of ask, well, how do you feel about cash then? Because that seems to be the predominant use of physical currency these days also. So I wonder about this tension of what is the US willing to do in terms of a regulatory anti-money laundering, know your customer protocol for a central bank digital currency, and will that provide the privacy and security that the unbanked may want, if that's the reason they're unbanked? So without a real, again, in emerging economies, I understand why folks are unbanked, right? The infrastructure and institutions are not there. In advanced economies, I think it's much less clear. And so when you ask why is the Eurozone or the US creating CBDC for financial inclusion, I think it's a much harder case to make. So I'll stop there to leave us time for a last question.
And I just wanted to follow up with, I mean, just building on a number of statements that all of you have made, given kind of some of the current pressures that are in existence for a variety of reasons, but there's a bit of this race to roll out a CBDC. Some might be, from a certain perspective, potentially vying for, establishing the digital future reserve currency. We don't need to speculate on the specific impetus, but given all that has been mentioned in this panel so far, from a citizen's perspective, what should we be most worried about as central banks rush to figure out these new technologies and potentially deploy them? Do you have any specific concerns that are top of mind in your minds as these get rolled out?
Well, I think privacy is the number one. Privacy. We should, as citizens, try to force the institutions to keep privacy. That might not necessarily be for all kinds of transactions, but at least, like transactions below a specific threshold should be private, the same way as we have paper-based money, which is also private. And the second point is monetary policy can become dangerous because, for example, in Europe, we have negative interest rates, right? So you are putting money on the bank account and 1 year later you have less money on the bank account because we have negative interest rates. So negative interest rate can be pushed through much easier with digital infrastructure. And there is also a threat of money which can expire at some point of time. So you have to spend it. Otherwise, it's for whatever reason gone like a voucher. And there are a couple of design choices where I think we have citizens, but also the political parties and those people who are, let's call it, building or driving or governing the systems. You should really be warned that we should not have technology which would allow this.
Andrew?
Yeah, I agree with the way that you put that. I just think that there would be, my concern is that there may be a tendency to think that because the design includes blockchain in some way, that solves the problem of providing privacy for the individuals and accountability for the people running the system, but that's not a built-in guarantee at all. It's entirely possible to design a system that includes blockchain technology, but gets it backward, providing opacity and the ability to delete data or freeze accounts roughly unaccountably for the administrators, and that provides no privacy for the individual users. So you can't just rely on like technical destiny to assume that that's going to carry out the right way. I think it's really important to ensure that the designs that we have from the beginning reflect what we should be asking for in terms of rights to the citizens.
Thank you. And Ariel, any final words before we wrap up?
Well, not to sound like the nerdy macroeconomist here, but just to point out everything Philip said, academic economists might say are exactly a good thing. In theory, there's nothing wrong with negative nominal interest rates. A zero lower bound is a constraint on monetary policy. Alleviating that constraint is good. The experience in the Eurozone has not been great. So I appreciate Philip's perspective. A hot money where you get vouchers that expire can be a very valuable tool, precisely say in the midst of a pandemic. Overall, will that be used correctly by policymakers? We should be worried. So just to be a little concerned that it might enable the policy space in good ways. Could it be used in the wrong way? Absolutely. And I agree broadly with the point that we need to deeply understand what is the desirable level of privacy in developing these digital currencies, and our consumers, our retail, our citizens getting the appropriate mix of privacy and security from governments if they're issuing these. So.
Great. Well, we really just want to thank you all for taking the time to share your thoughts, opinions, and work today. For those who want to continue the conversation beyond this single recording, please feel free to check out the Smart Contract Research website, smartcontractresearch.org, where we're going to have a dedicated post to this panel. That post will include more work, links to the work of all of our panelists, how to get in touch, and also some broad information on this topic as a whole. I mean, there's so much we unfortunately did not have a chance to dig deeper on or bring up. So I definitely hope this is the first of many dialogues we'll be having around this topic. And I just want to thank you all again and hope all the listeners have a chance to enjoy the rest of the summit.
It's been a blast. Thanks for having us on.
Thanks a lot.
Thanks for your time, everybody. Really appreciate it.
Thank you, everybody, for that fantastic discussion on CBDCs. You guys will hear more from the Smart Contract Research Forum in coming panels and presentations and on the other stage as well. So keep your eye out for that. And that address again was smartcontractresearch.org. We're going to be going for the next sort of session here. I'm really excited for the next lineup of talks. It's extremely exciting to see who's next. We've got Sergey Nazarov coming up, Ben Chan, Alex Mashinsky, and many more throughout the day. And of course, that's the next 2 days. So make sure to stick around for that. We're going to take a brief break and listen to our good tunes in intermission. And when we come back, we'll be here with Sergey Nazarov. Welcome back to SmartCon #1 2021. Without further ado, I'm pleased to welcome back to the stage Sergey Nazarov, co-founder of ChainLink.
Great. Hi, everybody. Thank you for coming to the conference. I hope you're learning a lot and getting a lot out of it. A lot of thought and effort went into it, so I hope it's getting everybody what they want from it. The first topic I think I really want to cover is, how grateful I am to actually be working in an industry that has such a significant problem to solve. And I'm going to go into that in a minute, but I think the enormity of what blockchains and smart contracts can really do for society is something that I think it's important for all of us in this industry and in our community to generally understand and have a very clear picture of. Because in many cases, I think it's larger than some people assume. And I'm also kind of amazed that we're at a time in history where we can actually work on solving that problem. And so the problem that we're solving and the importance of solving it, I think, is something we should keep in mind as we spend, such significant amounts of time and late nights working towards making this industry how the world really works. So the nature of what I think we're all doing here is we're solving the problem of what is the truth and how does society work on the basis of trust. And while those are very vague notions, I hope to make them a little bit clearer in this presentation, and then to show some of the steps that we've taken and are continuing to take to solve for these immensely important kind of problems and issues and improvements that can be made to society. So really what you see here is a spectrum. You see a spectrum where on the one side of it, you have what I call just trust us paper promises. And throughout history, this has been much of the way that society functions. You've basically had banks, institutions, insurance companies, Ponzi schemes, and various other kind of conglomerations of promises and ideas provide promises on paper that there was no really firm commitment, no real reason other than a choice or desire to fulfill. And everybody is so used to the world working this way that it isn't really something people question, and it isn't really something people believe they have an alternative to. The fascinating thing is that they do have an alternative, and that alternative appeared in 2009 with Bitcoin and has since then evolved into more and more advanced versions of what we call cryptographic truth. So cryptographic truth is the ability to guarantee outcomes based on cryptography and physics and encryption and math, basically. So on one end of the spectrum, you have some kind of paper document and some people somewhere that say they might do something and you hope that they do it. And then on the other side of the spectrum, you have cryptographic truth, which is enforced by encryption and mathematics, and at the most base level, really physics. And it's that cryptographic truth that Bitcoin and decentralized infrastructure and Ethereum and smart contracts and DeFi is just a progressively more advanced version of. So this is the spectrum that I think society and really the world kind of exists on. And the right side of the spectrum just recently appeared. And in the scope of history, it's just appeared just like a second ago, basically. And we have the kind of really, I think, the immense privilege to be able to drive this technology forward to change the way society works. So what do I really mean by that? So if we look at this in a historical context, we see that since the invention of these paper promises in the form of banknotes in the 11th and 12th century in China, you had a number of different banknote schemes that were all, recycled or deprecated or no longer used because they led to massive inflation. They led to overprinting. They led to defaults. And, it went from the Jiaozi banknote scheme to the Houzi banknote scheme, all of which had similar inflation issues. And, banknotes were brought to the West by Marco Polo and other similar traders. And then eventually they made their way into Europe with the appearance of Stockholm Banco, which created the first banknotes in Europe. In a number of years, those banknotes were also overprinted, causing massive inflation and a default in only a few years. So not decades, but only a few years. You had the first banknotes in Europe from Stockholm Banco, leading to overprinting and a default. And despite that lesson, and really because there was no other way to generate agreements and to generate money and to generate all of these kind of relationships that people need to generate in society, the Bank of England, had their charter signed in 1694 and generated the Bank of England banknotes, which then kicked off a long set of events, a number of failures, a number of overprinting, inflation, and various other dynamics, which eventually led to the Great Depression of the late 1920s, early 1930s, which was only stemmed by certain very extreme policies, such as the FDIC, which allowed the government to actually bank back deposits up to a certain number. I think the number is something like $250,000 per deposit. And this has been the longer term history of these paper promises and where they originated. And it's been a very long history, and it's filled with basically the same story, right? The same story is, what a great idea that we can generate paper promises. Isn't that wonderful? Let's see how far this goes. Let's accelerate. Let's really accelerate. Oh, it's kind of going well. Let's really push the gas pedal down. Let's generate a massive amount of these things. Oh no, we overdid it. Inflation, defaults, paper promises no longer being honored. We can't honor the paper promises because, we pushed the gas pedal a little too hard and we did a little too much, and we don't actually have the collateral to honor what we said we were going to honor. And so, tough luck. That's the world of paper promises. And everybody has been living in the world of paper promises for so long that is the way the world is. That's just the world. And what I'm here to tell you, and what our industry is here to tell you, is that doesn't need to be the way the world works. The world can now work in a much better way. And that's the fascinating, amazing thing about this, is that the world can work differently. What are we doing in modern times? In modern times, I can't say we've necessarily learned from the lessons of history. In modern times, we are, in the timeline of history, modern times from the 1930s or the 1970s, it's not like a second, it's like a second and a half, right? So it's a blip, it's a very small blip. But in that blip, we're pretty much at the stage of, let's just push that gas pedal all the way down and see how far things take us. Throughout history, when that gas pedal has been pushed down, generally speaking, it's always led to the same place, just a recurring pattern of history that invariably leads to the same place. Now this suggests to me that in the cycle of just trust us, boom and bust, there's a boom. There's now still a boom. Everybody is, printing money. Everybody is generating credit and debt. There was a separation from the dollar and gold right after it became the global reserve currency, thanks to Bretton Woods. And the reality of this is that has to have a problem at some point. And everybody agrees with that. And already we're seeing inflation increase. Now, I think people don't fully maybe see the magnitude of how far that pedal has been pushed. It's been pushed pretty far. If you look at the graph here at the bottom from Fred, basically the point at which the US went off the gold standard and basically got the go-ahead to infinitely push that, the gas pedal, proverbial gas pedal for money printing, it has really accelerated. And the point is that this is what underpins everything, right? This is what underpins credit, debt, institutions, solvency, all of these things. And whether there's a problem with all this because there's inflation, or whether there's solvency issues for certain people, or whatever it is, every single indicator within the lessons of history shows us that we really pushed this gas pedal really hard. If you look at the central bank balance sheet as a share of GDP, if you look at the percentage of all dollars printed throughout the last couple of decades, over 20% was printed just last year. And then you think about the things that have been happening over the past 2 decades, both with the credit crisis in 2008 and the Greek banks denying access to funds in Europe back in 2015. I think you start to see that, the just trust us set of guarantees in various ways is fraying. And once again, the amazing thing is that there is finally, throughout history, there's never been an alternative, but finally there is an alternative to the just trust us model. And that is what we are doing, and that is what our industry is about. And that's quite an amazing difference. So I'll give you an example, a modern example, right? So a modern example of this is Robinhood. Robinhood is a TradeFi product that basically gives a just trust us paper promise that says, do whatever you want, whenever you want, just trade, just do whatever you want, just have fun. Good luck. Have fun. Okay, sounds great. People were doing that. Oh no. Turns out we can't do that. Why can't we do that? Oh, you didn't read the fine print. In fact, you did read the fine print, but we changed the fine print. That's what a paper promise looks like. That's probably the most modern, most well-known example. It's not any better or worse than the other paper promises that are out there. I'm just using it because it's the example that people know. But it's a very poignant example. It's a very clear example of, hey, I made you a just trust us promise. Nothing was forcing me to guarantee that to you. Nothing was forcing me to do that. Nothing was forcing me to actually deliver on the promise I made to you other than my desire as an institution or as an entity. And I didn't. I just said, hey, I can't, I'm not going to do it. Tough luck. Tough luck, everybody. Right? The just trust us tough luck era of 1,000-something years is now going to come to an end. Right? That model of just trust us and we'll do whatever we want is coming to an end. And that's a very, very, very different way for the world to work. For example, how does DeFi work in those situations? Well, in DeFi, you have certain cryptographic guarantees. You have certain code that is guaranteed to execute in a certain way. And what does that mean? Well, that means it's guaranteed to execute in a certain way, and you're not going to get away from executing it that way. That's quite amazing, because that means that no matter what anybody decides, no matter what the person who made the application decides or what someone else decides, you're going to get the behavior you expect from the financial system, for the financial product, from your assets, from your custody solution, from whatever. Never before in history could you generate that type of promise, that type of guarantee on the basis of math, physics, encryption. Never. No one ever could give you that guarantee until about 2009, where if you had a private key, you had control over something that no one else could stop you from doing things with because you had the private key. So that's a big deal. And I once again just want to underscore this so people understand what it is that we're doing here. Why does it matter? Why should we care about blockchains? Why should we care about oracles? Why should we care about smart contracts? It's not just about finance, and it's not just about gaming, and it's not just about insurance. It's about the way the world works. And the way the world works influences everybody. It influences developed markets. It influences emerging markets. It influences the average consumer. It influences institutions. It influences everybody. And at the end of the day, the way we're going to make the world work, and the way we're already making the world work to the tune of over $1 trillion in our industry, is cryptographic truth. That's the alternative. In cryptographic truth, there isn't some person somewhere that decides what happens. There's math, there's encryption, there's physics. And as long as physics and encryption and math works as expected, which is about probably the best guarantee you're going to get in this world, you're going to get what you expect from the financial system, from an insurance product, from a gaming system, from an ad network, from whatever. That's so different that people who aren't used to considering that, I think many times can't even process the full difference. But the difference is like night and day. It's the difference between having assurance that something will happen and having the possibility that it won't happen. And I have to tell you, in every single case where I've made this distinction clear, with every enterprise, every startup, every individual person, I have yet to meet a person that is going to tell me, I would prefer a just trust us promise where, things can get switched up on me at any moment. Just switch them up. It'll be fun. Nobody has ever said that to me once they understand the distinction. And that gives me an immense amount of surety that if we are able to provide cryptographic truth to the world in an easily consumable, secure, easy to use, easy to implement manner, then that is how the whole world will work. Because nobody so far has ever told me, no, I would just like the paper promise where, I could be screwed. Let's just do that. Never heard that once. This is why our vision at Chainlink Labs and what we hope Chainlink will do is build a world powered by truth. So we've done some work internally to solidify in the simplest terms possible what it is that we're doing, what we're hoping to achieve with the Chainlink open source project and community and network. And this is what we're hoping to achieve. We're hoping to build a world powered by truth, specifically cryptographic truth, but really to build a world powered by truth. As you can tell, this is rooted in our fundamental belief that truth is better than false, paper-based trust, right? So if you have the truth, you can build systems around it. If you have to just trust some paper promise, some institution, some whatever, that is strictly worse. That is inferior. So truth is greater than trust. That's what we mean when we have this statement. This is at the core of our fundamental belief system. And how we're seeking to achieve this is to build decentralized systems that link everything to truth, creating a fair, unbiased world. So that's fundamentally what Chainlink Labs does. That's what the Chainlink network will hopefully achieve, is become a set of decentralized systems that link everything to truth, creating a fair, unbiased world. And that is going to be a world that's much better to live in for everybody. For developed markets, because there aren't just a small number of people that can just take money from society and everybody else, and in emerging markets, because they'll finally have access to agreements and contracts and capabilities that they never had access to before. So this, I think, is a very worthwhile goal that we have. This is how we're approaching it. And I just thought in the first few minutes of the presentation would be useful for everybody to get on the same page of why this is important, how we're seeking to achieve this, and what it is that our fundamental beliefs are in terms of what we're working on, and ideally, I think also in this industry. How is this achieved? So this is achieved through creating more and more advanced hybrid smart contracts, right? So something that people, I think, need to understand is that the more advanced smart contracts become, the more industries, the more use cases, the deeper into existing industries technology from our industry goes. The more smart contracts can do, the more blockchains are involved in the financial kind of world. The more blockchains and smart contracts can do, the greater share of gaming is powered by them. The more smart contracts and blockchains can do, the more of the insurance world is powered by them. This is what we're doing. We are seeking to extend and augment and improve and enable and help build an entirely new, more advanced class of smart contracts that extend what blockchains and smart contract platforms like Ethereum and others are used for across many industries. And this will massively expand the pie. It'll grow the pie, it'll grow the market, it'll grow what our industry is about, and it'll make blockchains and smart contracts the source of cryptographic truth for how the world operates. And that's our fundamental goal, to transition the world from a paper promises, just trust us, hopefully it's going to work out model, to the cryptographic truth model that, in my opinion, requires smart contracts to be able to meet the operational demands of the financial industry, the insurance industry, the gaming industry, and all subsequent industries where it will fundamentally change how they operate. Now, this works on three fundamental levels. You have the blockchain, which is kind of the root of cryptographic truth and trust that secures the state, secures the truth, secures the trust dynamic of the state changes. You have the off-chain world of trust minimized off-chain computation in the form of decentralized Oracle networks, which is what Chainlink specializes in. And then you have the world of existing systems, existing services, data providers, existing backends, existing payment systems, all the world's existing infrastructure for data, payments, backend computation, backend systems control, access control, so on and so on. Now, we in our model have divided up the off-chain portion of the world into three distinct categories, which I will be going through today. The first category is off-chain data, the second is off-chain compute, and the third is cross-chain compute. In terms of what this actually means, you already see all of this happening. So you already see multiple off-chain services powering DeFi, powering gaming, powering wrapped assets like WBTC. You basically already see the ability to provide price feeds, weather data, proof of reserves, random number generation to various protocols that all then interoperate with each other you see their existence appearing because you have these services. So I'm very, very proud to say that our many long nights of effort and work by everybody here in the Chainlink ecosystem has already resulted in a significant change in our industry, has already resulted in a significant improvement of what our industry does, and has already grown DeFi well past what it was when we started, and is now growing other sectors of the blockchain economy by allowing people like weather insurance, insurtechs, and gaming companies, and custody providers to join into the benefits of using cryptographic truth in blockchains. And DeFi is just the initial example of this, which is really just getting going. But if you look at the model is multiple off-chain services being used by on-chain contracts that interoperate with each other to create really advanced applications, which then go into these finance industries, insurance industries, gaming industries, global trade industries, and begin to redefine those industries and begin to pull more and more value, more and more contractual transactional volume into the contracts, because the contracts can finally service the requirements of that industry, thanks to this combination of off-chain systems together with on-chain advanced code, which is enabled by the off-chain systems. So we are already doing this, and we're very, very proud of that, and I think we should be very proud of that. Our fundamental goal is to create a global standard for enabling cryptographic truth by augmenting blockchains, improving what blockchains do, enabling blockchains to be more useful, enabling smart contracts to do more. In the history of global standards, I think you see a very useful pattern in that HTTPS, as an example, what is it built on? It's built on being an open source standard that had the first best technology, that was built on superior security, and now it services most web traffic. Similar story with Linux. Open source standard, innovative first mover, built on better security, services most web servers. With Chainlink, what we are working on diligently and kind of feverishly at this point is making sure that it's the global open source standard. We are clearly the innovative first mover that's actually accelerated certain industries like DeFi into what it is today. We are definitely built on better security based on the preference that everybody has in using our data and our other services. And as you can see, we service more smart contracts and are rapidly adding to that list. So our fundamental goal is to create a global standard that will change the way that our industry is used, improve society, improve how the world works, and write our name into history in the process, just like HTTP is, just like Linux. That is our fundamental goal. That is the kind of journey that we're on. That's what we're focused on doing. Luckily for us, we have the resources to do that. We have over 250 people working on that at Chainlink Labs, and lots of other people and lots of other teams building that. And we have a huge community of users and node operators and other really smart people collaborating to make that happen. But that is the fundamental goal of Chainlink, to become the global open source standard for how cryptographic truth is enabled on top of blockchains, on top of smart contracts, to make blockchains and smart contracts useful for the larger world. And there is certainly a lot that they are useful for. Now, if we look at this in a very general initial sense, what we really see is various services, various decentralized services, enabling distinct industries that would not exist and could not properly function without those decentralized services, serving them in the secure, reliable, low-cost, high-speed manner that they are. Now, the first and best example that we're known for about this is price and market data, which, as many of the people that we work with and many in the community know, has accelerated and allowed the DeFi industry to grow into what it is today, which is why we serve the largest lending protocols, the largest derivatives protocols, the largest insurance protocols, and why when they launch new markets, we make sure that they have the secure, reliable data that they need. This is done through a complicated system that was architected with a secure systems design set of principles that other solutions don't seem to have, and that have been tested over time against flash loan attacks, congestion to the tune of 2,500 gas, which we have always overcome by putting in updates while other Oracle systems have not put in updates, and various other innovations that make sure that our systems operate. This is why the majority of DeFi uses us, and why even more DeFi applications are automatically integrating us on their own to make sure that they have a reliable system of data. Now, what this has shown us, this initial interaction with DeFi, which is now still, in the 70 to 100 billion market size range, which is very, very small compared to where I think it will be, is that all of the world's financial contracts, financial products, financial incentives, ownership rights, carbon credit systems, insurance processes will eventually be in a smart contract. That is what I personally believe very, very strongly. There is absolutely no reason why they wouldn't, if we as an industry can make the transition of carbon credits, derivatives, capital markets, real estate, commodities, insurance, if we can make all of those industries able to transition to blockchain-based smart contracts, to hybrid smart contracts, to Oracle-powered systems and smart contracts, that is what we can achieve. And when we achieve that, the same diagram you saw for DeFi, where different DeFi protocols are composable, will take place for all of the world's markets. Whether that's carbon credits or capital markets or insurance markets or commodities markets, it doesn't matter. They all want to function in this hyper-reliable way. And the DeFi world is a microcosm of that. It is a precursor. It is a signal and a sign and a picture, an early picture of what is to come. And I personally think that this is inevitable. It is completely inevitable. The only question is, how quickly can we do it, and how quickly can we get it to benefit emerging markets and to benefit developed markets? And my other personal belief is that the speed at which the just trust us guarantees of society fail, and the just trust us, model begins to show that it doesn't fulfill people's expectations and needs as consumers, is also going to accelerate this. But this is where everything is going. After enabling all of this DeFi stuff, after seeing how it interoperates, after talking to multiple banks and various other institutions, all of the world's contracts will be a collection of services interoperating with each other across a number of different chains, vertically focused chains, geographically focused chains, private chains, public chains, but they will all be on a blockchain because of this superior cryptographic truth guarantee that they don't have anywhere else to get, and that they will desperately want the more that the just trust us paper promises world shows its inability to guarantee solvency, reliability, and just, to be unpredictable generally. People don't like unpredictability. They like guarantees that are actually fulfilled. And that's what our industry is about. Our continual goal is to provide more and more and more services. More and more services means more and more smart contracts. More and more smart contracts means more and more usefulness for various industries. More and more usefulness for various industries means more and more adoption of smart contracts. And that is the cycle. That's the virtuous cycle. The more we can enable smart contracts to do, the more useful things they will do, because they do extremely useful things. And then the more they'll get adopted, which will lead to even more services being in demand. Proof of reserves is just one simple example. It's the ability to replace a one-year audit process that has historically failed society, whether it's through Enron or Wirecard or any number of other examples. That one-year auditing process where everybody's buddies with the auditors and the auditors missed something or didn't see something or, were somehow having a conflict of interest. That one-year audit window, I got to tell you, if you give people a choice between a one-year audit and a 1 second audit, automatic audit with cryptographic truth, proving every single thing that was audited and that the place where it came from proved that the assets were there, that they were at a certain value, that they were in a certain state. I don't know a single person who's going to tell you, I'd like a one-year audit. I'd like a year of risk. Give me a year. I'd like to take risk for a year. Nobody will want that. Everyone will want automated cryptographic truth-based audits. And you already see that from the organizations that understand how cryptographic truth can allow them to provide better guarantees. Now, once again, that's initially crypto firms, certain fintechs, right? Certain CeFi. But the fundamental kind of proof and cryptographic truth benefit compared to other things is just, hundreds of times better. And everybody can verify it. In our proof of reserve schemes, everybody can verify the assets that certain stablecoins have in bank accounts, in gold vaults, on a block by block basis. So block by block, you know what's backing a stablecoin because it was proven to you by a data source that, shows that. And what does that do? That makes it so that if anybody wants to under-collateralize that stablecoin, what do they know? They know that they will be discovered within 10 seconds. That's not a year. You can't take some money and hope to put it back in 10 seconds. It's 10 seconds. That's another example of a difference. And beyond that, it just expands, right? So highly validated data is the first category, where once you generate highly validated cryptographic proofs about what's going on, you can then prove what is true, what happened, what didn't happen. And then around that truth, around that cryptographic truth that was proven through a definitive method of generating a consensus about what happened, you can then build all kinds of systems, all kinds of innovations, all kinds of things that weren't possible previously. And this is the amazing initial step that we've taken that has given birth to DeFi, given birth to proof of reserves, given birth to some decentralized insurance products, better versions of fraud-proof gaming. Here are just some examples. One of my favorite examples, quite simply, weather insurance. Based on what's happening with the weather these days, I think you can see why it's one of my favorite examples. People need weather insurance. There's a flood there. There's a forest fire here. There's rising sea levels there. There's lack of rain somewhere else. That's not going to stop, first of all. Second of all, how do people manage that risk in places that don't have insurance companies? What do? They pray. They pray to the rain god. That's very nice, and they should do that if they would like to. But, that's not really going to work if there's no rain. That's not going to give them solvency. That's not going to allow them to continue being an emerging markets farmer. You know what they should do? They should do whatever they want to do to help make rain happen. And then they should have cryptographically guaranteed insurance that doesn't depend on their local legal system. The only thing it depends on is them having a $50 Android phone in their hand and internet access. And then all of a sudden, through insurtechs like Harbol, you can suddenly have people in all kinds of parts of the world where their local legal system doesn't work. The insurance companies aren't going there. The ones that would go would be predatory. There's payday loan people who are predatory. There's banks that are highly predatory with just crazy usury rates. And they can just sidestep all that because you now have a system of contracts based on cryptographic truth. We can verify whether there was rainfall. They can sign up for the insurance with the cryptographic proof, and they can automatically be paid what they're owed, not because an insurance company says, I feel like it, but because it is enforced by math and physics. And now somebody with a $50 Android phone and an internet connection that hasn't heard of an insurance company up until now can have better insurance guarantees through cryptographic truth than people in developed markets that are still stuck with paper promises. That's unbelievable. And more importantly, that will completely change that person's life. That will allow them to continue being a farmer, or it'll allow them to continue, selling meat or building construction things or whatever they're doing. And this is the underpinning of society that isn't seen by people, but which underpins how society works that we're changing. This is partly dependent on our ability to generate these cryptographic systems, our community's ability to help build Chainlink, and the inclusion of data providers. And I'm really encouraged to see large and impressive weather providers like AccuWeather basically going on and running their own Chainlink nodes and providing their data to various blockchain networks eagerly in order to service all of these smart contracts. Because there is a huge world of data, and everybody does want it to be used to achieve these critical, massive changes in how society works. And the place where that is going to happen is the smart contract state on blockchains. And all we really have to do as an ecosystem and as a project and as a group of people is make that happen. We have to get the data and the things that all of the smart contract developers need in order to build the future and to build this cryptographically truth-powered world. We need to get it to them. We need to give it to them in a secure, reliable, decentralized way. And if we're able to do that,
It'll change our industry. It'll change the way the world works. And, I personally think it'll make ChainLink a global standard, which is once again our goal. Other examples of this are very straightforward. NFTs. NFTs are really impressive. They're great. But even more impressive are dynamic NFTs that are updated by what happened, right? So if you own some kind of sports-related NFT, with the help of Chainlink networks and the data and sports data, you can keep it updated, and the value of that NFT can be tied to what's happened in the real world. That's called the dynamic NFT. So that's a great gaming example. Other examples are things like identity, where you're able to verify identity for something like a decentralized domain system like Unstoppable Domains through Twitter. And you're able to connect various points of identity to a domain system like Unstoppable Domains or Ines or others. And identity is something we're working on, is another source of data. But this is just to highlight that there's large varieties of other data that will continue to generate large varieties of other critical use cases, which were previously unavailable, and will once again reinvent what our industry is about. And that's what I think we should all be focused on, and that's what I think we should be doing. The next part of this chapter in enabling developers to build more and generate even more impressive things is off-chain compute. Now, when I say off-chain compute, I mean trust minimized off-chain compute. I mean off-chain computation that isn't done in a centralized web server, but it's done in an Oracle network in a way that creates some degree of trust minimization so that you still have decentralization around the computation, but you can still use it to do things other than what you would do in a smart contract. This is an entirely separate category where so far we have generated randomness very successfully for many gaming applications. Now we are moving on to keepers, automation, and more advanced off-chain compute. And beyond that, there's expanded computation like FSS. So far, in less than a year from going live, the verifiable random generation systems that we've put out are now generating over 200,000 VRF requests per month for many of the top games in the blockchain industry. And what that shows me is that not only is data and the access to various data, identity data, weather data, price data, market data, location data, whatever data, not only is data a critical component of building more advanced smart contracts, but computation and certain specific types of computation that need to be trust minimized are also a key aspect of building smart contracts in an advanced, more useful way that's going to reinvent our industry and reinvent how the world uses what we're building in this entire industry. This is why we are today announcing that Chainlink Keepers is going live on mainnet. Chainlink Keepers has been in the works for a while, and it has been open beta for some time, just kind of soak testing it and making sure that it's secure and ready. And we're thrilled to say that today it's going live on mainnet and basically launching for use by all of the DeFi apps out there, and will be coming to all the blockchains where we integrate pretty rapidly. Now, Chainlink Keepers is fundamentally the ability to give a computation to something called a keeper network, to give a computation that isn't something you can do in a contract or you want to do in a contract for either capability reasons, the contract can't do it, cost reasons, the contract would be too costly to do it it would be too costly to do it in a blockchain, or sometimes privacy reasons. The other reason that we found is realistically, just like you had a centralization problem with data, where people would run their own oracles and those oracles could fail, and that failure could lead to a DeFi protocol being, underwater or dislocated from markets or dislocated from reality. It's very much the same situation with keepers. You have developer teams and developer communities that are building a great DeFi application, a great gaming application, but they don't want to build infrastructure and they don't need to build infrastructure. And that's the problem we need to solve for them at Chainlink. And the Chainlink network needs to be built to solve by the larger community, by them together with us and so on. It's a matter of providing a decentralized system that you can offload the responsibility of off-chain computation to, while still having those off-chain computations have a measure of decentralization and trust minimized guarantees, right? So the way it really looks is, hey, I'm a smart contract development team. I know I'm going to do 1,000 contract calls about a certain topic, whether that's telling the contract what time it is. For example, smart contracts can't know what time it is. They need server. They need a central server to tell it it's midday UTC time to settle, time to execute. Even that level of information isn't available to the contract, just time. And so these developer teams know, hey, I am going to have 1,000 plus interactions with a smart contract. Man, I hope I can keep my server running. Man, I hope I don't miss one of those, because if I miss one of those, it'll be really, it'll be a real problem. So instead of having to do 1,000 of those and not being able to tell their user base that they're giving them reliable guarantees, now they can quite simply say, here is one upkeep request into the Chainlink Keeper system, into a single Chainlink Keeper network. And then that Chainlink Keeper network will do thousands of ongoing DevOps, off-chain compute, and other transactions. Now, why does this matter once again, right? Just to explain this kind of slightly esoteric problem. Why does trust minimized off-chain compute matter? Well, once again, when you're building decentralized secure systems, you need to be secure and decentralized and hyper-reliable end to end. So you need to be hyper-reliable when the gas price is at 2,500. You need to be hyper-reliable if a server somewhere goes down. You need to make sure that your systems run in all market conditions, in all network conditions, because that's the nature of blockchain-based applications. You need to provide that cryptographic truth guarantee that under all circumstances, you will be able to generate the outcome the application says it will generate. So how does this look when everything's okay? Well, when everything's okay, the smart contract development team, is triggering things based on time, maybe doing limit order execution through their interface, maybe doing automated liquidations, maybe doing some smart contract DevOps requests. Someone on their team is maintaining a central server. That central server essentially decides how the application will and won't function because it controls certain key outcomes of what the smart contract application is able to do. And that is a very, very striking parallel to oracles, right? Data oracles. Same exact story. Guess what? That's a bad idea. Same reason. You don't want a centralized system controlling your contracts, whether it's for data or telling it what time it is or triggering it for various key events that you would ideally offload. And the place where that starts to get shown is when gas does go to 2,500 and transactions aren't being broadcast, or your centralized server fails, or an adversary finds out how to DDoS your one centralized server, and all of a sudden you're not broadcasting DevOps transactions to your smart contract. Those are all very exploitable, very risky things that Chainlink networks expressly eliminate, right? They expressly eliminate the congestion issues, the network issues, the market-based issues, the exploit issues, all of those. And that's been proven, which is why, once again, the Chainlink networks that provide data, hundreds of those now exist, going to thousands soon, and those networks provide that data under the same set of guarantees that Chainlink keepers will provide to the applications that now need a reliable method to compute key computations that the contract cannot do, but that have to be done in a decentralized, trust-minimized, hyper-reliable manner. And so that's the fundamental role of keepers. And this, once again, serves the purpose of, firstly, unburdening the smart contract development teams from having to do this so that they can focus on making a great DeFi, gaming, or insurance application. And secondly, providing an end-to-end decentralized guarantee for how the application functions. And this guarantee is what all of this is about. All of this is about a decentralized smart contract with end-to-end security, end-to-end decentralization. This is what end-to-end decentralization looks like, not this. Now, here are some examples to provide clarity. So in the case of Aave, we're working with them on reliably managing the liquidations in their protocol to make sure their protocol remains solvent. That means that the various liquidations that need to happen for their protocol to remain, above water and solvent and usable will now, in many parts of their kind of smart contracts, be done by Chainlink keepers that will provide guarantees about liquidating those things, about getting transactions in about that, about properly monitoring that. And that's a critical aspect of keeping the Aave protocol working properly. In the Synthetics case, it's about staking and fee distribution. And so there needs to be a mechanism to properly stake, give out staking rewards, fee distribution, and so on. And this is a very, very clear need in many different applications where a keeper network is now going to take on the role of making sure that that part of the application works properly as an off-chain trust minimized computing resource that's configurable by the synthetics community and the synthetics team, and through whatever set of processes that community has. And then another final example is Pool Together for something as basic as starting its games and ending its games on the basis of time, right? So instead of the Pool Together team having to initiate these critical aspects of their game, they can now offload this responsibility to a hyper-reliable, decentralized computing system in the form of a Chainlink network that's committed to doing this, just like it's committed to providing data and under the same set of hyper-reliable systems guarantees, in reliable systems. So this is a big, big improvement for what smart contract developers can build today. They can offload a massive amount of DevOps, a massive amount of automation, a massive amount of computation that their team has to do internally. And they get their developer resources back. Their protocol becomes more decentralized, and their protocol can prove more cryptographic truth to their users. So it's just a benefit all around, accelerating what can be built. The more expansive vision of Keepers that I'm truly excited about, and I'm already starting to see certain protocols taking advantage of, is the ability to actually offload certain amounts of computation into a Keeper network. So the way that this looks, and in practice it can actually be done today at this very moment, is the broadcasting of a smart contract on chain into a network like Ethereum. That contract that was broadcast and deployed on chain then can be split into two equal parts. It can have a portion that is supposed to be executed on the blockchain network, and then it can have a subsequent portion, maybe even a very large portion that would be extremely costly to run on the blockchain network in the Keeper network. So the Keeper network, basically at no cost, or just like web systems cost, just base minimal hardware and web traffic cost, which is like the lowest cost you're going to get for any computation, can now execute a portion of the code that was broadcast and deployed on chain. Now, the benefits of this are twofold. Firstly, you've deployed the code on chain, so everybody can verify what the Keeper network is going to compute for you. That Keeper network is only for that contract, and it is not going to compute anything else for anybody else. It's not going to do anything else. It's a distinct service that only computes that piece of code for that one contract on a committed SLA type of basis. And so everybody knows this Keeper network has committed to run that code, which has been deployed on chain. So now you know that this trust minimized Oracle network is committing to run that code. So you have certain assurances and certain cryptographic truth and certain transparency there. And then the Keeper network runs that code. So if you had a contract that you wanted to make more robust, you didn't want to pay a lot of Ethereum fees, or you wanted certain privacy about that code, guess what? You can broadcast it, and then you can have it run in the Chainlink Keeper system. And the Chainlink Keeper system can look at a multitude of on-chain and off-chain activity. And this is a very, very extensible capability that we already see some of the protocols we're working with that are using Chainlink Keepers doing. We're seeing them basically say, hey, I want a more robust, more advanced hybrid smart contract. Here's what I want happening on chain for cost or speed or whatever other reasons. Here is the code that I want to run off chain in a trust minimized way. And here's what I needed to do. I needed to tell me the time. I needed to go get some data. I needed to compute some things. I needed to compute something else. Once you see the results, I needed to monitor a contract somewhere and then do something based on that monitoring, because smart contracts, can't even really monitor each other unless they're kicked by a Keeper system. And so this is extending to a very large degree what smart contract developers can build with a trust minimized system that generates cryptographic truth on that topic. And so that's quite an amazing innovation, in my opinion. And I think it's going to generate a lot of very advanced use cases. Now, if this is something that you would find useful, if you're a developer, if you're building various blockchain-based applications, I think you should really check this out. This is a decentralized, easy-to-use form of off-chain computation that in a matter of minutes can allow you to offload some of your centralized responsibilities to a decentralized system that you can configure. You can add more nodes, you can add less nodes, You can expand what the nodes are computing for you, and you can prove all of that to your users so they know that this portion of your smart contract is not run by you, is not in a black box, but it is in this cryptographic truth, decentralized, completely end-to-end provable model, which is the model that I think everyone here is going towards. The next aspect of what we're working on, and what I think it's important to say, is the cross-chain compute aspect, right? So there's the off-chain data and the off-chain services and the off-chain payment systems that Oracle networks allow contracts to use. There's the off-chain compute that you can't do in centralized systems because they don't have a trust minimized aspect. You need to do them in some kind of trust minimized Oracle network-like system. But then there's also the cross-chain aspect. And the cross-chain aspect is actually the way to make some of the most advanced smart contracts, and really the smart contracts of the future, what we call cross-chain dApps or cross-chain smart contracts. It's the ability to string together multiple smart contracts from multiple chains using one smart contract, for data. Maybe there's a supply chain blockchain somewhere with data about, what's going on with a good. Maybe there's another blockchain somewhere that you want to do a payment in. Maybe there's another blockchain where the contract itself operates. Then maybe there's 5 other blockchains that you want to use to generate various DeFi, DeFi interactions. This is why, we're quite proud and very excited to be announcing CCIP. So CCIP is something we've been working on for many years. In our initial white paper, we made it very clear that we want to support all leading smart contract networks for both off-chain and cross-chain interactions. And CCIP is similar to TCP/IP and other protocols that seek to provide connectivity and seek to make disparate different systems work under one messaging and under one communications standard. So CCIP is really about creating a global open source standard such as TCP/IP or others that will allow blockchains to interoperate with each other, will allow smart contracts from different blockchains to send each other commands, and obviously enable the movement of tokens between chains. And this is the final piece of the puzzle that we are now very, very focused on and have already been working on for years, about how we want to enable a truly cross-chain set of smart contracts where all the different features of all the different blockchains and all of their different capabilities really need to be something that we give people access to. Because giving people and developers the ability to generate a smart contract on Ethereum, use DeFi protocols on other chains, send a payment on a Hyperledger payment system, maybe get collateral in Bitcoin, or do whatever complicated combination they want to do, is something that will unlock an entire world of innovation in our industry. It will unlock an entire new set of applications that were previously not available and previously not possible. And that's why we're doing this, right? We're doing this because we want to enable hybrid smart contracts to reinvent how the world works through this collaboration between different smart contracts, different chains, different capabilities. And we are positive, and we already see a huge demand for the ability to use multiple applications on multiple chains, multiple services on multiple chains, multiple smart contracts on multiple chains. So this is now the expanded definition of a smart contract, right? The initial definition of a smart contract might have been a tokenization contract, and that's it. And then it expanded to a tokenization contract with a voting contract. And then it expanded to a tokenization contract with a voting contract that uses a data feed. That's DeFi. And then it expanded to, tokenization, voting, off-chain data feed through an Oracle network like ChainLink, and maybe some off-chain computation. That's more advanced DeFi. And now, with the help of the work that we're doing on CCIP with the large and growing community of contributors and thought leaders working with us, I think what you'll see is that a smart contract will actually be defined by a tokenization contract, a voting contract, a multi-sig contract, a few off-chain data feeds, a few off-chain keeper systems that do computation, and a few other contracts in a few other places that provide distinct services and tokens and DeFi and other capabilities. And that will be the definition of a smart contract. That will be what a smart contract is. And that will be better for everybody, because the amount of capabilities that are going to appear from that is once again going to grow the industry. It's going to grow the industry based on the usefulness that that's going to provide to the entire blockchain ecosystem, to the entire world. And once again, that's our goal. Our goal is to grow the usefulness of the industry, just like DeFi has grown the usefulness of the industry with the help of off-chain data. And that's going to be a recurring pattern. More off-chain services, more off-chain capabilities, more advanced smart contracts, more useful things for society, more users coming in and building things, using things that have blockchains. And eventually, it'll lead to a larger kind of societal and collective consciousness understanding of cryptographic truth. Because if you're getting cryptographic truth in one part of your life and you're not getting it in another part of your life, you're confused, right? You're thinking, hey, I have all these great cryptographic truth guarantees in my financial part of my life, but my insurance company isn't giving it to me. I don't think I like that. That's what all of this is going to result in as we gradually provide capabilities to developers and they gradually build more advanced smart contracts. That's how we get our industry from 1.5 trillion to hundreds of trillions, to powering how the world works. Now, one concrete example of this that I'd like to walk through is our work with Celsius. So we're very proud to be working with Celsius, who has over 16 billion in total value locked in their systems, and close to 1 million users using them to generate yield on their cryptocurrency. Now, Celsius is an interesting organization, an interesting company, because with our help and with our collaboration, they're actually combining certain centralized systems with certain decentralized systems on a progressive and more rapid basis. And one of the things that CCIP and the ability to bridge value into other blockchains will allow them to do is it'll actually allow them to use various DeFi protocols such as Aave. And it'll allow them to use those protocols on different environments like Ethereum or Arbitrum or others. And so Celsius's plan, and I think this is going to be the plan of many different user-focused applications, and eventually the plan of many banks, and eventually the plan of many fintechs, is how do I interoperate with all of the useful smart contracts in all of the environments that can provide value to my user base? And more importantly, how can I do that with the most security and with the minimal technical investment? Both of which the CCIP standard and our approach to programmable bridges provides, which I'll go into more detail here. So generally speaking, what you're going to be seeing with the CCIP implementations is people like Celsius sending both commands and tokens to a CCIP-enabled programmable bridge. And what programmable bridge means is that they will send both the tokens and the instructions of what to do with the tokens to the bridge. The bridge will then move the tokens into relevant protocols according to the instructions that were given to it by somebody like Celsius. So the bridge is not just moving tokens and saying, good luck, I hope you know where to send them, or I hope you know what to do on whatever blockchain. The bridge is accelerating the speed at which Celsius and other cross-chain dApps, right? Because in this case, Celsius is very much becoming a very, very cross-chain enabled dApp and kind of collection of centralized and decentralized systems. It enables them to rapidly both send tokens and send the commands and instructions of what to do with the tokens, which means they don't necessarily need to deeply integrate with anything. They just need to send the tokens and the instructions. And now they can easily utilize not only multiple chains, but multiple smart contracts on those chains, such as Aave. And this is a huge benefit for everybody. So the first thing that it does is it allows Celsius and their users to gain access to all these different chains and all their different smart contracts. And the second thing that it does is it provides massive amounts of value to those protocols on those blockchains that want to interface with that user base, right? So Celsius has a user base of close to 1 million users with 16 billion total value locked. That's growing pretty rapidly. Aave has an amazing lending protocol that can reliably and with the help of various cryptographic truth guarantees provide a lending dynamic that other systems that Celsius has access to can't. And Celsius's users may want to use Aave, and they may want to get their yield from there, and they should absolutely be able to do that. And more importantly, they should be able to do that on all the blockchains where Aave has lending markets, because one of the lending markets might be better, or one of the lending markets might be about something that isn't somewhere else. And so this is an example of a cross-chain application that is leveraging CCIP, leveraging programmable bridges to get to the next stage of building advanced smart contract applications. And this is the picture of what's to come, because they're leveraging external data, they're leveraging the cross-chain interoperability protocol, CCIP, they're leveraging programmable bridges, and what it's getting them is a more transparent system that proves to their users with various sources of cryptographic truth what's going on. It's allowing their users to use more applications and get more useful outcomes from various smart contracts. And it's fundamentally kind of changing their relationship with the entire blockchain industry. And so this is what we want to achieve with CCIP. Generally speaking, CCIP is a part of a larger stack with a number of different stakeholders and a number of different community members and a number of different kind of parties that need to fit into a larger holistic model. And that holistic model, is basically based on our viewing of it on these, 4 levels. And then it has 1/5 kind of critical aspect and system that we provide on the right here, the anti-fraud network. So the first level is the consensus and transport level. This is the computing infrastructure. This is the physical computing environment, which is, not surprisingly, the ChainLink networks, right? The ChainLink networks using OCR 2.0 will be able to generate even more efficient computations on a greater amount of topics. So OCR 1.0 was the protocol we released to increase the efficiency of ChainLink's ability to deliver data by over 90%. So almost a 10x increase in efficiency, which allowed us to scale the amount of ChainLink data-related networks to hundreds and soon to thousands, and which allowed us to really generate a faster response time, a cheaper response time, and so on. OCR 2.0 is going to have an even greater, it's not going to have a 10x improvement on efficiency, but it's going to have a very large improvement on efficiency. And more importantly, it's going to provide a more generalized computation capability for things such as signature aggregation about events on various blockchains. So OCR 2.0 is the consensus methodology at the core of the cross-chain bridge and at the core of the ChainLink networks that will be generating the consensus to approve various transfers between chains, whether those are messages or whether those are tokens. Now, the other thing that OCR 2.0 does is its efficiency gains allow us to add even greater amount of nodes. So if you've seen some of the things going on today at the conference, you would have seen large enterprises like Swisscom joining the ChainLink network and becoming node operators alongside other node operators like T-Systems from Deutsche Telekom and other enterprises in the future. So what you're really seeing is the highest quality validator set, the highest quality node network in the blockchain industry is only going to become more high quality. And OCR 2.0 is going to only allow a greater and greater conglomeration of larger and larger node networks. And so if you look at the other cross-chain bridges, you'll see 2 things. You'll see certain cryptographic mistakes about how the protocol is built that have involved losses of funds in the tens of millions because certain cryptographic primitives were improperly connected and the fundamental principles of the design were flawed. And then you'll see node networks in the single digits. And node networks often made up of a relatively small amount of node operators that are either anonymous, so you don't know who's controlling the cryptocurrency, or individuals, just a single person who doesn't have a security background, who doesn't have a DevOps background. Obviously, those people can join ChainLink networks and can make ChainLink networks. But if you're going to have a physical compute infrastructure, a decentralized infrastructure that eventually secures trillions of dollars in value, you want to have a system that gets you the best node operators, that directs fees towards the best node operators, and that progressively improves the quality of the network as the value secured by it grows, which is the distinct advantage that Chainlink networks have, and that OCR 2.0 only accelerates because it allows us to add even greater amounts of nodes, such as hundreds of nodes, into a Chainlink network that is bridging, let's say billions of dollars. The next level is CCIP, the cross-chain interoperability protocol. Fundamentally, CCIP is an open source global standard that we're collaborating on, that we're collaborating around with a number of important stakeholders, like Celsius, like various blockchains, like various DeFi protocols, like various bridge providers, various groups that need a reliable messaging protocol. So the CCIP is not necessarily about building a bridge. It can be used to build a bridge. It's about moving commands and information between chains, because it's those commands and information which will fundamentally make up any bridge. And so at the lowest level, you have the Chainlink Oracle networks coming to consensus using OCR 2.0, growing in larger and larger number with higher and higher quality node operators that have greater and greater amounts at stake to guarantee that the bridge is going to operate properly. And then you have a messaging system that has a very distinct purpose and a separation of concerns around messaging, right? Around the transaction of messaging and information and commands. And what this does is it enables cross-chain smart contracts, because smart contracts can outsend commands to each other on different chains. It creates a global standard for blockchain interoperability. And very importantly, it enables various existing bridges, various, current interfaces to build a better bridge, to build a better interface into various blockchains, because that messaging layer absolutely has to be secure. It can't be manipulated, right? You need the physical compute infrastructure, doing things in a decentralized way, coming to consensus about the signatures that need to be aggregated, about what messages to be sent. And then you need the messaging system to be secure. And so that's why those are the two primary levels we're focused on. We're focused on making a highly reliable Oracle network that can aggregate signatures and can verify things on various chains reliably, and a messaging protocol that can send messages to different chains in a hyper reliable manner. Now, this is once again all about messages, right? So in subsequent presentations at the conference, you will see the details about the log system and the Chainlink message routing contract and a number of other things. So I don't really have time to go in this presentation, but what you'll really see is that it is about sending commands. It is about generating events that move between chains in a hyper reliable way, so that one smart contract can say, I want to release a token from that contract in another chain, or another contract can say, hey, mint a token on that chain, or lock a token on this chain. And it's really about sending these commands through messages. So it's not necessarily about token movement, it's about generating a messaging protocol, and that's really what CCIP's focus is. Once again, as a global open source standard that we're collaborating on with multiple bridges, multiple external kind of DeFi applications, multiple CeFi applications, multiple blockchains, and so on. And what this is meant to do is just make everybody's life easier and more secure, so that the DeFi applications can get more value into them. The blockchains can interoperate with each other and get more interactions between them and various user bases that they want access to. The CeFi applications can usually use blockchains. It's really just a massive benefit for everybody, because everybody just gets more usability from our entire ecosystem. The next level in the cross-chain stack is the cross-chain services level. Now, the cross-chain services level is really about creating bridges and creating cross-chain applications. Bridges are more along the lines of using CCIP to generate token movements for whatever topic the application or the user wants, right? So the programmable bridge is an initial reference implementation that we've made, and we're kind of making now, and we'll be releasing at some point, to show how you use CCIP to make a very advanced bridge. And advanced means not just the movement of tokens, but send my token to chain X and then monitor and put it into a DeFi application, monitor the yield of the DeFi application. And if the yield falls below a certain point, return it back to me. So you don't only send your tokens, You send your tokens and instructions about what to do with them. And the bridge abstracts away all the complexity of having to use that chain, of having to use those DeFi applications. You just get the benefit. You just get the benefit of that chain. You just get the benefit of all those DeFi applications. The DeFi applications benefit because they get far more usage this way. The chains benefit because the amount of transactions that they're executing for the DeFi applications or the services or the unique abilities they have, skyrockets. And the whole ecosystem benefits because everybody can just build more and more advanced things, which once again allows us to turn around to society and say, hey, we've built this amazing advanced hybrid smart contract. Here's what it does, right? It allows you to use all the different DeFi applications in this programmatic way. It's getting you even more value as a user. You should use DeFi because this hybrid cross-chain application can generate all this important kind of usefulness to you as a user. Now, once again, the Chainlink programmable token bridge is built on CCIP. It's a reference implementation, and we absolutely encourage other people to build bridges. So we want others to build bridges on CCIP. The reason we're focused on CCIP and not building bridges is because we want to provide the fundamental messaging layer and the fundamental blockchain infrastructure, not the blockchain, but like the Oracle infrastructure that is going to reliably execute the CCIP messages. The ability to build bridges is something we want other people to take on. The programmable token bridge reference implementation, I think, will be very impressive and very useful. And it'll have amazing features that I don't see in any other bridges, and it will have security guarantees that other bridges simply don't provide based on the way they're architected with the use of cryptographic primitives, or because they're not using Chainlink networks and they don't have a sufficiently large collection of nodes. Fundamentally speaking, what you're really going to see is a very large amount of messages. I think you're going to see a large amount of messages for a number of different bridges in the blockchain ecosystem, which I think don't fundamentally want to build the messaging layer or the physical infrastructure layer of node operators. I think they want to build a bridge that manages the movement of tokens somehow for different interfaces or even from their own interface. And that's what I've seen. I've seen a lot of people build bridges and then be forced to make a validator set or be forced to come up with a messaging protocol because they needed a bridge. And what they really want is a bridge. So we will have a programmable token bridge that we're absolutely thrilled for people to use. But we absolutely encourage other people to use CCIP to build their own bridges and to build even more advanced bridges. And then also to build cross-chain dApps that have their own unique bridging functionality built right into the dApp. So its own bridging conditions and its own messaging conditions built right into the application itself, right into different smart contracts. Once again, sending those commands over CCIP. The next level of the cross-chain stack that we focused on and worked on is the anti-fraud network. So the anti-fraud network, I think, is an amazing and unique innovation where we are able to generate an Oracle network, partly based on our work on proof of reserves, that monitors various key aspects of risk. So if you look at any system out there in the traditional world that moves any kind of value or anything, they always have a risk management and a fraud management and an anti-fraud department, and often a very complicated set of AI-driven systems. This is what the anti-fraud network does in a transparent, cryptographically truth-based, decentralized manner. It monitors all of the activity at all levels of the messaging system, the bridging system, and anything else that CCIP or Chainlink networks would be used for in regards to cross-chain communication, movements of tokens, or anything else. So the anti-fraud network is a separate parallel Oracle network sitting next to each cross-chain bridge that comes in the form of a DON, and it's at the most detailed level possible, monitoring the activity on both chains. What's happening with the minting, burning, locking, unlocking? What's happening with messages? Are they being delivered? What's happening with the aggregated signatures from the Chainlink networks? Are there any deviations? Do those bridges need to be slowed down or sped up? What are the risks with those bridges? They're basically scanning for an endless collection of issues. Reorgs, not enough confirmations, any number of risks. And then what the anti-fraud network does, similarly to what risk management and anti-fraud systems do in the real world, is they mitigate risk. So they manage risk in order to make it so that the Chainlink messaging protocol, the Chainlink programmable bridge, CCIP messages are all being accepted or not accepted according to the levels of risk that are deemed acceptable by users. Because once again, if you look at any system that moves around value, it has a dynamic like this. It has a risk management system, an anti-fraud system, a department that does this, AI that does this. And it just makes complete logical sense that if you're going to move critical messages between chains, if you're going to move tokens between chains, you want an anti-fraud system. But in the spirit of our industry and in the spirit of cryptographic truth, you want that anti-fraud system to be on a decentralized Oracle network. You want it to be transparent, and you want to know what it's doing, and you want it also to become more and more advanced. So this anti-fraud network can grow to extreme levels of advancement, possibly even running certain AI algorithms or any number of traditional anti-fraud mechanisms. So I think the anti-fraud network is going to be something extremely useful for bridges. I think it's going to be extremely useful even for users of CCIP. And I think it's actually going to have a life of its own in other categories of fraud management, even outside of the cross-chain world. This is one of the key innovations that we've been working on. As I've said, we've been working on CCIP, cross-chain, and all of these things for years. You can see, that this was our goal in the very initial Chainlink white paper. And this is one of those innovations that I think is going to have a very large impact on the ability to go from millions in bridges to billions in bridges to eventually trillions in bridges and flowing through something like CCIP. The next level of the stack is applications and user interfaces. Fundamentally, applications and user interfaces are either about cross-chain dApps like Celsius that are now interfacing with multiple different chains and need the security guarantees of that, or it's about just interfaces, various apps, wallets, lending interfaces, whatever interfaces that want to efficiently use different contracts on different chains. It's really about enabling all of these places that have large user bases, whether that's a wallet, an exchange, a crypto lending system, to interface and get the benefit of various chains. And once again, this benefits everybody. This benefits the user base of those apps and wallets. It benefits the chains because they're getting a greater user base. It benefits the DeFi protocols because they're getting a bigger user base. And it benefits our industry because once again, the applications people are able to build are just more advanced, right? And once again, that's our goal. Our fundamental goal is to provide a more advanced version of what our industry provides and to enable greater usability for the larger kind of global ecosystem of contracts, of finance, of insurance, of trade. And that is what will bring our industry into the future. That is what will make our industry about, hundreds of trillions of dollars, not $1.5 or $2 trillion. The fascinating direction that this goes in, right? The fascinating direction that this is really evolving in already now is the direction of the entire world's value flowing through a Chainlink abstraction layer. If you really think about it, and you think about what do web startups, web 2.0 firms with thousands of employees, fintechs, and enterprises with tens of thousands of employees want to do in relation to blockchains, the answer is they just want to use them. They just want to use the blockchain, and they only want to use the blockchain really for the reasons that they can use a contract on the blockchain. So what does CCIP do? And what does the Chainlink abstraction layer do? It enables people to send commands to various blockchains and even utilize various smart contracts from a single interface. This is absolutely fantastic and amazing for the entire blockchain industry, for the simple reason that the value locked in Web 2.0, fintech land, enterprise land, can now flow into blockchain networks. If before they were stuck in integrations, they were stuck in choosing the right blockchain, They weren't able to integrate with certain blockchains because they were somewhere lower on their list, or God knows what reason. With a single interface, Web 2.0, fintechs and enterprises can integrate with all the world's blockchains, with Chainlink being, announced and integrating with over 100 chains. And not only that, but they can efficiently use all the applications on those chains. That's a next level improvement of integration. And I personally think from our conversations with various enterprises that this is exactly what they need. They need to take all of their existing systems, all of their existing workflows, all their existing processes that they've trained 1,000, 10,000 employees on, or all their existing messaging protocols, all their existing routing systems for messages. They need to put it into an abstraction layer like Chainlink, and they need it to come out on the other side in a separate standard that allows them to reliably and in a provable manner interact not only with the blockchain, but also with the applications on a blockchain. So not only will they be able to send the command to a blockchain, but they'll be able to send the command to a specific contract. Personally, my personal point of view is that this extends even beyond enterprises. If we arrive at a world where CBDCs are on a blockchain, I personally think that there needs to be a global standard for how those CBDCs interoperate with other blockchain networks. And I think that's a far, far ways away. And I think CBDCs are very early. And I know there's a lot of, controversy about CBDCs. But my personal point of view is that if CBDCs are in a blockchain-based format, the ability for them to interoperate with blockchain networks and the ability for them to use DeFi applications will open the floodgates and will simply allow trillions upon trillions, hundreds of trillions of dollars to flow into blockchain networks, both public and private. So whether CBDCs are issued on blockchains or not, I don't know. But if they are issued on blockchains, then they will naturally need a solution to both interoperate with various enterprise systems, and they will need a solution to interoperate with various blockchain networks. And enabling that interoperation will be an extreme positive in the ability to allow trillions of dollars to flow into, the purchases of Bitcoin, the use of Ethereum DeFi, the use of gaming applications, the use of any number of other things. Fundamentally, if the world moves to a blockchain-based model, whether that's for supply chain data or global trade data or insurance-related contracts or CBDC, asset ownership or real estate ownership, what really matters is that the entire world moves to this cryptographically truth-based model. And our role is accelerating the interoperation, the access to data, the access to off-chain compute that's trust minimized for that to happen. And I personally think every single time that an enterprise integrates into a blockchain, any CBDC that starts to interoperate with a blockchain like Ethereum or Bitcoin or any others is going to bring a huge flow of value into those environments. And I think that is gonna really, really change our industry personally. So my personal goal is to build these decentralized systems, get as many people as I can using CCIP, building cross-chain applications. And if CBDCs do go in a blockchain-based way, then enabling the value from those environments to flow and to interoperate with blockchain systems and DeFi applications will be a huge win for everybody. This is what the Chainlink kind of universe of decentralized services looks right now. There's the validated data universe, there's the off-chain computation universe, now there's the cross-chain universe, which hopefully I've been able to create clarity about why that's very meaningful. Generally speaking, I think that this universe is going to continue to grow with identity solutions, with various other capabilities that we see smart contract developers need. We will not be making a blockchain. We will not be making DeFi products. We will not be making the smart contract applications themselves. Our goal is to accelerate what DeFi developers, gaming developers, insurance developers can do with blockchains. And that is fundamentally tied to enabling a greater amount of capabilities in the world's blockchains by attaching all of these decentralized services around them, right? So our fundamental goal is to provide price and market data, proof of reserves, all the world's data, random number generation, keepers and various off-chain computation, expanded forms of computations like FSS, bridging and messaging capabilities through CCIP and various programmable token bridge implementations that other people in the community build or whoever builds, and to fundamentally augment what blockchains can build, which we see as the critical missing piece, and which we've already seen greatly accelerate what DeFi can do. Our fundamental belief and what we've seen in practice is that as each cross-chain service goes, as each service goes live, as each decentralized service gains steam and has more Oracle networks, going from tens of Oracle networks to hundreds, and going from tens of users to hundreds of users, those markets just speed up, right? There's just more useful stuff being built. The markets speed up, more people build things, more people need services. So our fundamental cycle is, hey, here's a great decentralized service, build something cool. Okay, you as developer build something cool. Wow, everybody's using that. Wow, there's more developers that want to build that type of application. How wonderful. Here's more services to do that. Oh wow, we helped invent an entire category of useful smart contracts. How exciting is that? By the way, we're reinventing what smart contracts do. We're reinventing their benefit to society. We're reinventing all these beneficial aspects of what our industry does. So that's the ancillary impact of that. I once again believe that we are at the very, very, very early stages, just based on basic arithmetic, right? This percentage in some of my previous past presentations was about 2.5. So the percentage in DeFi has grown. But as a percentage, it's still unbelievably low. It's still less than 5%. So if you think that 70 billion in DeFi is impressive, just another 5% and that doubles, right? I personally think that that's going to probably 10x to at least 50% is going to be in DeFi. And that means that DeFi is going to be approaching the value of $1 trillion in DeFi. That's my expectation. That's what we're building towards. That's why we need to build hyper secure systems, hyper reliable systems, for whether that's for data, keepers and automation, random number generation, cross-chain messaging, whatever it is, because that's the world that we expect. That's the world that we're driving towards. If you go outside of the blockchain world and you look at the value that's outside of it, I mean, we're not even at the early innings of this. Like the game hasn't even started. Like we're at like whatever the pregame thing is, where there's like some music playing or something. We're at before the beginning, right? Most people haven't even come and taken their seats yet. It is unbelievably early. If you look at the amount of value that is going to be transformed into a hybrid smart contract based form, I mean, we're so far below 1% that it's not even worth mentioning. And once again, this is where I think the world is going. This is where we want to take the world. We want to go to the place where the entire world operates based on cryptographic truth. And there's actually industries missing from this diagram. The gaming industry isn't on this diagram. The insurance industry isn't on this diagram. The trade finance industry for global trade isn't on this diagram. A bunch of other industries like the ad network industry aren't on this diagram. All of those are going to be powered by cryptographic truth. All of them. That is where this is going. That is what we're building for. That is what our industry should seek to achieve. That is what we want to achieve. We want to change the world from a just trust us paper promises mess, where people can change things up whenever the hell they want, to a cryptographically guaranteed system of math-based truth, where nobody can change anything unless it's been codified in an encrypted system. And that fundamental difference, in my opinion, will result in this transition. And this will be, in my opinion, one of the largest transitions in history of how the world works. And that's why I'm grateful to be working on it. That's why I work on this way. That's why I am into this. I am into this because there will be a point in history where people say there was before cryptographic truth and there was after. And before cryptographic truth, the world was a mess. And nothing was predictable and everything was failing every 10, 20 years. And there were booms and busts and economic crises every couple of decades. And after cryptographic truth, we entered a new age of productivity, emerging market growth, reliability, and simply just an ability for people to interact with each other in a predictable way. And that's why this will happen. That's why I believe in this. The value and the reason for this happening is fundamentally there. And I personally see it every single day in the users we work with. And after people experience cryptographic truth and use it as a user or use it as an institution or use it as a fintech, they don't want to go back. Doesn't make sense. They don't understand even the way that the other systems worked, because it's like it's just a joke to them once they experience what cryptographic truth actually offers. Once again, there's a virtuous cycle that we need to generate. We need to provide all the services. We need to provide all the decentralized systems. We need to provide all of the messaging protocols. We need to provide all the capabilities that are going to take the world into a state of cryptographic truth. That's what we do here. That's what we care about. That will likely result in an increase in the amount of services that are used and in the amount of services that we launch. So I don't even think this is the amount of services that Chainlink networks will run. I think this is a relatively small list. But I think this is the general dynamic, is that we have a virtuous cycle and a chicken and egg problem that we solve, where you couldn't build fraud-proof gaming in certain cases without fraud-proof randomness. And once you could, you had fraud-proof gaming. And then people came and played it. And then other people came and said, man, I want to make a fraud-proof game. Or you couldn't build DeFi without certain types of data. And now you have that data, and now you can build DeFi. And guess what? People really want DeFi because the paper promises of Robinhood or Wirecard or Enron or whoever are no longer their only choice. And so that is what we need to keep doing. We need to keep generating these services with our amazing community, our amazing partners, our amazing users, all of these people that we work with that we're just amazingly grateful to work with in enabling them and helping generate a world powered by cryptographic truth. So once again, I'm truly amazed at where we are in history. I think the ability to transition the world from a just trust us paper promises model to a cryptographic truth, mathematically guaranteed world is a once in a lifetime, probably once in a many lifetime opportunity. I'm personally deeply grateful every single day to be working on it. And I'm just amazingly impressed by a lot of the other people working on it with me. I'm also amazed that we finally have the technology thanks to Bitcoin and other subsequent advanced iterations like Ethereum and others to finally solve the problem of just trust us paper promises and replace those with cryptographic truths. So not only, is this a unique time in history, but we can actually solve this problem in the next few years. And I think that'll be looked on with real historical significance. That's my personal belief. I think it'll be looked on as something like the internet, because just like the internet, it'll completely reinvent how people work with each other, how the world works, how people interact with each other, whether they have or don't have certain things like bank accounts, insurance, any number of other things, for the reason that cryptographic truth was previously unavailable and it became available. Now, if this is interesting to you and you're interested in solving these types of problems and you can see that cryptographic truth is the future of how the world will work, I encourage you to contact us. We work with people all over the world. We work with people in every country in the world. We want to work with you to make sure that your insight, your talent, your belief, your interest in generating cryptographic truth and making the world work in this way is something we can collaborate with you on. We have, over 250 people right now at ChainLink Labs, some of the most amazing, most impressive people I've ever met in my life. And, we're growing rapidly to help enable this together with many other teams in the ChainLink ecosystem. And I encourage you to join those teams or to join us and to really examine if changing the way the world works by making it run on cryptographic truth is something that you find interesting. And if that is an idea that you find interesting, and if you have, a desire to work on that, whether you work in research or engineering or marketing or sales or operations, there are teams in our ecosystem that want to work with you that are growing rapidly due to the demand that the ChainLink system and networks are experiencing. And we want to hear from you and we want to work with you in a very collaborative, fast-moving, impactful environment. Because I have to tell you, on a daily basis, we are now making this happen. So if you're thinking about, do I want to work in the blockchain industry? Where do I want to work in the blockchain industry? I think ChainLink Labs and the ChainLink ecosystem is a great place to make an impact across many different use cases and many different chains, and generally just generate a lot of change in how our industry works and how useful it is to society in general. So if you're interested in this, please contact us. Beyond that, I really do want to say that I am deeply, deeply grateful to all of the people working on the various ChainLink network systems and services, on CCIP, on our efforts to make sure that users get an ability to integrate with ChainLink properly, all the people that inform people about ChainLink in a correct way and make sure that people know the benefits of it, and our amazing and kind of very supportive community, as well as the larger cryptos community. I think new appreciation for the benefits and the improvements we can bring to the crypto industry. I'm very grateful to be working with all of you, and I can't mention everybody by name in this talk because there's just too many people, and even all the categories or all the specific initiatives. But for whatever it's worth, I think it's important for everybody to know that I and many of the people that I work with are deeply, deeply grateful for the support of everybody that puts forward effort to make sure that our systems are secure, reliable, provided to important users, and that people are properly informed about what this actually does and how it can improve their systems. So once again, thank you very much to our amazing team at ChainLink Labs, all the teams in the ChainLink ecosystem, the larger ChainLink community, the amazing developers we're working on with on the protocol, and all of our amazing developers and users that give us regular feedback on how to improve. I'm once again deeply grateful to all of you. So thank you for listening to my general explanation here. I hope it's been useful for you, and I'm looking forward to seeing many of you in person and working with many of you on realizing this vision of a world powered by cryptographic truth. Thank you very much.
Thank you so much, Sergey, for your time and for your vision over the course of the years as well. It is very much appreciated on behalf of the ChainLink Labs team, as well as the ecosystem as well. Thank you for your thoughts. Now we are going to move on into the SmartCon conference. Many of us have a seat at the game. Even though the game has not yet started, we're going to use these seats and learn as much as we can. So coming up next, we have Sergey again, but speaking with Alex Mashinsky from Celsius Networks to talk about their just announced integration of price feeds and now CCIP. So now we'll hear from Sergey and Alex.
Hi, everybody. I'm thrilled to be joined here by Alex Mashinsky, who has been doing amazing things in the blockchain industry for many years now. He initially pioneered a lot of voice over IP technologies, and now he's focusing on how to make blockchains and yield from DeFi and various other blockchain-based sources accessible to the rest of the world's billions of consumers. Alex, thank you for being here with me in this fireside chat. I also just I'm always curious whenever I look at what Celsius is doing, the speed at which it's moving and releasing new capabilities. What are your near-term plans or even medium-term plans for providing even more access for yield and other blockchain-based financial products to a larger and larger universe of users.
Hi, Sergey. Great to be with you. Love the amazing stuff that Chainlink has been doing for the last few years, and we're super excited to expand our capabilities with you guys. Celsius is really developing a lot of new capabilities on the front end to enable customers not just to earn yield, but also enable to swap between assets. And to do that, we're using more and more of the different services and oracles that you guys provide. And also on the back end, our yield sources are now counting 6 different methodologies, DeFi being just one of them. And going cross-chain, multi-chain, again, using a lot of the stuff you guys provide is definitely part of the infrastructure that we're building to enable all of our customers to benefit from this globally, right? Without having necessarily to know all the intricacies of using this chain or that chain. So how do you see organizations like Celsius benefiting from these decentralized oracles? Obviously, we're seeing tremendous expansion in the need for these services, but what are the key benefits?
Yeah, so for organizations like Celsius that have been able to secure a lot of value for users using good private key signing and other systems, without necessarily having everything in a smart contract on chain, I think the really attractive property here is being able to gradually decentralize more and more by consuming various decentralized oracle networks to provide cryptographic proofs around the value that you secure for users, which I think at this point is well over 16 billion. I've seen it be over 20 billion, and I consistently kind of see it growing. So I think the fundamental benefits and value are that you may have certain parts of your systems that secure user value through multi-sig and through some existing methodologies, but you can gradually decentralize greater and greater parts of Celsius through consuming things like Chainlink-based price data or Chainlink-based cross-chain services or any number of other decentralized oracle networks. So I think that's the model that we've been working in pretty heavily. And I think that's the right model because it allows an adaptation to users' demand for more cryptographic proof, for more decentralization, for more of all of these kind of properties and how they use blockchain-based financial products. But I'm also thrilled to hear your point of view on it, right? So how do you see Celsius becoming more decentralized over time?
Yeah, so Celsius is considered a CFI or centralized finance, even though we have one leg in DeFi and one leg in traditional finance. Our goal is to really, again, build a bridge between those two worlds. Today, over 99% of all the money in the world is still in traditional finance. And we need to build bridges to really bring all that money over. It's not that money is created somehow in DeFi. Value shows up from traditional finance. It lands on different projects or different asset classes in DeFi and in other parts of the crypto community. And then it increases in value. So for us, basically showing our community and the community in general, all of the details of how we create yield, verifying that the assets came in the first place, where they were deployed, how did we earn this yield? Did you receive the pro rata of that yield that you were supposed to receive? And was it distributed properly and so on? All that are forms of decentralization that we're using with zero proof knowledge and other mechanisms. The project itself is called Proof of Community. And again, we're using Chainlink to really help us deliver this in a way that enables everybody, even people that are not Celsius users, to be able to go dig into the numbers, verify all this information, and make sure that we're building a sustainable and scalable organization that is going to be here for a very long time. I think the main problem we had and why Bitcoin was invented in the first place is because companies like, in 2008, when Lehman Brothers went bankrupt, I think it was August of 2018, just a few months earlier, their auditors told us that everything is great with Lehman Brothers, right? So how do we avoid all of that? We need transparency, we need decentralization, we need access to all the data.
Yeah, that makes sense. I mean, I'm thrilled that Celsius is now using Chainlink price data oracles to power a lot of the internal methodologies and calculations, and is then able to turn around and prove to users that the inputs into those calculations were done in a very transparent way, right? And that's kind of, I think, the vision of the future for whether it's CeFi or DeFi or even web companies. It's proving that the inputs have been made transparent and the outputs have been made transparent. And so the leeway that you have to deviate in the middle, the leeway that you have to do something that users don't expect or users wouldn't want you to do in the middle becomes very small, right? So that universe of things that could go wrong because of the cryptographic proofs and transparency from decentralized systems and decentralized oracles, and the fact that Celsius is now powered by Chainlink price data, eliminates a lot of those concerns that people, when looking at other CeFi or other web systems, they don't really know how things are being calculated because they don't really know the price data that's going in to prove what the settlement was or what the actual outcome should be. And so I really appreciate the forward thinking and kind of focus on security and decentralization that I've seen from the Celsius team in trying to make as much cryptographic proof through various blockchain-based systems, decentralized oracle networks like Chainlink, available to users. So that's the thing that I see that's pretty unique about how Celsius approaches this transparency and ability to create assurances for users.
Yeah, and because we use both blockchain-based and non-blockchain-based yield sources, we can't just rely on the traditional decentralized factors, but we do always have to rely on Oracle data to prove the pricing points and the inputs and everything else, right? So I think for us, being able to normalize all that data and provide it to the community in a way that they can consume. We call it Rewards Explorer is actually the name of the product that's doing this. And imagine going to your bank and asking your bank to tell you, okay, here's my paycheck, and I want to know where you're going to deploy it, how much you're going to earn on it. I want to know where did the money, I want to see that you got paid this yield or interest, and I want to see what the other people in the bank earned versus me, right? That's a laughable request to any bank in the world. But here we're delivering that both on DeFi and on CeFi, and that's what creates a real world application for 7.8 billion people, right? There isn't a person on this planet that will say, I'm rich enough, I don't need to earn more money on my money, right? And today, Celsius pays between 10 and 30 times more than your bank in yield. And obviously many, many other companies are not trying to replicate that as well. But that's what's going to bring the next several billion people into crypto.
Makes sense. So in this world where you're approaching all of these users and there's all these different environments, and you want to generate yield from all kinds of different sources, and you want all of that proven through Oracle networks. I think that's something that we've shown through the deployment of Chainlink networks powering. Celsius is already 16 billion. That's something we've already been able to achieve. But the next question kind of becomes, I think, how does Celsius become a cross-chain enabled kind of financial product or set of products or ability to gain yield? So how do you view Celsius becoming a cross-chain based system or a multi-chain system?
Yeah, no, it's a great question. And so again, Celsius invented this idea that you can earn yield on crypto, right? We wrote the paper back in 2016. We published it in 2017. We launched the product in 2018, a year or two ahead of all the other names that you heard of. And we support more blockchains. We support, I think, 16 different blockchains today, 42 different assets. That's more than anybody else. And so we are effectively a multi-chain platform today, but what we're layering on top of that is the ability to seamlessly transition value across different blockchains. And to do that, you really need to have super high accuracy on real-time values on all these different chains, because if you're enabling somebody to go from any to any asset or borrow any to any, you need to make sure that your data sources are extremely accurate. We've seen several places and problems on DeFi and on other platforms where the source of their data wasn't accurate or was not decentralized enough, and obviously that caused damage and losses to the participant of the network. So for us, being able to partner with a company like Chainlink to really make sure that all of our data is accurate at all times and is scalable, meaning we can actually handle the volume of transactions, the volume of interactions, is life or death for the products that we offer, right? So one of the innovations that we're working on right now, which we're jointly announcing, is our ability to basically lock value on any platform, for example, on Aave or any other DeFi platform, and verify that with Chainlink, and then basically be able to create wrapped assets or minted new assets on other chains, right? So that in the ability to link those values together and verify that is an extremely important piece of basically increasing the yield. I think worldwide there's competition for yield. Obviously, we're doing much better than what the bank's offering, but I think there is definitely a growing cross-chain need to be able to represent these values in real time and verify that the values are there, right? Verify that what you put, for example, on Aave is locked and is available for you to transact on other chains. So that being able to do that, I think, is something that is extremely new and valuable. And as you said, Sergey, we have over 16 billion in assets. We're looking to put more and more of that on DeFi as we can enable these type of services. So these unique benefits are really things that we worked on together, and I'm super excited about that. Maybe, Sergey, you can kind of explain the details and why this is so important.
Yeah, I think it's more so, in my view, about actually being able to use various DeFi protocols and various smart contracts on various chains. So it's not even in my mind. I think it's great to use Aave, and I think that's a great service. But I think it's even as interesting as using Aave on different chains and using various different protocols on different chains, because there is all this fascinating stuff in DeFi happening in different environments, right? And Aave has already successfully been able to generate yield and provide its services on other chains as well. And so that's really what I'm seeing with the DeFi community, is that there are many different DeFi ecosystems now coming to life, and all of them have different benefits with different yield and different fluctuating value that users want access through something like Celsius, right? And Celsius wants to provide yield to this larger and larger collection of users through this highly transparent, cryptographically proven methodology that includes, both the performant centralized CeFi approach and the decentralized, hyper-transparent cryptographic proof, cryptographic truth-based approach, right? Which is a very interesting combination. In any case, what I really see happening is great teams like Celsius being able to utilize various DeFi protocols on various chains to give your users access to that yield, which really benefits everybody. It benefits the users because the users have access to those protocols and their benefits. It benefits Celsius because Celsius can do that in a secure and reliable way with the help of decentralized Oracle networks and various other systems. And it also benefits the DeFi protocols because they get more access to a user base, right? They get more access to value locked. They basically become more used, which is always their express goal. The way I see Chainlink cross-chain services playing into this is very clear. I think there's these critical nuances around first moving the assets in some kind of really secure non-custodial way into these various environments so that they can actually be placed into the DeFi protocols, once again, in a way that creates a lot of assurance to Celsius and its users with a lot of transparency, which is exactly what decentralized Oracle networks expressly seek to do, and to do that in a very secure way. And then the second one is eventually actually creating the messages and the commands through a Chainlink cross-chain system that actually utilizes those DeFi protocols. So I think there's this fascinating world where not only can you move value into these other protocols through Chainlink cross-chain messaging and bridging and smart bridging capabilities and systems, but you can actually tell the Chainlink programmable bridge that, hey, I'm going to give you this many tokens, and I want you to actually enact this usage of a protocol over there. And so the bridge now becomes kind of an agent, a highly transparent, highly reliable agent that's in the control of Celsius and its smart contracts and its systems. But all of that is, once again, super transparent, right? So the user can know that they've been able to use 5 different DeFi protocols on 5 different chains for the purposes of getting access to the benefit of all those protocols. They've been able to do that through Celsius, but they have a transparent cross-chain infrastructure that allows not only the movement of value, but also the ability to direct that value in a very reliable way. And so I think supercharging both the rate at which value can be moved into these various chains for the use of these other protocols for the benefit of users, and the ability to also send messages is in combination going to be really, really powerful, because it's just going to accelerate the rate at which you can make something called cross-chain dApps or cross-chain kind of financial applications. And that's really what I see Celsius really seeing the benefit of and getting behind. It's really making a number of cross-chain applications that get its users a multitude of different benefits from different chains, whatever the great new DeFi product on whatever chain is with like 20% yield, Celsius users should be able to get access to that through an efficient, secure, and highly transparent cross-chain system. And that's really, I think, the great partnership that we formed here.
Right, and to add to that, the innovation used to be living only on one chain, which it all starts on Ethereum, and it lived there. But now, like you said, there are many chains, and they're all starving for that liquidity, right? Even if they have yield, in many cases, they need that liquidity to be able to really scale and operate at optimal efficiency, or be able to create that yield and optimal efficiency. So part of these bridges is also enabling liquidity to flow cross-chain to where it's needed the most, and which was not really possible before. It required many manual steps that took time and did not allow this liquidity to really flow efficiently. The vast majority of this value creation is then captured by the community through their participation, or through them providing this liquidity through platforms like Celsius.
Yeah, I think eventually we'll arrive at some place where you might even have vertically focused chains or geographically focused chains, and there in my opinion will be a very large degree of smart contract execution on Ethereum, including for DeFi. I think the interesting thing is allowing people to build basically cross-chain applications that use both Ethereum and whatever other benefits other chains have, whether that's getting something about supply chain data and combining that with DeFi and combining that with carbon credits on another chain and kind of just building more and more advanced cross-chain applications. I do think that the core logic of certain smart contracts might still keep living in one primary chain. I don't know exactly how that's going to evolve, but right now that still looks heavily like it's Ethereum at the moment. Generally speaking, I'm super excited about enabling CeFi and DeFi to benefit from all the great work happening on in various environments. And I think that the approach Celsius is taking, both by becoming more decentralized over time, providing these cryptographic proofs to users, and by generating all of this proof in your cross-chain movements. And it's amazing to me that there's going to be 16 billion, or probably by the time we're really getting this live, probably much more, being able to be sent to use various DeFi protocols and various smart contracts on various chains. I think that's going to be a really amazing picture of how really the blockchain world should operate, right? Is that you should actually be able to access data. You should be able to access the resources of other chains. You should be able to access, all of these kind of capabilities and efficiently combine them into a single, highly reliable, multi-chain, externally data-powered kind of decentralized application of some kind, even if it has certain multi-sig or private key components that are more centralized, right? So at the end of the day, I think you're going to be arriving at a more advanced application in terms of, the model that you guys are building in.
Yeah, I totally agree with you. And I think a lot of these other blockchains have built EVM compatibility because they wanted to effectively suck in the users or the devs or the liquidity. But I see that as a two-way highway in which many participants want to go back and forth. And like you said, it's very important to build this as a two-way platform that enables both users and developers and liquidity to flow in all directions, because that's what the competition is not between this chain and that chain. The competition is between traditional finance and this new decentralized form where innovation is happening at 100 times faster pace than traditional finance. And really, for all of us to work together to build these bridges is creating the future of finance, is making a much more reliable, a much more sustainable ecosystem. And again, I come from a telecom world where we had global standards for the last 100 years or so, right? I worked before Celsius. I helped launch the first 5G device here in the United States with Verizon, the MiFi 1000, and that's a global standard, right? Even though we used components and pieces from maybe 100 different suppliers, it all came together and it worked because of these standards. And that's what we need to do here as well. We need to make sure that everybody works on a standard that the community can benefit from.
Completely agree. I think you just said it very, very well, that we're all just working on this together. And I think you and me have always really viewed this as growing the entire pie of our entire industry. And I think that'll result in much more value being secured on Ethereum and in various other places. And I think the real value of all this is just growing the usefulness of DeFi and blockchains for the larger financial ecosystem through all the unique benefits that it has. So I'm thrilled that we're working on this together, and I really appreciate your thoughtful feedback on all this. Alex, as usual, I'm thrilled that we're building a more decentralized, more transparent world together. Thank you so much for speaking with me here at the conference. I really appreciate it. As always, I'm thrilled that we're working together and looking forward to speaking again sometime soon. Thank you.
Thanks again. Thanks for having me back, and looking forward to next year's conference.
Thank you so much, Alex and Sergey. Appreciate those words. coming off of Sergey's keynote to talk about Celsius and the recent integration and building the future of decentralized services together. One of the things Sergey mentioned in his keynote was keepers are now live, Chainlink keepers. So for our next panel, we've got a group of Chainlink users who are here to talk about some of the use cases for keepers. So for this next panel, I'm going to introduce Anush Vijayaraghavan from Chainlink Labs team. He's a new addition for many of you in the community, and I'll throw it over to Anush, who will then bring on our panel.
Perfect. Thank you, Andy. Perfect. Thank you for that, Andy. Hi, welcome everyone. I'm Anush Vijayaraghavan from Chainlink Labs, and I'm happy to be here today to moderate this panel on automation infrastructure and the use cases of Chainlink keepers. We have an excellent group of panelists here to talk about reliable automation, how automation is evolving as the blockchain ecosystem grows and becomes more sophisticated, and where Chainlink keepers fits into this picture. Smart contracts allow for a highly trustworthy collaboration across even distrusting parties, establishing and maintaining truth that we can all agree to. But there are limitations. They cannot communicate with the outside world on their own, a problem that's addressed through decentralized Oracle networks, and they require external input for actions to be taken, oftentimes cascading down from a user clicking a button somewhere on a UI. However, not all actions can be driven by immediate end user input. So we need to create these off-chain application layers and infrastructure layers to set on top of your smart contracts. So your dApps can be automated based on time, events, some combination of the two, perhaps some off-chain computation, rather than being solely driven by direct human interaction. Now, creating and maintaining this automation infrastructure is critical to the core function of many dApps. And today we will discuss the pitfalls and the opportunities that automation infrastructure presents and how to safely and reliably outsource this fundamental automation work. On our panel today, we have Kane Warwick, the founder of Synthetics, Max Figa from the core team at Barnbridge, Ernesto Boado, the CTO of Aave, Brendan Asselstein, the CTO of PullTogether, and Peter Van Morik, the CEO of ChainLayer. We have a lot to get through today, so I'll just jump right into it. As a starting point, it might be useful for the audience to hear a bit about your project and the role of automation in your work. Kane, would you like to kick us off with this?
Sure. So, for those of you who don't know, Synthetics allows you to get exposure to a range of different assets on Ethereum. It's a fairly complex smart contract suite, and we were lucky to work with Chainlink early to implement their oracles to support the network. But over the intervening 2 years, I think it's been now since we've been live, we've added a lot of new functionality, and there's a lot of aspects of the system that require intervention. And so we have a number of aspects of the protocol that on a weekly basis, some bot or some keeper needs to come in and make a transaction based on some information that's on the blockchain, and it's just not possible to kind of automate those things with simple payments. So we've been talking to Chainlink about taking over a lot of that infrastructure as they do with our oracles, because we want a streamlined and simple interface for all of these different aspects of the system that need to be maintained.
Awesome. Thank you for that, Kane. Ernesto, would you like to cover Aave?
Yeah, sure. Hi, everybody. For those who don't know what Aave is a liquidity protocol where people can supply assets to get yield on them or borrow them. And in general, it's a pretty a standalone running protocol, let's say, in the sense that it doesn't need so much automation, at least in multiple points. But there are certain aspects, like, for example, the liquidations where actually automation can improve the system by orders of magnitude. So another point is also like in certain parts where the computation are quite heavy, and potentially it could be re-architected to introduce other parties that do some kind of automation to optimize the cost. So yeah, pretty excited to see how it's going to look the ecosystem like in the future with intervention of keepers.
Perfect. Thank you, Ernesto. Peter?
Yeah, so for those who don't know, ChainLayer is a node operator on the Chainlink network. We're also a staking service provider on a lot of networks. And I think Keeper for us enables us to do a whole lot of automation on things we now run in various crowns, various systems, and especially the security aspect of it is amazing. If you run a script that has to do something on chain, you basically need a private key somewhere, or you need to secure it with ledgers or difficult things. And with Keeper, that whole part of security is basically outsourced to the node operators. We like to dog food Chainlink as node operators, and this is a perfect example of things we can do ourselves. So yeah, really excited.
Thank you, Peter. Brendan, would you like to go next?
Yeah. Thanks, Anush. So I'm Brendan from Pool Together, and Pool Together is a prize savings game. So users deposit into a prize pool, interest accrues, and that interest is awarded as a prize. And so the prizes are awarded periodically. We use Chainlink for two things. One, the Chainlink VRF to get a random number to select the winner or multiple winners. And two, we need that reward triggered periodically. And in fact, it can be triggered by anyone, but as Peter said, we effectively need a cron job to run it. But what we can do now is have the protocol cover the cost of rewarding the transactions, because of course that needs to be paid for, and have it managed all by the Chainlink keepers. So it's a really effective system for us to be able to outsource that, which we try to do as much as possible. We don't want to run servers.
Understandable. Max, would you like to go next?
Sure. So BarnBridge is a risk tokenization protocol, meaning that we build applications that go after specific risks users in DeFi are trying to alleviate or get more exposure to. We rely on Chainlink keepers primarily for our smart exposure application, which allows anyone to create a pool between any two assets, any ratio they'd like, that will constantly rebalance kind of around the parameters of that pool. So that might be 5% deviation from the ratio between the two assets on a daily basis. And when that deviation is triggered, a Chainlink keeper can actually trigger the swap necessary to bring things back to parity with the kind of established ratio of a given pool.
Thank you, Max. So thank you all for introducing your company and how you're using Chainlink, as well as where you might see automation having an impact on your work. I think it'll be good for us to maybe dig a little bit deeper into how what considerations really go into the process of deciding how you do automation. The criticality of automation is clear in order to create more and more sophisticated dApps over time. But there are a number of difficulties to consider. There's DevOps maintenance concerns. There are centralized automation risks. There's economic incentive considerations. And maximizing decentralization is also critical as part of this. Perhaps you could share what are some of the complexities that you've found in your experience, and perhaps some pain points as well. I'd like to open this up to the entire panel and see where we go from there.
Well, I'm happy to start.
Excellent,
yeah,
thank you.
I can kick it off. Yeah, So we've been using Chainlink VRF now for a good while now. In fact, probably over a year and a half or so. And an important consideration has been support, has been the ability to reach out to somebody if something goes wrong to get things in order again. And so that was a big consideration when looking at Chainlink keepers, is that there's accountability. And it's difficult to have that in all decentralized systems. I mean, if something happens on Ropsten, who do you talk to? Who do you reach out to? Do you just tweet it out and hope for the best, and see if someone picks it up? So that accountability is really important. And just because, in these kind of external systems, like, Oracle networks, essentially, if we include keepers as part of that kind of, then things are going to go wrong. There are going to be problems. It's inevitable. And so having a support system has been really, really valuable to us. So that's been the primary consideration. Secondary, as I already mentioned, we don't want to run servers. Our goal is to become a pure decentralized protocol. So we want to stick to our core value add, which is writing great smart contracts. And so being able to delegate that for a pretty minimal premium is really valuable to us. We want to make sure that it's done well by a professional community.
Thank you, Brandon. Kane, I think
I can jump in.
synthetics has some very interesting scenarios to consider here. So yes, please.
Yeah, I think one thing I will say, if you're on Ropsten in 2021, you're probably NGMI, unfortunately. Sorry, Ropsten Maxis, but I think it's game over there. So I think with synthetics, we've got a range of different things, right? And a range of considerations in terms of like incentivization, economic incentives. There's a whole range of considerations that we had. And what we ended up with over the course of multiple years was like this patchwork of different systems with different incentives, and they were incompatible, and sometimes things wouldn't work, and actions wouldn't be triggered, and it was just a bit of a mess. And so we actually started working originally with Andre when he started developing Keeper, and we talked to him. But I think one of the primary considerations that was kind of not met for me, at least in that architecture, was this idea of taking the kind of auction process offline. So having some kind of mechanism to ensure that you weren't having these gas wars. So because we saw this a lot in the early days when we had Keepers, even for simple things like closing a fee period. It got to a point where there were multiple different bots that were competing for it. And then over time, all of the less successful bots just dropped off to the point where there was only one, and then that one would fall over and then nothing would happen. And so we saw this play out. We saw this, kind of iterative game play out where like one person would take all of the spoils, and then eventually, something would go wrong and there was no decentralization, and it didn't work. And so it was really important to us that the architecture that we chose had this, component of some kind of off-chain system to ensure that you didn't have perverse economic incentives. So when Chainlink started working with Andre and all of this research started happening, and we started talking to you guys and going a bit deeper, that to me was like the primary consideration, that this was like this off-chain network. The economic incentives were aligned. You had confidence that you weren't going to have this winner-take-all effect, and then a very brittle system emerging over time. So you could kind of implement it and not worry about it, and go away and assume that it was still going to be there in 6 months' time, and not be constantly monitoring to see what the state of it was.
Right. It's kind of this situation where it's game theory 101. You need to make sure that there's cooperation between all the keepers so that everyone is profitable in general, and not have just a Wild West competition between all the different parties involved. Thank you for that, Kane. Max or Nessa, do you have anything you'd like to add to that?
I can take that. I think what I find more interesting is like the implications that it has in architecture of new systems. Like personally, I suppose everybody else that has experience on smart contracts in the code knows that when you have a system that is too reliable on parties that needs to trigger something, usually the system, initially at least, seems a bit more fragile, because you need to have a good system of incentivization, you need to have good infra, because usually you need to check some conditions of chain to then trigger that action on chain. So we just try to avoid it as much as possible. But obviously, in a lot of cases, it's not possible to avoid it. So having something like Keeper, and we already also experimented with Andre back in the days with for the liquidations, on the previous system of Keeper, but having a system that is reliable in terms of infra and incentives, and systems like the Aave protocol that is basically running out there and decentralized, doesn't really need to care that works well. I think it's a huge advantage even for future design of systems, where you can actually think, okay, maybe it's fine to have some scheduled tasks on the design, because at least there is a reliable system out there that could cover them. So.
Right. Those are definitely some of the themes we've consistently seen when doing some of the user research on what are our users looking for from an automation infrastructure. But reliability is always coming up as like the number one in general. And that is represented in a number of different ways. And then the second thing we've been hearing a lot about is around ease of use. And a third and very critical component that we've seen from a segment of the marketplace seems to be around being able to do some of this computation off-chain, so that you don't have as much excess gas costs. If doing everything on chain is extremely expensive, reads are expensive over time. And so that's come up quite a bit in our discussions as well. Max, do you have any thoughts as to like how off-chain computation as part of a infrastructure model to trigger actions might benefit BarnBridge?
Sure. So when you think about the types of assumptions we make in DeFi today around risk management, right? It can be, you have to take into consideration what you can do on chain, and that's quite limited. Whereas, when we look at incumbents in legacy finance, they're running risk algorithms day and night to manage their systems, right? And so when we think about where does DeFi head over the next 2-3 years, I think off-chain computation, kind of referencing back to smart contracts and being able to impact the parameters we're operating under in those smart contracts is going to be very critical. And something I'd add, just kind of on the last question line, right? Along with that expansion of DeFi and this expansion of complexity, I think there's definitely something to be said for specialized services like Keeper networks, right? Because if you imagine a new project launching today, maybe they're DAO first, maybe they're not, but it's going to become increasingly difficult to consider all of these other chains that might be a constellation around Ethereum. And how do you accommodate your apps across multiple ones, right? Do you have your own bots on every single network that may or may not be relevant to your apps, right? And so this idea that like having a Keeper network allows you as a new team to kind of have this infrastructure kind of, again, in your sails, so to speak, as you're examining the wider landscape, I think is also really critical.
Agreed. And Peter, from ChainLayer's perspective, you guys are involved in being a fundamental infrastructure to the blockchain ecosystem. And I'm kind of curious, like from your perspective, how do you see long-term where automation can really help perhaps reduce some of the burden on your teams?
I think on our side, there's a lot of things we need to do on networks, like redelegate rewards, withdraw commissions, maybe even activate validators in some cases. And basically with Keeper, you can automate any on-chain thing, and especially with CCIP just being announced. For us, this I mean, this basically
lots of things coming together.
Yeah, this really opens endless opportunities for us to automate not just the infrastructure, because unfortunately we do need infrastructure to run our organization. And we like to automate infrastructure as much as possible, but the on-chain part is always something that's really hard to automate. To be honest, today I'm not really sure where we're going to end up in a year, but yeah, the possibilities are endless, basically. But I think we're really excited about facilitating other users with their goals. I think for us as an infrastructure company, we live because other people rely on our expertise regarding security and keeping things up. And this is just another perfect example of an opportunity where we as ChainLayer, and I think all node operators, are really going to be excited to be a part of automating more things on the side of our customers.
Right. Thank you. Yeah, and that kind of brings us to a future-looking concern. And obviously, it's hard to predict exactly what's going to happen, but blockchain is often seen as this democratizing foundation for the world to form trusted bonds without having to place the trust purely in brands, individual promises, or relying on institutions for adjudication purposes. So I'm personally very curious about how the ecosystem reacts to having an incredibly easy to integrate automation infrastructure at their fingertips. What will emerge next? If we look at how the ecosystem has been evolving over time, we've seen changes at an astounding rate. What DeFi is today was a dream 2 years ago, and that was broadly enabled by obtaining high-quality price and market data on-chain. So in a more future-looking perspective, what do you see as the potential changes we'll see as the ecosystem matures and automation infrastructure becomes a lot more easily accessible, so any dApp developer can make use of it in a matter of minutes? Brendan, would you like to jump on this one, or Ernesto?
Sure. Yeah, I can jump in. It's a very broad question.
Yes, it is.
Yeah, I do want to make a quick comment though, because your last question was a really good one. In that we have direct, and the question was how useful will it be to move that computation off chain? And with the current Keeper design, you do first the check to see what needs to be done, and then the work, the actual transaction. Our code for those two are almost identical, and the check can be done entirely off chain because it is the actual execution that does the verification of what, it only can run a valid transaction. And so moving that off chain will be super critical. And we've been doing that more and more. In fact, Pool Together V4, we're moving a lot of computation off chain. So it just becomes verification in that sense. So I do see a lot of potential for growth there. In terms of unlocking developer capabilities, I mean, the more these pieces become Lego pieces, the more innovation we're going to see at hackathons and elsewhere. The more permissionless this is to get involved. If registering a keeper becomes as simple as just like pushing a button, we're going to see some awesome innovation happen at these hackathons. That's where Pool Together started. That's where a lot of projects get started. When you bring people together and just give them the tools to be able to build whatever they want to build. So as this system becomes more permissionless, I think innovation will only grow exponentially.
Agree. Yeah, I kind of agree with Brendan on both points. Like moving off-chain computation is completely necessary. Like we are seeing it now with fork by fork, like the gas consumption of the smart contracts that are deployed, like it tends to go up all the time. So it's important that new tools appear that they offload that. And then that unlocking the developers I think is where I'm more bullish on this kind of systems, because end of the day, even if in Ethereum sometimes like the constraints on development is actually what brings a bit of innovation, I don't think it's really optimal. So probably that is the solution, like having at least a minimal assumption that you could automate something on chain or with this hybrid system. Also, I would say that the bridging capabilities and like playing with cross-chain communication with these keepers is something which I'm pretty bullish on. So, but probably it will be a bit more in the line. So,
absolutely. I mean, connecting all these different tooling together to create a more sophisticated hybrid DApp, hybrid smart contracts, is definitely the future. Kane, would you have anything to add to that?
I think Ernesto's point earlier was pretty indicative of kind of the place that we're at, right? A few questions ago, he kind of made the point that like, oh, we try and avoid this as much as possible, right? Like we try not to have any automation. That's kind of the default assumption for people, at the moment. It's like anything that, even looks like it requires a keeper or whatever, like let's work out a system that might be more complex or convoluted that can avoid that. And so I think that once we get to a level of comfort in the ecosystem that this is a thing and it works and it's stable, it's the same thing as, I see keepers as kind of like a subset of the Oracle problem, right? Like it's just a specific, implementation of the Oracle problem. And I think when we saw Chainlink oracles get to a point where the DeFi ecosystem was comfortable using them, and remember that always wasn't the case, right? Like, a lot of people were running their own oracles. The effort of running your own oracles or your own keepers is significant. And so you couldn't just turn up at a hackathon and be like, oh, let me just spin up my own oracle today, and then that will allow me to do whatever I want to do in this hackathon, right? So like these are really enabling technologies. And I think that we're probably not there yet in terms of like getting everyone a level of comfort that, these are ready for production, but I think it's close. And once it gets to that point, then, it sort of goes parabolic.
Definitely. It does feel like we're very much at that starting point of getting the kind of tooling necessary for developers to really be able to create highly sophisticated apps with just one or two people in a garage. As Brendan was saying, a lot of these projects start off from a small group getting together to make something very interesting. So we have DeFi now. We have a whole bunch of new business verticals that can start being enabled by blockchain technology. And having these small groups come together to really create this next generation is, I think, where we're hopefully going to see a lot more of the market go. Max, is there anything you wanted to add to that from a Barnbridge's perspective?
No, I think everything was covered quite well.
Awesome. Thank you so much for that. So that's pretty close to about the amount of time we have for this panel. So I'd like to close out by thanking all the panelists for being here today. And for those of you watching online, Our goal in creating Chainlink Keepers was to provide this easy to use, reliable automation infrastructure for the blockchain ecosystem and the developer community at large. Any dApp developer looking to automate their smart contract can integrate Chainlink Keepers without worrying about deep integration concerns, and can do so in a matter of minutes to hours. Making your contracts Keeper compatible, all it requires is your Solidity code and a simple registration process with our Chainlink Keepers app. Chainlink Keepers network is created to create a fundamental fair playing field where keepers must cooperate with one another and not compete. Head over to our website, read our latest blog post, and check out our documentation. We are now live on mainnet, and we'd love to have you using our product. I hope this was engaging and informative, and I hope you enjoy the rest of SmartCon. Thank you.
Thanks, Anush.
Thanks, Anush.
Thank you, everyone, to the whole panel. And Anush, I hope you guys enjoyed meeting Anush as well, Chainlink Labs team member. I really appreciate you guys' insights there. If you have questions, if you're a developer and you've got questions about integrating keepers or co-marketing or whatever it is that you want to work with Chainlink Labs, head down to the Expo section and talk to our Chainlink experts. There's a tab there. You can go and talk to some of the reps that are there ready to talk to you. But up next, we've got another Chainlink Labs team member, Chief Scientist of Chainlink Labs, Ari Jules.
I'm going to talk today about fair sequencing services, a platform we're developing as a product at Chainlink Labs. As the name suggests, the goal of the system is to order transactions in a way that is fair, beneficial for users. Before I get into details, let me provide a little background. How are transactions ordered today? The transactions, of course, are submitted by users to a mempool and then taken up by miners. When a miner successfully mines a block, it includes transactions in it. And an important thing to know is that the miner gets to determine how the transactions are ordered in the block. And it does this unilaterally. What this means is that existing systems are centralized in this temporary and limited way, but nonetheless, they are at least partially centralized. Well, so what? So these decentralized systems have a touch of centralization in them. Why does this matter? It's not as though miners, for instance, can tamper with transactions. Well, it turns out that the order of transactions, the ordering of transactions matters a lot. And let me explain this by way of example. Suppose that Alice wants to buy a token on an exchange, say an automated market maker. For example, she'd like to buy some Bob's Bubble token, or BBT, for ETH. She submits a transaction to the mempool, and that works its way on chain, and she obtains some quantity of BBT. So for instance, she may obtain a price of 1 ETH per BBT. And if the AMM parameters are right, her transaction will cause the price of BBT to rise. Well, this is all well and good, but when Alice submits her transaction to the mempool, it's of course observed by all miners, and it's known, of course, to the miner that mines her transaction. This miner can take advantage of this knowledge and its ability to order transactions to do the following. It can create 2 transactions, a buy transaction and a sell transaction, and order its buy transaction before Alice's and its sell transaction afterwards. This is what's known as a sandwiching attack. What's the effect of this? Well, the miner's buy transaction will do exactly what Alice's transaction accomplished originally. It's to say, the miner will get 1,000 BBT, as Alice would have if the miner were not present, and the price of BBT will rise. Now, Alice's transaction gets processed, and she gets some BBT, but the price of BBT has risen, so she gets a little less BBT than she would have otherwise. Her transaction also causes the price of BBT to rise. Now, the miner turns around and sells the tokens that it acquired. And it makes a profit because Alice has helpfully caused the price of BBT to rise between the 2 transactions submitted by the miner. What's the effect of all of this? Well, Alice is getting fewer tokens in this toy example, 25 fewer tokens than she would have gotten otherwise. And the miner's making a profit. The miner sold his tokens for 1025 ETH, but only paid 1,000. Where's the miner's profit coming from? Out of Alice's pocket, of course. The value exploited by the miner here, extracted from the user, has come to be known to the community as MEV, or miner extractable value. And this is a term coined in a paper that my academic group published, led by Phil Diane, back in 2019. Now, there are many forms of MEV, and loosely speaking, some are good and some are bad. For example, certain forms of arbitrage are useful in that they communicate price information across markets, across contracts, across chains, or whatever. But things like sandwich attacks and related attacks like front running, which Sandwich Attacks Incorporated, are for the most part clearly bad. And they're not a hypothetical concern. They happen today all the time. Miners are doing exactly what I described in conjunction with arbitrageurs. In our paper 2 years ago, we included examples of the plaintive cries of users who had lost money, in that case to bots, but equivalently today, potentially to miners. And some of these are really disturbing. I'm a stay-at-home parent, I day trade to keep my family above water, but this was a mistaken order. Please send my money back, I have faith in you. This was an accident, I'm a single parent, and so on and so forth. And there's a litany of these online. Perhaps the most disturbing was this one from Rajesh, who gathered up rupee in his village and rolled the dice on a transaction in DEX and was front run by a bot at that time and lost all the money. And one shudders to think what happened to this poor fellow. So, as I said, this is not a hypothetical concern. What can we do about it? We probably can't eliminate all bad MEV, all exploitation of users of this kind, but we can at least build tools that help mitigate the problem by enacting policies for users that are fairer in the sense of reducing the opportunities for miners to take advantage of the ability to order transactions. And this is the goal of fair sequencing services. Just a reminder, in the current model of transaction ordering, it's the miner that decides unilaterally how transactions get ordered. In FSS, the goal is to replace this miner with a collection of nodes, with a set of entities, in particular a decentralized committee to determine how transactions get ordered. And this ordering happens off-chain. Natural question to ask is, where are we going to get this committee? Where are these nodes going to come from? Well, it turns out that decentralized Oracle networks are actually great ready-made committees. They provide the trustworthiness that is required for this operation. And also, as it turns out, reporting on observed transaction ordering transactions is a very natural Oracle functionality. After all, what do oracles do? They observe off-chain behavior or activity. They reach consensus on their observation, and they report their observation on chain. And that's exactly what FSS is doing. We plan to deploy FSS in 2 phases. In the first phase, we're going to implement what's known as secure causal ordering, or more formally, secure causal atomic broadcast. The intuition here is that this type of ordering involves no node seeing the payload of a transaction, the actual substance of a transaction, before the transaction is ordered. And this idea is actually decades old. Dates originally to, I think, the PhD thesis of Mike Reiter back in the 90s. How do we accomplish this? Well, very simply using encryption. So here's the idea. Transactions are submitted to the committee in encrypted form. They're encrypted under the public key of the committee. The corresponding private key is secret shared among nodes in the committee. The committee then decides how to order these transactions, and decides collectively on definitive ordering of those transactions before it decrypts them. The committee performs a threshold decryption once the transaction ordering has been decided upon. This is great because it's hard to front run or otherwise attack transactions you can't see. And by the time the transactions are revealed, it's too late to squeeze in additional transactions. So even a rogue committee member doesn't have the power to extract MEV from users. It works very well, but it has a couple of limitations. The first is that metadata are not encrypted. For example, you can't encrypt the address from which a transaction has been sent. And metadata can convey enough information for an adversary to extract value from users and to mount attacks roughly like the type that I described. The other thing it doesn't protect against is what I call blind front running. So suppose, for example, there's an ICO and one node in the committee or some other adversary wants to be the first to buy tokens in that ICO. Well, there's nothing in the properties of secure causal ordering that prevent the adversary from squeezing transactions in at the front of a block before other users' transactions. So these two limitations of secure causal ordering suggest that it doesn't give us everything we're looking for. Note, interestingly, that secure causal ordering doesn't actually specify the ordering of transactions. It merely says that they need to be ordered before they're decrypted, but it doesn't tell you how they should be ordered. And this observation is the springboard for the second phase of development or planning, namely the addition of the Equitas family of protocols. Equitas is a set of transaction ordering protocols, actually consensus protocols with ordering, developed within my academic group in work spearheaded by Mahimna Kelkar. And the intuition here is that transactions get ordered according to the time that they're received, in particular, the time they're received by a supermajority of nodes. It's a little bit more complicated than that, but that's the idea, that's the intuition. So if we put Equitas together with the scheme I just described, the secure causal ordering scheme, here's what FSS, or the FSS architecture looks like. Transactions are submitted in encrypted form, and they're ordered by Equitas, again, roughly according to the time that they're received. Then they get decrypted. By putting these two approaches together, we get some nice properties. Equitas, in particular, prevents attacks of the type that I described earlier against secure causal ordering. Equitas prevents metadata-based and attacks and, to some extent, blind front-running. But Equitas does have a limitation. Right? It's potentially stronger than secure causal ordering. It is in certain network models, but it's sensitive to network adversaries and somewhat complicated to implement. On the other hand, Equitas, as I said, is in principle, when it's working well, stronger than secure causal ordering. Okay? If things go well, Equitas gives you exactly the type of ordering of transactions you're after. If Equitas fails, though, by also implementing secure causal ordering, we ensure that there's a strong backstop. So if a network adversary is able to manipulate transaction ordering and bypass the security properties of Equitas, secure causal ordering still presents a barrier to manipulation of user transactions. FSS can be used in a couple of different settings. It can be used as a pre-processing stage for L1, for example. You can associate particular smart contracts with FSS, or an FSS enable particular smart contracts. Ordering, though, is increasingly taking place off-chain in L2 systems. As with the rise of L2 systems, the power of miners to order transactions is being, the locus of transaction ordering is shifting away from miners to L2 systems like rollups. Well, FSS works equally well for L2 systems. L2 systems include transaction sequencers, and those transaction sequencers can be FSS enabled. That's it for my presentation. If you're interested in learning more, I'd encourage you to have a look at the Chainlink 2.0 white paper at the URL given there, or you can take a look at the 2 academic papers that I mentioned in the presentation. Thank you.
Thank you so much, Dr. Jules. Appreciate that presentation. Coming up next, we've got Rich Brown from the Smart Contract Research Forum. Smart Contract Research Forum, or SCRF, is a great place to go to find more research initiatives, and we'll hear all about that from Rich Brown coming up right now.
Welcome to the Intro to SCRF presentation. My name is Richard Brown. I'm the lead at the Smart Contract Research Forum. Previously, I was the head of community at MakerDAO for a few years. I'd like to spend the next few minutes giving you an overview of SCRF's mission, talk about what we do, why it's important, and a bit about how people can get involved if they're interested. To start off, let's talk about what SCRF is. We are a community of researchers, analysts, industry experts, and academics gathered together to pursue our goal of making blockchain research accessible to the entire ecosystem. And just as importantly, to make the blockchain's problems accessible to academia. We do this by maintaining a highly moderated chain and project agnostic forum where civility and intellectual rigor are paramount. On top of this forum, we apply incentives. This is the crypto space, so through intelligent application of financial, reputational, and intellectual incentives, we encourage the type of behavior we think which will help us achieve our mission. A little bit about our origin story. SCRF was born out of a series of conversations I had with Sergey Nazarov, who's my co-founder at SCRF. We had a chat about the nature of community in the blockchain space. We spoke at length about what community means, how it can be applied to a mission, how best to design a community that creates reciprocal relationships of value with the organization that's constructing the mission and the users that are participating with it. Through these discussions, we both discovered that we shared a frustration, and that frustration was at the puzzling divide of between academia and industry in our space. We wanted to know why there was no place for blockchain researchers to seek open, real-time peer review, critique, and collaboration, and by extension, why the technologists in our space and the community leaders didn't have a location where they can go to engage with the people, the academics and researchers who are also thinking deeply about the same issues that we are. So, out of these conversations, the Smart Contract Research Forum was born. Let me dig into our mission a little bit because it's deceptively important, at least I believe it is. Our ecosystem consists of a number of stakeholders, but for the purposes of this discussion, we can divide them into 2 groups. There are people that have problems to solve in the industry, and there are people who have solutions to share in academia. So broadly speaking, that encompasses industry and academia. SCRF exists to answer an obvious question, but a pernicious problem all the same. Why aren't academia and industry speaking to each other? We need both groups sharing their data, their insights, their research, and their solutions, so we're going to be better positioned to face some of the challenges that are coming our way. So as a thought experiment then, we asked ourselves, so why as founders and architects and community leaders, why aren't we drawing from this well of research that's available to us? Economics, mechanism design, governance, privacy, auditing and security, et cetera. These are all heavily explored schools of thought. Yet in our space, we continue with an endearing, occasionally inspiring, but ultimately frustrating habit of starting from scratch. And it's not entirely clear to us why that is the case. So in order to solve for this problem, SCRF had to break this problem down a bit and look at them one by one, see if we had some solutions for these things. And so the first problem we thought about was the conversation problem. Social platforms have a noticeable bell curve of utility. when they're allowed to develop organically, they generally follow a predictable life cycle. Core membership creates value. New participants are drawn to this value that they find there. Culture and norms are eventually overwhelmed by the newcomers. The core membership leaves, and the quality of the discourse eventually diminishes until the rest of the users leave as well. This is not an uncommon pattern. I'm sure we've all experienced it. OGs in the space will remember the rise and fall of Bitcoin talk, which is sort of a textbook example of this issue. The way that we solve for this at Scurf is we have a dedicated team of paid moderators and operations personnel, project managers who have no profit motive. Their profit is derived from the maintenance and the support and facilitation of this environment, so the forum itself. That means that we have a project that supports the space that's completely chain agnostic, project agnostic, and is mentoring and facilitating this community of users that are here to seek open and constructive peer review, civil critique, conversations with people in their space or in their areas of interest, and collaborating to make crypto better, or blockchain in general. Attention is a scarce resource in our space, particularly on the industry side. We need to move quickly and execute as fast. That doesn't leave a lot of time for introspection. Academia has many problems of its own, but one of the benefits there is that there's a certain luxury for academic rigor and deliberation. There is a synergy between these two groups. Industry needs to bring some of this vibrancy to academia. Academia can provide us with that insight and that intellectual rigor and that leg up onto solving problems that we might be whiteboarding without realizing that the solution exists in somebody's filing cabinet already. So we deal with the attention problem by having a community of researchers and academics that we incubate and mentor and train in the forum of junior analysts and academics and postgrads, whose job it is to surface, discover, surface, summarize, and rebroadcast novel, actionable research in the space and bring it to the attention of the rest of the ecosystem. These researchers are supported by senior research associates or research fellows that we draw from academia and from research think tanks and research agencies in the space who provide guidance. These posts that we create are presented in a format that allows developers, founders, and architects to easily understand the applicability of a piece of research without having to dive into the source materials, which can be a significant challenge for just myself. Next problem, discoverability. Information in our space, well, I'm sure in many spaces, but I'm familiar with ours. So information in our space is buried in silos, ivory towers, archives, blogs, private repos behind paywalls, on social medias. Finding research is tough. And if you do find it, it's potentially going to be stuck behind a paywall, or if you get it out from there, in an inscrutable PDF filled with latex and graphs that are, I'm sure, very, very impressive, but difficult for industry to wade through. This prevents a bit of very significant cognitive overhead that needs to be dealt with. On to the next problem, it's the bias problem. In our space, we are all familiar with a tendency for discourse to find the lowest common denominator, frankly. There's a lot of territorialism in this space. Maximalism runs rampant. Antagonism, shilling, groupthink, all of these things are common, rife with logical and rhetorical fallacies and traps. It's difficult to have a good conversation. And if you do have one, how long it's going to last is anybody's guess. We have a solution for that problem as well. And this is potentially one of our most innovative, probably one of the most valuable things that we can bring to the table. And it's a surprising one in how simple it is. But as far as I'm aware, there's never been a venue like ours that takes no position. It has nothing to sell. We mint no tokens. We exercise no editorial control. We're not a journalistic enterprise. We're not looking for, nor are we supporting drama or contention. Our role is simply to facilitate the surfacing of testable solutions for the blockchain space. We want to find actionable research. We want to find researchers. We want to find industry. We want to connect those two groups together so they make blockchain better. So that's the recap of the problems in this space. I spoke a bit about how we are going about solving these things. We have a great deal going on and a great deal more planned. Lots of work available, and like most of the space, we don't have enough people to do it. So here's the call to the ecosystem. If you find what we just went over at all compelling, Scurf needs help. We have lots of positions available. We're looking for project managers. We're looking for editors, illustrators, community managers, researchers, junior, intermediate, and senior to join us in our mission. And once again, that mission, while it's not terribly compelling in a space full of unique crypto primitives and earth-shaking developments on a weekly basis, our mission is to provide support for the intellectual commons in the crypto space and do whatever it is we can to help push the space forward and provide support where it's needed across all chains, across all projects, across all faculties, across all regions of the world. If you found any of this particularly compelling, like I said, please join us. Put a link on the screen about where you can find us for more information and where you can join us in the chat. Looking forward to talking.
Thank you so much, Rich. As a former academic myself, I appreciate the initiative of Smart Contract Research Forum. It's a great place to start that bridge and continue the conversation and meet our industry with our academic research. So props to you and your team. And in that spirit, I wanted to, I'm happy to introduce some of the people from Smart Contract Research Forum for our next panel. I'm going to let the moderator, Lucas Nuzzi, introduce everyone, but the next panel is called Privacy and the Evolution of Snarks.
Hello, and welcome to the panel on Privacy and Snarks, organized by the Smart Contract Research Forum, or SCURF, as part of the Smart Contract Summit. I'm Eugene Leventhal, the operations lead here at SCURF. This is actually part one of the panel, as the conversation was just too good to cut short. You'll be able to read more about the panelists and to watch the rest of the video for free at smartcontractresearch.org/T/622. And with that, I'll pass it on to our moderator for this panel, SCURF's research lead, Lucas Nuzzi.
Thank you, Eugene, and welcome everyone to what's going to be a really fun discussion on the state of the industry when it comes to ZK rollups and the low-level protocols that enable them. And to have this conversation, we have two of what I consider the top researchers in the space doing work in this area. Ariel Gabizon, who has been doing research in this area for quite some time, now at Aztec Protocol, who's building a really interesting ZK rollup solution, as well as Alex Vlasov, who has also been researching this area for quite some time and has been working with ZK Sync in their various approaches to rollups. Gentlemen, welcome to the panel. Really a pleasure to have you on board. Maybe to kick things off, you guys can give a little bit of an introduction of yourselves and your projects, and we do have some questions to go over, but it'll be great to hear from you guys the evolution of your research, what you've been working on, and the areas that you focus on. Maybe starting with you, Ariel.
Yeah, sure. So I guess, yeah, I basically spent a lot of years in academia doing math, computer science, and once basically I read the Bitcoin white paper, I felt that I should sort of get into this world, and the best way for me to do it seemed to be through these ZK zero knowledge proofs, since they were relatively math heavy with the sort of math I liked and was comfortable with. So that led to me working with Eli Ben Sasson back in Technion University in Israel in the early days of Starks before they were called Starks. And then I sort of left academia to work on Zcash, the first trusted setups. The first sort of commercial use of Snarks was there, and that was really exciting. And and then a sort of a chance meeting with Zach Williamson led to this this universal ZK snark called Plonk, which sort of, I think, really put universal snarks in sort of in the practical, made them very, very practical. And and then that led to me moving from Protocol Labs, where I was working, to Aztec, to focus on this work with Zach and the Aztec team.
Excellent. How about you, Alex?
Well, regarding the way into snarks themselves, I was participating in ETH Waterloo. I think was actually the first one from ETH Global series, which continued for a few years after. And at this hackathon, there was the talk, well, first by Vitalik on snarks, and then by Eli Ben Sasson on Starks. So this is when it first caught my attention in general for what's possible to do with the snarks at that point in time. Then I was working on plasmas in different flavors. Then at some point we decided to form a Meta Labs to bring the best from two worlds and kind of marry the rollups and ZK snarks to make the ZK Sync, the ZK rollup released a few years ago. So now we are continuing to develop it to bring in the version 2.0, and it should be able to run user-defined smart contracts, which should be compilable from Solidity and Sync, which is our developed programming language. Also not specifically for circuits, just normal programming. In theory, we should be able to even build Rust and run it in our architecture, but it's a little bit off topic. So yeah, along the way, I participated in improving snarks. As for us, it's more like a tool than something like pristine and fundamental. So for this purpose, we we published a small paper about the transparent polynomial commitments, which used Fry, and then which led into the expanded paper called the Redshift. So this was roughly my way into here. Now we're in the final stages to bring ZK Sync 2.0 with smart contracts to life, with basically all snark related work done. Now we just have to check the code, run the tests, and be able to release it so people can try a compiler, see how the VM was designed. Actually, we have to write a lot of manuals, but it's on a good track.
Yeah, it was super interesting background, and I think it ties things very nicely. I do remember when Vitalik first described what we now call ZK rollups, essentially applying this technology, which the industry had predominantly seen as an approach to privacy with projects like Zcash, applied to scalability, right? Enabling transactions to be processed outside of the blockchain, and essentially borrowing some ideas even from Plasma at a time when more research was coming out on the feasibility of Plasma that I would say disappointed a lot of people. So to set the stage a little bit, it would be interesting to talk about the commonality and the theme of the projects that you guys are working on, because when people think about ZK snarks, they still have this anchor towards privacy, right? Whereas because of the research that you guys have produced over the years, that theme has shifted quite a bit, right? From privacy to scalability. And now with recursive snarks, with the ability to program contracts using these systems and still carrying some of the benefits that snarks intrinsically have. So maybe to set the stage a little bit, Ariel, could you just talk about recursive snarks and Plonk, and what is it that enables these contracts to be generalized and really just granting the tools to the developers to build these contracts using this technology?
So I maybe one thing to mention is like, why are recursive snarks relevant to or essential to programmability? And I guess one part of that is if eventually you have one sort of verification contract that is constant, like say this is the contract that verifies the rollup. So this contract is fixed. It's not dependent on a specific program. So in this sense, recursion helps you because whatever your sort of actual circuit is, the final thing, the final program you're running is just a verifier. Sort of what is the relation between Plonk and recursion? So the first thing to notice is that in principle, there's any ZK snark gives you recursion because ZK snarks allow you to prove statements about any program. So you can always prove a statement about the snark verification program in particular. So recursion was never impossible theoretically. It was really a question of constants. And the concrete constants when writing your program, your snark verification program, due to basically field mismatches, we're just very large. So one reason why sort of Plonk made recursion more simpler is basically shaving off a few constant factors in terms of representing constraints compared to the R1CS representation. And these sort of factors shaved off exactly sort of made this writing the recursive verification program more practical without the need for any special tricks like elliptic curve cycles. Yeah, so I'm saying a lot of things there that maybe need explaining, but that's sort of the mid to high level.
Yeah, no, absolutely. And I think there's part of the priming that I see exists when people reason about ZK rollups. I think it's exactly that, right? I think there's a lot of priming in terms of applicability. I think there's this idea that a ZK snark is application specific, right? Its role is to simply verify transactions. And the reason why I think there's been a lot of this priming is that in order for you to, under previous systems, bootstrap an application, it requires creating this string through a process that must generate a random number, right? A random string. And what your research has shown over the years is that this is abstracted away through shaving some of those parameters, so that you can apply this technology to broader programs without the requirements of actually regenerating these strings, which increase kind of the potential attack vectors of these systems, right? So it really just enabled a way for you to reuse that SRS for a plethora of applications that can then be granted the benefits of this technology. Is this a correct characterization?
Oh, well, that is, I mean, so that is another huge issue. universal snarks like Plonk don't require a setup per circuit. I was referring to this, I guess, other more low-level issue that to actually write the snark verifier as a program, you need to sort of simulate these field operations in a non-native field, and that was extremely inefficient before Plonk. But actually, maybe you're right that you're right that a much more basic issue, if you want recursion and user-defined circuits, so the universality is actually a much larger and more basic point. Otherwise you would need every user would need to run their own trusted setup.
And I think there's been a lot of really interesting content. I think even the initial Powers of Tau ceremony from Zcash that you were one of the architects of, I think there's a lot of mysticism around what that actually entails, right? And how that is performed. But the basic idea is that string must be secure enough or random enough so that you have guarantees around the provers and verifiers of these systems. Alex, you've worked on this scheme called Redshift, right, which was a really interesting piece of research. And it basically introduced an interactive Oracle proof system that used polynomial commitments to essentially circumvent the need for a trusted SRS. Could you talk a little bit about Redshift? What motivated that research? Was it the security and more universal angle that motivated that research? And also, if you could also talk about the evolution of that research and what led you guys into Plonk as that research evolved, and maybe the trade-offs associated with that research.
Well, first of all, I should mention that so there was for Redshift and its history, there was no particular decision to do such research. The historical state at this time was that there was a deep dive paper by Elie Ben-Sasson and his colleagues, which basically used FRI, proximity testing protocol, in some particular way, which allows them to have more efficient Stark. And here by Stark, I mean a proof system and the way of arithmetization, which is called AIR in the original paper. And basically what this paper was doing is very close to what the Plonk paper was doing in its original form, with just the polynomial commitments, which are Kate commitments. Basically, the prover commits to the set of polynomials and then draws a random point, then make a standard trick of quotiening. Basically, if your polynomial is at this value at this point, then you can perform a formal division operation, and that the result will also be a polynomial. And then they used the FRI to prove that this result of the division is indeed very close to polynomial, which was sufficient for all the purposes of Stark as a proof system. But it was never called a polynomial commitment, even while it was doing basically the same as Kate commitment itself, just in a different way. I read this paper, and then after half a year or something like this, there was a Plonk paper, which I seen was covering largely the same details in the same format. And only then I just randomly in a train actually had an idea, well, this is basically the same, and why no one tried to do it. And then we spent 2 weeks trying to convince ourselves that there was some trivial mistake and overlook, that this is very very much the same idea, which was never covered. So then we made a very small paper on archive, which was basically talking about the polynomial commitments, which was strict commitments to only a single polynomial, and used Pry as a proximity testing protocol in a mode which is called unique decoding radius. A little bit simpler, it was testing that something which prover gave you is close to the polynomial, is like very close to polynomial. Let's call it this way for simplicity for now. And then we started to, which led to larger proof sizes, which was a problem with original Starks back then when they were introduced. They required very small radius for testing of proximity, which led to larger proofs. And then we decided to go beyond this, the same achievement which was done in the Deep Pry paper, to go beyond unique decoding radius, and this was done in the Redshift paper. And the main trick, or like slash problem, with going beyond decoding radius was that now the prover is able to commit not just to a single polynomial, but some set of polynomials. The set is still small compared to the field size, so it wasn't the end of the day for most of the for soundness, but it would be okay for witness polynomials. So the prover can give you something which is like maybe one polynomial out of 10, which satisfies the verification relationship. Was still fine for witness polynomials, but it would be a problem for setup polynomials which were present in all the proof systems other than Starks and others which are like for uniform circuits. Let's not go that deep into this direction. So we had to find a way how to actually pinpoint a single polynomial out of the set at the setup time, which was done in Redshift, which basically brought the best from the Starks world and basically transferred it to all the protocols which require polynomial commitments. That's why it was that's why it was demonstrated on Plonk itself, because it was first an original inspiration, and then the idea was that you can do the same, you can run the same proofs by just swapping the commitment scheme and maybe adding some factors in the soundness. So that's why the Redshift was made in a form which basically taken the Plonk and kind of changed it a little bit.
So actually,
go ahead, Ariel.
Yeah. So actually, Alex, what do you think really about the non-pre-processing Starks versus doing like Redshift? Do you think it's like, what if you had to choose between these two? What would you choose?
Well, I don't I have a preference for one with the pre-processing for reasons that it can be much simpler to write and designed by people who cannot just take the polynomials and write the polynomial protocol by hand on a piece of paper by basically linking all the witness values by themselves in a very large set of witness polynomials. So the problem with the protocols which are like Starks without pre-processing is that your set of constraints is so much non-trivial that first of all, it's difficult to design without mistakes. And the second, after you design it, it's unlikely that you will find another person who would be able to review it. But if your proof system is more universal in the sense that the pre-processing written once does everything for you, and when you design the circuit, you only write a code which is much simpler, so you do not manually take care which variable is located in what polynomial at which index, and you basically treat them like values and variables in any some convoluted programming language. It eliminates a lot of mistakes, and it actually becomes auditable and understandable by the wider audience. That's why I think that there are more people which are able to write a Plonk circuit, or maybe understand the to understand Sprout or Suplink Zcash circuits than people who would be able to write a Stark to, for example, do the Peterson commitment. And Peterson commitment was actually quite trivial. For whatever people in Starkware did for the Cairo programming language, I can guess how it works. I didn't look in details and didn't try to reverse it, but I can guess how it works. But I think it would be non-trivial for anyone to try to try to write an external manual to how it's actually implemented. Even so, you will see a full set of constraints in the verifier if it's implemented as a Solidity contract.
Fascinating. Yeah, it's interesting to hear about the reasoning behind some of these trade-offs, right? I think if the research around even more recently with Plonk and its newer iterations and all of its predecessors showcases is that there are some non-trivial trade-offs at play, right? When it comes to usability, proving time, verification time, proof sizes, even complexity. What other trade-offs, fueled your research as you're thinking about, for example, shifting the commitment scheme, in this circumstance for efficiency purposes? What are the trade-offs that influence your research, especially as you're trying to build a system for Ethereum applications?
Well, I think one should actually separate two parts here. One is designing the final system in the sense that it's like what circuits you write, which is the functions of the circuits, whether those circuits require some recursive verification because they kind of prove different substatements of one larger logical statement, and so they require recursive verification. And another trade-off is purely regarding the proof systems and like concrete implementations of the recursive approach. For example, if you take the fractal paper, it was a direct comparison was done there. So the fractal paper is also transparent snark or Stark, like however you want, with the pre-processing. And what they did is they presented the size of the circuit which does the verification, a recursive verification of single statement, if you use one hash or another hash to construct the Merkle trees when you do the proofs. So if you use a standard non-algebraic hash, then your verification circuit is very large because non-algebraic hashes take a lot of constraints to implement, which was partially solved by the Plonk with lookup tables. We can cover it a little bit later. And another example they did, and they used the rescue hash as a hash to construct the Merkle trees, which led to much smaller circuits to implement the verifier, but which also led to the much larger proving time because the hash itself was very slow to compute. So this would be, I would say, I think more to the question which you asked originally, in the sense of different trade-offs. In a similar direction, you can view how many constraints does one recursive aggregation in Plonk take. And it also depends a lot. For example, if your verification keys are all the same, it's one number. If your verification keys are all different, it's completely different number. Like I think five times larger, if I remember correctly, like roughly at least. And this even would not be a complete verification, it would be aggregation, which is also a little bit different procedure. And Ariel can cover it in details, I think, much better than I do. So like for this, we should separate this talk and first maybe talk about the proof systems and trade-offs coming from proof systems themselves. And then you can try to talk about how you can actually try to implement a programmability kind of separately, and which is unlikely to depend on how on what proof system you take if you have the recursion. It's another like field of optimizations, I would say.
Yeah, that's a very interesting framing. I think That's exactly right. Right. You start with the proof system, and then recursion is applied, and then you have all the interesting benefits of it. But Ariel, were you going to say something?
Yeah. Well, what was I going to say?
I guess, do you agree with this framing? Is this the correct way to reason about the trade-offs of these systems?
What is that way again?
It was more about that you can separate this large equation made by Lucas into one is like what are trade-offs in proof systems and their particular implementations versus a design area of how you actually implement programmability. And from my perspective, those are like completely two different tasks. One is optimize how you implement proof systems and recursion, like particular hash function choices, commitment schemes choices, maybe something else. We can talk about this. And another one is how you actually make a circuit, which, for example, does the ZK rollup, and maybe verifies user-defined circuits and contracts. So I would say like two completely different deals for me, at least.
Yeah. Well, one thing just I think about you, Lucas, originally you, in terms of trade-offs of polynomial commitment schemes, I think right now the KZG, the Zawarucha Goldberg one, is clearly like the winner. Right. I think the only reason to use anything else is if sort of carrying friendly curves will at some point be crushed, and yeah, and then there'll be no choice but to use something else. Yeah, I don't know. I think there were a lot of parts of this of this question. Maybe maybe let's go to the next question. There's a lot of parts, so I'm not sure what to.
It's a loaded question.
Exactly. Yeah.
But you did mention something interesting with regards to pairing-based cryptography that we've had a couple of discussions in the past, and you, of course, a huge topic of your research is security. Ethereum uses a variant of BN256 as a proving curve, or as a curve in at the base layer. ETH2 moving to BLS 12.381. What is your take on the security of these curves and maybe of pairing-based cryptography more generally? Do you think there will be a scenario in the short term, and here's another loaded question, where these curves need to change or setups need to change?
Yeah, I don't know. It's like asking, will Bitcoin hit $1 million, or let's say, will Bitcoin hit $100,000 within 3 months, 2 years, 5 years, never?
Is it a matter of when, not if?
Well, there is a question of if. It's really hard to say. You've got these number field sieve attacks that are what makes us go to larger curves, and it's really tricky to say. You occasionally have a new paper with some improvement, and then it's sort of like, how fast are these improvements going to go? Are they going to get stuck? Are they going to yeah, so it's really hard to say. I mean, I tried to understand practically how safe is BN254 for the next few years. Yeah, honestly, it's really hard to say. It's really hard to say if, like, okay, the current attacks need a little extra trick to make it dangerous to use BN254, or there's going to be like 10 years till this trick comes, or it's really hard to say. One annoying thing is that you've got when you've got the Pollard's row algorithm, so the proof runtime is very well analyzed, but with these number field sieve attacks, they're saying, okay, this is the runtime under these number sort of theoretic conjectures, and then you're sort of like, okay, so should I update my code according to the more pessimistic in terms of not say the user, not the attacker? Should I update my curve according to the more pessimistic estimate sort of versions of these conjectures, or should I actually wait till there's because so these curves have 254 bits that we're using right now in Ethereum. So if you look at Zcash, for example, they the minute there was a paper saying, okay, there is potentially an attack on this curve, immediately they moved. So, what should be your what should be your approach? The minute someone writes a paper where this maybe is not safe anymore, do you move then? Or do you say, well, show me an actual attack on, you say, okay, SHA-256 is not safe anymore. It has 80 rounds. Just show me at least an attack that breaks 70 of the 80 rounds. So equivalently, all right, show me an actual discrete log computation in a field that is, getting close to what we're using, and then I'll switch my curve. Or it seems, that the more what people are actually doing is the minute there's a paper saying, okay, this may be dangerous, they immediately move. They don't want more evidence. So honestly, this is a bit of a rant. When Zcash, when we moved so quickly, I was like, oh, we're sort of giving them too much, credit,
legitimizing it too much.
But on the other hand, when I talked to some of these experts in the last few months, I don't know. It seems like they have a lot of tricks up their sleeves, and so it's this is sort of a long way of saying. I don't really know. I mean, it really is like the price of Bitcoin. How long will it take to hit the next the 100K? Is it going to be tomorrow? Soon? Is it going to be never? Is it going to be really slowly?
No one knows. Yeah, it's an interesting area of research, and I think it's exactly what you said, right? It's really a matter of making these design decisions on a proactive or reactive basis, on the basis of how legitimate or how concerned from a practical perspective. Some of these attacks are, Klaus Schnorr recently said that he broke RSA, and is the industry completely moving away from RSA? It's not really happening. So it fits into those trade-offs. But is this something that as you're designing these systems that you guys take into consideration? Do you have kind of contingency plans if this were to happen? How proactive is that design? Because I would imagine it would be a non-trivial shift, right? If parent-based curves were to be, as you mentioned, at 70 rounds, be proven susceptible to some of these attacks. Or is that now part of those research decisions or design decisions?
Well, I think the nice thing is since
that, I co-founded a cooperative, a multi-stakeholder cooperative in the real world, as a real business, with 1,500 photographers, which is still running today. And before that, I ran a 300-person pirate corporation in EVE Online, which Frey, you might, or Seth, you might have some insights into, where I learned most of my community building skills, actually. I've just been coasting on those since then. So that's why I'm here.
It's interesting that you should mention online cooperatives in relation to your kind of DAO resume. So why would or wouldn't communities want to consider a DAO, and why is it now that blockchain communities are really kind of interested in investing in governance?
So I definitely think that the metaverse sort of like conversation which we're sort of bringing up here with EVE Online and World of Warcraft and so forth is pretty relevant here. Like, especially during the pandemic, I think people started to really understand the reasoning behind the popularity of those sorts of organizations, which like this fringe sort of, or roughly more fringe group earlier on already did. I definitely also grew up sort of like playing World of Warcraft and like helped run guilds and raids and so forth. And that experience was like formative to the point where it didn't seem strange to me to like interact with a whole bunch of random people that I don't know online towards like some common goal. So the idea of like the Ethereum ecosystem never really seemed that strange to me. And it's interesting that like it does seem strange, or like prior to the pandemic did seem strange to so many people. But I think now there's a lot more understanding of the ability for people to coordinate online being like a core primitive of just like where we're at as a society. And I think that it's naturally going to be a kind of thing that like progresses over time. We probably still have a lot of work to do in terms of like, you know, when we talk about people creating DAOs, the question arises, like, what is a DAO, right? And I don't think we're there yet in terms of really having like to something that Rich was saying just before we sort of started, like a formal definition of like what or instantiation of what a digital cooperative should be in the future. But I think we're certainly making a lot of progress there. And I think that there's certainly been an acceleration just in this general idea of people coordinating online to like generate value being like a normalized thing. The other last example I'll just very quickly mention is Roblox, which is like now obviously a public company, now obviously very popular. And like, even I think that's part of the reason we're seeing like traditional Web2 folks, like even the standards of like DC Twitter folks, like now caring about this space. So I'll pause there, but that's certainly been my journey, I guess. And it's I think to me, one of the reasons we're seeing so much popularity in this concept now.
I think just jumping a little bit on Scott's thought, like, and you alluded to it as you were introing Kelsey, and we also heard Rich talk about his participation both with online communities and then in cooperatives. Like it just strikes me that a lot of the people who are interested, it's almost the perfect opportunity for people who are interested in cooperatives to collaborate with people who are interested in online communities, because both different forums have so much important precedent to provide to those who are now thinking of setting up DAOs, and also determining what DAOs are. I mean, I think we've all alluded to that. Like, there's no clear definition as to what a DAO is, and there's a lot of different thoughts about what that could be. And that is an incredible ambition, I think, of somebody to take on that task to define DAO in a way that's meaningful and important to the community. And I'm doing a thing right now with the DAO Research Cooperative where we're trying to identify some of the most pressing issues for DAOs, thinking broadly like legal issues, governance issues, treasury management issues. And in a couple of the initial calls I had, that was the first thing that folks brought up. Like, I'm talking to different leaders in the space, and it's what is the definition of a DAO, whether it's related to the kinds of systems that a particular organization uses, or the kinds of obligations it has to its members, or a large variety of things. So when we think about why DAOs are popular, I think in part DAOs are popular because the definition of DAO is so broad that anything is a DAO today. But we might see a fall off in popularity when we may, start defining it more narrowly, or at least creating subcategories for DAOs.
Well, I don't want to put you on the spot though, but can you get us started? What is your definition of a DAO? What's your working definition when you're speaking to these people?
Ooh, that's so tough. I really don't want to dodge the question. And so maybe I won't I just think that we're at such an early stage of experimentation that we've yet to figure out what a DAO is, candidly. And I know that's kind of a shady answer, but I was actually talking to a guy, a VC earlier today, and I was asking him about, when you're talking to organizations that you're looking to invest in, and they intend to ultimately become DAOs or like Dexit, how do you think about the way in which they're composing their DAO? How do you think about their timeline for decentralizing into a DAO? And that was really his response is, we're so early here that we actually don't even ask that question because we just don't think that someone could give us a serious answer. And candidly, I'm a little bit of the same mind. I was talking to Julia Rosenberg from Orca, and she thought like very critically about this sort of stuff. And she was the first one to bring this up to me as a big issue. And from her perspective, and I don't want to misquote her here, but she was talking about uses of particular systems. So when I think about that, I would want, a forum for proposals. I would want voting mechanisms. I wouldn't just want a Telegram group. And so to me, it maybe very broadly is an organization that allows for decentralized governance, decentralized voting, but I would leave that very broad because I also have kind of a specific view on what members of a DAO should be able to vote for. And I'm not a huge believer in kind of a one token governance system either. So what we define as DAOs broadly today, I may not totally agree with. And I imagine that's probably the same for most people on this call.
I like that though, because I mean, at the moment, and we're talking about this process of how you get to a DAO, I like the DEXIT acronym, so short for Exit to DAO, which is a take on Nathan Schneider's Exit to Community. But they're not decentralized yet in many instantiations, and they're not autonomous. They're kind of organizations. And I think a lot of the blockchain community is trying to figure out, like, what is an organization? Leighton, you mentioned a suite of DAOs that you're involved in. What's the varying mission or objective or goals of these different groups?
Yeah. So I think I draw one line very clearly in my DAO involvement. So pooled together, I wouldn't really call it a DAO, to be honest, because to me, it's a protocol that has tokenized governance. And some people call those DAOs, but I don't think of those as DAOs like Compound, Uniswap, even Maker. Like, if you're familiar with these protocols pooled together, like, I think of it as a protocol with tokenized governance, whereas Venture DAO and Pleasure DAO, they both have DAO in the name, I think of those as DAOs. And the difference in my mind is, like, Venture DAO and Pleasure DAO are a group of people who came together to sort of like actively go do new things, whereas Pool Together is like a protocol that was already established, already had hundreds of millions of dollars in it, already was functioning, and the control was just given of an existing self-perpetuating project to the community. And I think that's like a very different thing than, in my experience in like Pleasure DAO and Venture DAO, is they immediately become very hierarchical. But Pool Together is not. And it doesn't have to be, because there's a very narrow space that like we're like making decisions about. And because we're not like debating like, completely arbitrary subjects like we are in Pleasure DAO and Venture DAO. So that's how I think of them differently, which, I'd be curious to hear Seth's input, because I think I would be curious how that maps to maybe like categories in a more academic sense, but that's at least from my personal experience.
Let's see. Well, categories. So I think that I have something a bit akin to folks here. This aversion even to defining a DAO, I think it's perfectly legitimate and from my perspective, encouraged to end with definitions rather than start with them. To have a word be the name of the thing you're trying to understand. It's consistent with a very iterative, empirical kind of approach that sort of represent, typical of the kind of experimentation that we see here. And in line with that, all governance taxonomies that I encounter in my work I'd say most of my effort goes into trying to break them or push them, and I'm still struggling. As you go across domains from a physical, real world, let's say nation state system, which is where a lot of our taxonomies come from, to a small scale self-governing system. I actually also got my start organizing cooperatives and moved into the online space after that because it's easier to do data science on. I'm originally in out of the housing co-op sector. So taxonomies of small-scale governance systems, and then moving on to that into the emergent taxonomies of online communities, how they understand the differences between themselves. We are still not at a place where there's any kind of unified taxonomy or ontology, I could say, of the axes along which governance systems vary. And so I'm inclined, to everyone's disappointment, to come just as much as a watcher and observer than a holder forth.
Have you been tempted to, so the co-op space has been examined for the last 400 or 500 years, and there's a lot of subdivisions and categorizations and definitions there. Have you been tempted to sort of use those as templates to the new DAO ecosystem, or do you find that it doesn't translate?
Well, you know what? It's a really pleasant surprise to find so many people here coming with some kind of co-op background or interest in, in my understanding, I'm still figuring out the kind of mapping of ideological backgrounds of people in this space to the subset of kind of blockchain applications that they tap into. I do have one kind of litmus test I use for kind of knowing where to start talking to a person, which is, okay, visualize utopia. It exists. Let's say utopia exists and we're in it and it runs out of a building. My question for a lot of people tends to be, are there any people in the building? So is governance a system that runs itself, or is it inevitably something that we're involved in, that we use as a set of tools to govern ourselves, that we're active in the work of governance? And one kind of sense I'm getting already from at least the folks in this small circle is that a lot of you end up more in the idea that it doesn't run itself, that we're active in the acts of governance. So if anyone wants to not be pigeonholed by me, I'd love to hear that.
So that's helpful. And to the point about the name referring to autonomy or not, Aaron Wright recently said in a Stanford piece that there are two main types of DAOs, participatory and algorithmic. But really, in what we've all described, there's both participation, or it's not a DAO, and there's also algorithms. So there's something happening through smart contracts and kind of automation there. So what are your views towards how much, or what, I guess, what's being automated? To Seth's point, is it the people being automated out of the system, or is it certain levels or functions kind of being automated to give autonomy to the people in the DAO? And then what does that actually mean?
I'll do a quick answer on that, because so like the idea of social scalability, like Nick Szabo's essay on that from, I don't know, the late 90s was definitely a super influential piece on all my work I've done. And what caught my attention about that piece is that basically his thesis is like smart contracts lower the cost of trust. And so what's being automated is the human trust that's required to broker relationships. And when you can lower trust, when you can lower the cost of trust of entering into new relationships, you can have more relationships. And I think the ideal world, you can have like a more flourishing social reality, because you're able to be in more relationships with more different people groups, because the trust, the need to, the trust is what's being automated. So that's my 2 cents on it.
I definitely think that there's something to that notion. In particular, we aren't very good, Seth would know this much better than me, but like Dunbar's number is a really important concept here, where once you scale past 150 people, it's very difficult to actually have any idea of who those people are, to have real defined relationships with them. And I think what we sort of designed, even beyond the idea of DAOs, in traditional structures, is this idea of well, what if we put in structures around voting, around like what it means to participate in the system that are more formalized and less sort of like normative, I suppose. And those structures sort of act as scaffolding that allows us to more easily coordinate with like a larger group, because there's like processes that we can all agree on, even if we don't necessarily like know each other. And that like is the scaffolding, to Leighton's point, that's like providing that trust there. And so historically, that was very kind of opaque. It was just like, okay, well, these people have sort of decided on these rules, and so I guess that's fine now, and now we can all abide by them. Like, we can trust these people and like the tower to decide what these things are. And like in theory, I wouldn't say necessarily in practice yet with DAOs where they are. That's sort of what we're, to Leighton's point, automating.
I would say just kind of adding on to that and thinking about the way that different DAOs, I really like the idea of the trust created by smart contracts allowing for scalability, and even other tooling like just the governance mechanisms, and even single token like in Uniswap or in Compound, for instance, the creation of grants programs. So grants programs are obviously, there's a huge part, at least in those two organizations. There's a grants committee, and they make assessments about projects, and then they decide to fund them or to not fund them. And so there was a vote done at initial stages as to whether or not those committees should be funded. And in looking at MakerDAO too, and I know Rich could speak more to this, but as I understand it, when MakerDAO decentralized or became a DAO and maybe left the foundation world, there might be other structural pieces I'm not totally familiar with there, but some of the functions were allocated to or assigned to new organizations. And so there were just different organizations under the treasury or the DAO, however you want to state it. And so you members of the DAO, and this isn't specific to Maker, are able to make some decisions about allocating responsibility to other people. And this is potentially where the co-op structure becomes really important. As Rich mentioned, there's 400 or 500 years of exploration there. And so we appreciate that cooperatives have members, but the members don't make every single decision. They assign decisions to management. And so in that same way, we're seeing assignment of different responsibilities, sometimes to organizations and at other times to potentially individuals and DAOs.
Rich?
Sorry, I was muted. So it relates to something that Leighton was talking about earlier, where some DAOs are protocol management DAOs, and it's largely governance mechanisms around binary decision trees, basically. So we vote for this, we vote for that. Then there's engagements or creative, and the list goes on and on. But from the co-op model, that you're kind of decentralizing or taking a committee model to a business unit. And so that's one of the ways that these more complicated, or to a business organization, that's why that some of these more complicated organizations are able to maintain themselves with more egalitarian decision-making processes, which in my mind kind of raises the question, and you triggered me with the Maker question, because as an organization becomes more and more complex, and all of its decision-making responsibilities get spun out to the community, is there an upper limit on the complexity of a DAO? Is it possible to scale, or are you sort of 3 steps past the protocol management level? Then maybe it's time to look at a firm instead, or does this group believe that the DAOs can scale?
That's interesting. That, because for me that brings up a little bit of a tension almost between where Rich is and where Leighton, Scott, and Connor are. For among Leighton, Scott, and Connor, it sort of seemed like there's an understanding that that trust didn't used to be scalable, and now it's scalable. But a little bit where Rich is coming from is, well, centralization is a great way to scale things. And because we have a background, because society has a history of centralization, scale hasn't really been the problem. We have scalable trust. There's centrally managed reputation systems. There's centrally managed currencies and centrally kind of architected, engineered market economies. And so then, so I'm curious, is there a conflict here? Is there a proposal that a decentralized scheme is ultimately more scalable than a centralized scheme? Are we challenging the scalability of centralized schemes? Or, as Rich is kind of possibly indicating, is the goal to get decentralized schemes as scalable as centralized schemes, and on top of that, expressing all the other benefits of decentralization?
Well, I was kind of hoping that Scott would jump in, because if I look at my crystal ball, Gitcoin is heading down sort of the same road. So these are the challenges staring him directly in the face. So do you have some insights, Scott?
Definitely, yeah. I think that's a fair assessment. My view would be that you have easy access to scale when you're centralized. Like it's very easy to scale, but it's simultaneously, I think, much more fragile than if you had a decentralized system, in the sense that like you don't actually have any kind of like redundancy against corruption, basically. If like that centralized authority starts acting in some way that's incorrect or against the norms or like is illegitimate or anything like that, like you run into an immediate collapse of like that system, or maybe not always immediate, but like an eventual slow decline of that system. And that's what you see in like every country where there's been a government that's being active that suddenly like doesn't really deal with the people or like have like any really connections to the people. And those sorts of situations tend to be much more damaging than if you had a system that was like slightly less scalable, but like kind of a bit more robust and a bit more like functionally accountable, I suppose. So I think there's trade-offs in those models, like between like how much executive function do you have and like how much sort of legislative function do you have and so forth. But like, I think one of the things we've learned from, and like the reason that like, I think democracies sort of are the prominent like sort of examples of governments that we have today is not because like they're perfect options. It's because like they're like kind of the least bad option. And they kind of aren't great, but like they kind of work. And like we don't have a better, in my mind, option at the moment.
I think a really, Scott mentioned something which will trigger something for me, which is also in thinking about centralized systems, if you could develop partially centralized systems that have some level of checks and balances. Like we think about government, and there are 3 different branches of government, and the courts, watch Congress, and the president watches the court. Executive, judicial, and congressional is the third. But can we do something similar with DAOs and the corporation? Similar thing, board members and then executives. So some level of oversight, and then shareholders as well have certain rights too. So this is something that Justine wrote about in part was when we're thinking about completely like for instance, maybe one extreme being token holders making every decision about how a treasury is used. And so instead of having a treasury management committee, which specializes in thinking really critically about every decision made, should we diversify and invest in a certain amount of stable coins and invest in a certain amount of tokens from other protocols, et cetera, you have the entire community making decisions. And so we could easily say, okay, that's not incredibly scalable. And then when we think about other functions too, like legal, for instance, if at some point you need to think about, okay, we're diversifying our treasury, what are the tax consequences of doing that? Who is the counterparty who's going to pay the IRS because they're going to be coming for us eventually? If you have, decentralized community, who is getting the memo from the lawyer? Because all of a sudden it's no longer privileged or confidential, and it could be used as evidence against you. So there are just a number of different ways that it can be very problematic to be fully decentralized in the way the world works today. So I think it would be hard to say that it's maximally efficient. Yeah.
Sorry to interrupt. But yeah, deal flow. Anything that requires some discretion is going to be tough in a DAO model, I believe.
So it's interesting to think about some of those kind of values-based or kind of ideological approaches to governance, but we've got some experts here in terms of actual experience of DAOing and trying to do decentralized governance. What are some of the challenges or strengths that are emerging in your personal experiences?
Not to jump in again, but one thing that actually really came up from that last comment was, it's funny because we did run into a very similar example of that problem with there was this whole Akita situation that's emerged in which, for those that aren't familiar, there's kind of this history of people giving random tokens to Vitalik. And, generally, it's not very favorable for Vitalik because he just gets these random tokens and then he's kind of like promoted as part of these schemes, and it becomes kind of an issue. In the Akita situation, it was kind of interesting because these original, founders of this token had dropped these, and then they had exit scammed at some point. So these other folks kind of started rallying the community, and got to a point where during sort of the last peak of the market, there were just almost 100,000 people that were part of this dog token community. And the reason I'm bringing this up is because eventually that allocate a bunch of these tokens to things like COVID India relief, to a lot of longevity-related organizations, and to us, to Gitcoin. And to Gitcoin, we got 50% of the supply of this Akita token, and it was entirely public in terms of how the community was deciding what to do with these tokens. And they originally just sort of said, well, we'll kind of sell these, like we'll be done with it. And what they didn't realize is like that decision was being made in an adversarial environment where everyone else was able to see that information. And so what that meant is that like the Akita community responded. There was a kind of prisoner's dilemma of sorts that emerged. And like we had to kind of like, the community of the DAO had to figure out like basically what does it mean to go from like a effect sort of state to a cooperative state. And eventually that happened, which was pretty cool to see in practice. But like having these sort of executive committees in place would have probably been preferable for that kind of decision. And so that's actually been something that's been formatted into the DAO structure now with these ideas of work streams and kind of like these executive bodies that can make particular decisions while still being accountable to the overall organization.
For context, Gitcoin had been a DAO for like a number of weeks when this vote was going on. And what was that treasury worth? What was the value of the Akita dog tokens?
Well, that's the tricky part because like people say like 500 million, but it was not worth that much because really the spot price of this sort of thing was not the same as liquidity. Liquidity was very low. It was maybe in the range of 5 million, 10 million. But to your point, it's a lot of money for a DAO like has just like come into existence to be like, how are we supposed to manage this treasury? What are we doing? And so it was certainly like, I was actually surprised that it even got to a point where it was something meaningful done with those, like given that it was like a 2-week thing. None of these, the stewards, the sort of representative democracy system that was put in place based on this retroactive distribution. And eventually the stewards who sort of roughly knew of each other through that process, but didn't really know much about each other, coordinated on this, which was kind of wild to see. But it's a very good case where executive function is needed.
Is there maybe a trade-off here? So, in a traditional business, these are decisions that happen in the boardroom. Nobody ever hears about it on the assembly line. But in the DAO space, have we replaced lobbying and public appeals and forum threads for committee decision or board decision? Is that because I followed the threads? They were enormously entertaining from my perspective. Sorry, Scott. When it was all happening,
it's
seeing this all play out in public in education.
I'll let Leighton jump in. I saw him put his hand up, but I would just say, like, I definitely think there's a balance between executive function and legislative function. It's a question of what that proper balance is, which is the hard question. But sorry, Leighton. Go.
I wasn't actually trying to raise my hand. I think I was doing something, but I think I was smiling because Rich, what I was honing in on what you just said was that DAOs still have a lot of back channels. Like there still is like a lot of like, oh, before I propose this, I'm going to like ask this person, or like, oh, I'm going to tell this person, like, so that's sort of what I was picking up on, Rich.
Well, I don't want to go down this road too far because there's a lot of interesting things to talk about, but that was very early on in the Maker development. It became apparent to us on the inside that at some point in the future, DAO lobbyists are going to be a thing. And I think that the ecosystem is kind of waking up to this. And I don't think that we're that far away from literal lobbyists like agencies whose job it is to get votes put through in various organizations, because it's public opinion now, and that's directly responsible. It's almost, well, I'm hesitant to say it's more effective than in traditional democracies, but we see direct financial incentives for votes to occur, and that's a very motivating force. And so lobbying, I think, is underappreciated how important that is in our space right now.
At this kind of level of abstraction, at this kind of strange mapping, the idea of lobbyists isn't going to be super different from the idea of a political party. Maybe in this metaphor, a party is just a lobby where the participants are also lobbyists. And so the literature in political science talks about how political parties exist to kind of coordinate units at different levels. And of course, there's skeptics about political parties, but there's this surprisingly large literature that's quite sort of optimistic about the importance of political parties as another kind of agent in a a polycentric governance system, doing a lot of coordination work and lining up work, as well as like in the case of nation states, like a talent finding and elevating kind of role.
You've seen some engaged participants, Leighton, in your ecosystem as well, with governance token allocations with various pools as well. Did you see any sign of lobbying pulled together?
I don't think we've seen. No, I don't think we've seen it yet. Not in any formalized way. No, but
You
I do
mentioned hierarchy before too. If you could talk to that as well.
Yeah. I mean, I think I have like an unspoken idea that like DAOs are not hierarchical, or they shouldn't be. And I don't know if we would agree with that or not. But yeah. But my finding has been that like in DAOs that are not associated with like protocols, they become very hierarchical very fast, because it's just I don't think we have a way. I haven't experienced a way to like organize people and get stuff done without hierarchy. And maybe that's just my capitalist brainwashing, but like I haven't seen it yet. So yeah, the only other comment I was going to make too is one. I think an interesting dynamic I've seen in DAOs is that almost no one votes against anything. Like it's very rare to have controversial votes, and so it creates this weird bias where sort of whoever it is, I think to like Rich's, I think Rich, you're sort of getting at this a little bit. Like there's definitely a risk factor of like the people who are just paying attention can sort of push through whatever they want, because 99% of people aren't paying attention, or maybe 10% of people are paying attention, and that 10% they just don't want to be negative. They don't want to vote against something. So like with Pool Together, like we'll have a good debate in the forums, but when it actually comes to voting, generally speaking, it's like 99% to 1%.
This sort of gets a subtle thing about governance and rules that is going, in my imagination, is going to represent kind of design challenges, and that's that. We kind of, especially if we're in the governance space, we think that rules are really important. We think of rules as the figure against the ground of possible action, especially if you have a very mechanism kind of focused view of governance. Then we define behavior in the system by defining rules. But a funny thing happened to some colleagues of mine who were doing actually ABM, so agent-based modeling of governance systems. And what they found was that they define a sort of virtual resource and virtual behavior, virtual incentives, and then they define rules. And what they found is that rules got triggered actually very rarely. That rules were rules are just there to manage edge cases. Rules tend to be there. Rule violation and policy subtleties tend to be there for the weird things that happen. For the most part, the system kind of runs itself. People do their things under an overall framework. But the actual need for conflict resolution mechanisms, for example, is pretty rare. And I guess that's encouraging from the perspective of a community that's skeptical about the importance of, or the need for rules and hierarchy that wants to offer a lot of freedom to a lot of people under a trusting environment. But it's probably going to be challenging from a design perspective, because it's going to reduce the rate at which you get signal about your governance design.
Yeah. It seems like the mechanism for resolving conflict in DAOs is exiting. Like I think that's like all I've seen so far. It's like whoever ends up with the disagreement
failure in
leaves.
itself, though, right? If that's the last thing you want, isn't it? People.
Sorry, I guess I'm not saying what it should be, but I'm saying like I feel like that's the reality. Is like if it's like the people who wanted that's like Ethereum Classic and Ethereum, and Bitcoin and like ECH and like Bitcoin and like it's just like it's exiting and forking.
Okay, so you mean capital E exit as opposed to just wandering away from the table. So like wandering away from your ecosystem would be bad.
Well, I do think those happen. Just to be sure, like there's like a lack of participation is a huge problem in these systems in a lot of cases. Like I actually would note, like so far we've had like 3 contentious votes of like 6 total votes or so.
Thanks for tuning in to the first half of the discussion on governance implementation. If you want to see the rest of the panel, if you want to learn more about our panelists, or if you want to be part of our long-tail discussion on the topic, check out smartcontractresearch.org/T/621. Thanks again, and enjoy the rest of the summit.
Thank you, Rich, and everybody from SCURF and joining into that conversation about governance. It's always interesting to see how community is evolving and how communities are working. And so we're going to check in on our communities. What a crazy day. What a wonderful day we've had. But right now, I'm going to bring Rory back on, and we're going to have a check-in with the global watch parties. Everyone, I see everybody on the screen, so I'm very excited. So let's bring on Rory.
Hey, everybody. Thanks again. I think we've got about 10 plus hours in the books. We have a few more great talks and conversations to go on, so hang with us. But just to do a cut in again, we've got a fantastic community watching from all over the world. I want to start to bring some of them up right now who are having some pretty big celebrations and kind of call them out. David, if you want to maybe unmute and say hello out of Toronto, how are you doing today?
I'm great, Rory. Thanks so much for having me on. We had a great event today. We had people from disparate communities such as insurance, looking into asset tokenization, the amazing news with the Chainlink node with AccuWeather. So really exciting day and really happy to be on here. Thank you so much for letting us participate. It was a wonderful day and it only continues.
Hey, thank you so much, David. Really appreciate it. Shout out to Michael and everybody that's in Israel. I don't know what time it is there, but I think it is either very early morning or late. But shout out to everybody who's happening in Israel. We've got New York City. There's a bunch of people there. Maybe they'll make a little bit of noise. Hey, New York, shout out. Perfect. We got a great watch party in New York City going on. Want to shout out to Ben just down the road from me in Austin, Texas. Ben, everybody watching. Good.
We're at midnight.
Perfect. It's midnight in Israel. Perfect. Austin, excellent. Josh, throw me some love out of LA. Josh, how are you doing? Good. Hey. Awesome. Hey, thank you, everybody. Let's bring on the next batch. We got a few more people I know that are watching. So again, shout out to Toronto, Israel. It's midnight there. New York City, Austin, Texas, and LA. Thank you, everybody. Perfect. Do we have anybody else we want to bring up?
What's impressive about this Israeli group is they were on the morning check-in too.
Yeah.
So they, started a little bit later, and then they stayed, and now they're here. So big props to everybody and everybody else too. Those of you on the West Coast for getting up early and all sorts of things there. Rory, it's been a pretty fun day for me. How about you?
Yeah, it's been amazing. I think we've had some great news and announcements, which I'll kind of sum up at the end here for those of you that missed. And again, this is only day one. So we've got 2 more full days that are just as full, that are going to be just as exciting. So super excited to get there. I'll go ahead and hop off, Andy. I'll let you kind of roll it to our next thing.
All right, we've got a couple more panels for the day. I can't believe it's only day one. We've been prepping for this for a long time on the Labs team, of course. So seeing it all come to fruition is just incredibly exciting. And it's great to see the community reactions on Twitter, on socials. There's people watching on YouTube, on Hopin, of course. Don't forget to check out the Expo tab for careers and other opportunities to meet Chainlink experts for developers, and use that networking tab. Meet those people who are around the world and who are also interested in Chainlink. Hey, maybe you'll find a hackathon partner for the next hackathon and be able to join us on stage at some point. But coming up next, let's finish strong with a couple of panels. I am quite excited for this one, and I think you will be as well. This one is about Deco and off-chain data. So Lawrence Bradenbach from Chainlink Labs is going to lead this one, and I will let them take it away and tell us a lot more about Deco.
Hey everybody, my name is Lawrence. I'm the head of R&D at Chainlink Labs, and today we have a cool little fireside chat lined up where we're going to talk about the cool work we've been doing together with Teller Labs on integration of Deco. And if you don't know what Deco and Teller are, well, don't fear, you'll learn more about it in a second during this chat. Yeah, so to intro the 2 fine folks I'm doing this with, Ryan is the CEO at Teller Labs, and Fan is a professor of computer science at Duke University, And we're also fortunate to have him working with us at Chainlink Labs. Now, before we start, I also want to give credit and a shout out to a bunch of the cool folks on the research team who've also been working on this. This is a team effort on the Chainlink Labs side. And so in particular, I want to recognize Drew Duplicano, Alex Coventry, of course, Ari Jules, and Siam Hussein for the awesome contributions they've made to this as well. Though unfortunately, they can't join us today for the panel. Yeah, with that aside, Ryan, can you briefly introduce yourself, maybe?
Hi everyone, Ryan here, founder and CEO at Teller. Teller is a consumer credit protocol, and we connect the world of off-chain consumers, data, credit with the DeFi money markets of today. Ultimately, we plan to be a developer-focused protocol that enables anyone to launch a credit-based money market. What that enables is your connection of bank accounts, FICO, employment data in association with your DeFi history. So your interactions with Aave or Compound or Uniswap can all be used to process some type of creditworthiness and get access to a credit-like service that we plan to open up to the entirety of developers in the space.
Cool. Thanks, Ryan. And Fan, if you could also introduce yourself. I mean, you're one of the authors of the Deco paper, of course, but maybe our viewers would like to learn a little bit more about you as well.
Sure. Hi, everyone. This is Fan. So, as Lauren said, I'm an assistant professor at Duke University. I'm also been working at Chainlink for the last year and in the future as well on a number of very interesting things, including Deco. So my interest in the blockchain space is the security and the privacy of blockchain systems, and in particular, oracles is one of my research topic. Yep.
Cool. Thanks, Fan. So then maybe the first natural question we should answer here is, what is Deco actually, and what makes it unique? Could you tell us a little bit about that?
Right. I think Deco solves really an age-old problem where in so many places in the society, we are forced to share way more information, often very private, than what's necessary. Deco can securely provide answers without revealing unnecessary information. For example, does Alice has enough money in her banking account without revealing the banking credential, right? Or does Bob have a good credit score without revealing his social security number, and so on? So the one unique feature of Deco is privacy. But thanks to zero-knowledge proofs, Alice can prove in zero knowledge that her banking account balance is over a threshold without revealing the exact balance. And another unique feature is that Deco taps into the existing infrastructure, and in that it doesn't require banks or the DMVs to make changes on their end. And this is an important feature because that means innovation can happen faster, right? We can be compatible with lag system rather than requiring changes on their side.
So a lot of the privacy preserving nature that Fan is talking about is going to open up access to the rest of the world of information that currently doesn't live on chain. Anything that's personally identifiable, be that in finance, be that, as Fan said, identities such as a DMV, be that healthcare, there's a lot of rich and interesting data that can be used, but currently lives absolutely outside of the blockchain ecosystem. Chainlink opens that up. And the ability for Deco to play this role in privacy without needing authentication from these middlemen or these current data repositories is a massive opening for what is going to be untapped as what we have today as our nascent DeFi industry really starts to belly into the world of traditional finance.
So one benefit I think in particular that I think is cool about this, and that maybe you can tell us a little bit more about, Ryan, is with regard to the nature of collateral in terms of what you can do with the solution like Deco plus Teller versus what's currently happening in DeFi.
Yeah, I think let's think about the origins of DeFi, and it is the financial system that we had been promised from the get-go. It is transparent to all, accessible to all, and you truly own your money. The origins of that will start in a place that's similar to the origins of traditional finance, where traditional finance began with collateralized nature of ways that you could say, hey, if I'm going to give you my chickens and I'm going to take a hen and I'm collateralizing to go do something with the money itself. DeFi has started that, and that's where we are with collateralization, and that's amazing for those who are already in the system. However, in order for DeFi to really service end consumers and break out of this notion of needing money to get access to capital, we need some type of form of reputation. And reputation comes from the history of data that a user can acquire over time by utilizing their interests, their activities, and their engagement in different applications. The best types of data, or the highest quality types of data in relation to DeFi, are going to be financial interactions. So that'll include your FICO score if you're in the States. That'll include your banking interactions or your mobile payments or your P2P payments in other regions in the world. And those pieces of information that you've built up over time in the traditional world should carry in somehow into the DeFi world, into the space where money can be transparent. And that's really where a lot of this innovation between Teller and Deco comes into play as we aim to lower collateral ratios in the space. One thing that's interesting to note is that the traditional world of credit doesn't necessarily work without collateral, but it works with the ability to give an individual access to capital before they have it. And I think that's the aha moment, which will happen as you see reputation coming into the space. The over-collateralized nature of today, where you need capital before getting capital, will be replaced with a world where we can give a user capital in order for them to do something with that capital, even if that capital has some type of collateral aspect in it in the backend. An example of that would be a mortgage. A mortgage has the house being used as collateral. However, the user, the borrower, doesn't necessarily have the full amount of capital to put down on the home at the start. In addition, you can think of your reputation in terms of your use of a credit card as collateral. It's just shifting the concept of what we think of collateral from being just capital today to being reputation and other world assets tomorrow. And that's what Deco can unlock in a privacy-preserving nature through applications like Teller.
Cool. Frank, can you tell us a little bit about how that works from a technical perspective, or what is it that makes Deco uniquely able to do this here? Why, for example, don't we just put the bank account data on chain, right, and then enable Teller to do its credit scoring based on that?
Right. So, right, yeah, there are two really technical kind of features of Deco that enables this. The first one is to prove the data came from the authentic source, right? You can't just put the banking history data on the blockchain because the data doesn't come with digital signatures to ensure its authenticity. So a malicious prover could easily modify the data, right, to pose as a millionaire while he only has, $10 in the bank, banking account. Another important feature that is enabled by Deco is privacy, right? You want to share your transaction history to, for example, take out the loan, but in the meantime, you only want to share what is absolutely necessary. And there are solutions that enables you to share the API access to your banking account via some third-party platform, for example, but that usually reveals more information than what's needed, and that doesn't give user a full control. While Deco changes this by giving user, very specific control of which data to reveal and being able to prove the authenticity of the data at the same time.
What Fan is bringing up with user control is really prominent here. The ability for a user to opt into what data they share is a brand new paradigm that is only going to happen because we're building it from the ground up in terms of this type of technology, both in parallel with Oracle's blockchain and Deco itself. And this is going to be a revolution that changes not only finance and how users interact with finance, but every other jurisdiction where you have some type of data that the user has built up.
Yeah, I think that control aspect is very important. And I mean, one thing in particular, right? So with Deco, for example, you could prove some statement about your bank account without actually giving the credentials. So for example, the password that you need to access the account details in your online bank's API without revealing those to anybody. And I think that's on its own already a hugely useful feature, without even yet talking about the other aspects of the zero knowledge proofs powering DECO and the even greater privacy guarantees one can provide with those. So I think we'll go a little bit more into this through the talk anyways. So I guess my next question then would be, what types of new data are we enabling to be consumed by smart contracts here, right? So you mentioned some examples of all of this credit score data, of financial data, but are there types of data beyond that will also be unlocked by DECO?
We like to think of it in three ways. One, you have the actual data itself, and that can span many different regions. That can be banking information, credit information, social information, GitHub information. All of these different types of information are just data points on a user. Those data points become really interesting when they can be scored. So an example of a simple score would be if you take someone's Twitter follower count, and instead of taking the number itself, you apply it to a log function where you say, if someone has 1 Twitter follower, they get a score of 1. If they have 10 Twitter followers, they get a score of 2. 100 Twitter followers, a score of 3, and so on. That final score is more interesting because it tells us a higher level of information about the actual user. That simple example of Twitter can be drawn out in much more complexity to banking or credit scores. But the beauty is something of very simple arithmetic can lead to a lot of information being known without ever revealing that information, just because you have that highest point, that credit score. So the first thing that smart contracts will be enabled to consume through this partnership with DECO and Teller is credit worthiness. That's an estimation of a user's ability to repay a line of credit based on their history of the data that, as we've talked about, they themselves opt in to share. So they could be sharing their Twitter data, they could be sharing their credit data or their DeFi history. It's up to the consumer what they want to share. And we're going to say, based on the actions taken, here's a score that the smart contract can consume. The second,
cool. And what I want to emphasize there, just to make sure that's super clear, right? The only data that's revealed in the end publicly on chain is the score, not the various bits of information that went into it. And the computation of the score itself is done in a privacy-preserving manner, right? So in this case you gave, for example, the number of Twitter followers would not be revealed, and neither would be any other, say, financial information that you would input into the score.
Exactly.
But still, we can kind of implement various flexible scoring functions here, depending on the needs of, for example, Teller or the consuming protocol.
Yeah, that's a really interesting example. In addition to DeFi, I think another area that DECO can have a lot of application in is identity or decentralized identity, because DECO can bring off-chain identity data to smart contracts in a privacy-preserving and also trustworthy way. Well, so that will enable, applications even beyond the scope of DeFi and so on.
Do you have an example of such off-chain identity-related data that it will enable to be?
So any data, about that proves a certain property about somebody is a credential, right? And for example, data from government websites such as DMV could be used to prove or verify one's age and can be a age credential. Okay, and then identity can be seen as a set of such credentials. Right, and the basic idea of the ID is for users to collect such credentials and form their own identity and control that identity, using the cryptographic techniques provided by, some are provided by DECO. Right.
Okay, cool. Are you guys planning to do anything with the ID, Ryan?
Yes, we are. I think this idea of a self-sovereign identity will happen, and it's going to start first through reputation. An analogy I like to compare it to is at the onset of crypto, the story we used to tell was about the dark web and kind of the trade that was happening on it and Bitcoin being used. But the market sellers, the people selling into the marketplace, actually weren't trusted until there was some type of reputation built in. And I think that shows that as we want to build decentralized applications where you may not know the name of an individual and you might not know their social security, you can trust that there's some form of identity or reputation associated with it. DIDs and the Web3 standard are going to be paramount in that evolution. And the way that we start to view this digital metaverse of what we call DeFi or NFTs or DAOs today as something real. And we all have a piece of us that will be brought on chain. And that's how Teller will be using DIDs.
Okay, cool. I think this aspect of combining the various parts of off-chain data or credentials in a way that the user controls and the user can choose what they want to reveal and what not could be hugely beneficial for privacy in general. Because I mean, right now, there's some shadow profile about each and every one of us with probably a lot more data than we're even aware of. And putting that control back to the user is certainly very exciting to me. So maybe then the next point I want to go into a little bit is about DeFi, right? That's sort of the hottest game in town right now. And so I'm curious, Fan, if you could tell us a little bit more about how exactly you can see Deco being used in DeFi and be very specific about how that would look like.
Right. I'd love to see Deco being used to unlock the value in private data, including, for example, the private financial data, while giving users full control, right? I'd encourage everyone to pay attention to all the places where, you have to reveal way more information than what's necessary, right? For example, when every contract you sign, you need to reveal a lot of information that's not necessarily directly related or necessary to making the agreement go through, including in many financial applications. Right, for example, even just showing your ID to prove your age gives somebody access to your home address. And smart contract that utilizes Deco technology gives me hope that we can move to a more trustworthy and private form of agreements sooner than many may think, because Deco, as I said, taps into the existing infrastructure, right? It doesn't require, for example, banks to make changes in order for this to work. So that's, I think, where I'd love to see Deco being used, in DeFi and in providing credit worthiness data to smart contracts in privacy preserving and the user controlled way.
I think that's a really interesting point you mentioned there as well, and I think you've mentioned it already a few times as well before, that Deco is backwards compatible, right? So all of the existing systems out there, whether they're with banks or the DMV or other institutions that are not exactly known for their agility and their fast adoption of new technologies, we can still bring into the sort of 21st century by using Deco and use the data that they provide in a privacy-preserving manner without them having to do anything or there being a dependence on them modifying their systems for everything to work.
And I think
so. Yeah, go ahead, Ryan. Yeah.
What's great is that we've shifted from a world where those backward compatible places today have just sucked up data to a place where they do want to give their users their data. And at least with GDPR, there are requirements for that to happen. So if a user wants to ask for their data, they're able to. And that data through Deco can be converted into some type of access to capital, which really starts to expand the set of how we can address capital markets, not only from the stance of DeFi and money markets on chain and how liquidity providers get rewarded, but to the flip side, which is what Fan is speaking on, where your data, as it has been built up over the past 10, 20, 30 years, now unlocks an enormous amount of value, not only for the consumer, but also for these businesses that have been holding the data to date. You can see places where the user may be monetizing their data, but the business could offer some type of credit integration or DeFi integration that is really going to unlock their entire user base to get access to that data and use the data. I think another piece to harp on is that users don't outwardly go get their data or grab their data. To date, many users who are not in the crypto space are just okay with these data storing places. So I think as DeFi becomes more embedded into these innate systems, when you see traditional fintechs integrating DeFi as a backend technology, that's when you're going to see these fintechs or big companies today become incentivized through DeFi to actually enable their users to monetize this data and give the users their data back.
And so in the end, as a user, I might not even necessarily know anymore that I'm using a DeFi-backed system. I just have a nice UX, and under the hood, it uses the DeFi system, if I'm understanding you correctly, Ryan.
And you'd be happy. Deco preserves the privacy, Teller gives you your credit, and the user walks away as if it happened in the traditional world today.
Yeah, that's a good point. Legacy compatibility is not only important for kind of fast innovation, but also important for user experiences, as you guys have been talking about. And also at the same time, it's a technical challenge. In some sense, it's easier to build a new and a flashy system without any constraints, right? If we live in an ideal world, building a new protocol would be easier. But we're not. We have to make do with existing systems over circumvent limitations in current technology, and that's an important kind of feature built in Deco. So we want to support legacy system from the get-go. That's part of the design.
Cool. Yeah, with regard to the legacy systems, I'm always reminded of the whole IPv6, IPv4 migration, where IPv6 came out years ago, and everybody knows it's a new standard you should be moving to. But just because the migration is so hard, it's still not done, and we are now at still less than 50% of web traffic and internet traffic using IPv6. So yeah, I think there again, this goes to show how hard it is to migrate systems that are not backwards compatible, and so. The backwards compatibility is certainly a huge feature there. So I guess one other question then, we've talked a little bit about what Deco is, how it works, what it can provide in general, but I'm curious about your personal thoughts as well here. Like, where do you see this being most useful in the next, say, 2 to 3 years? Yeah, what do you think will be the most exciting use case to you personally?
Yeah, I can kick this off. I mean, I think this is the most interesting question as we kind of predict where not only the shape of the market goes, but what people want. And DeFi today, at least in my eyes, has only started. It's only touched the first wave of innovators or really early adopters that have been very excited about the technology. If you look at capital markets today, the world of credit is what underpins the entire economy. In the States alone, the credit markets for consumers is about 15 trillion. That's if you combine credit cards, mortgages, and insurance. And then for businesses, it's about 15 trillion as well. Sorry if I said billion, I meant trillion. That is the underpinning. Yeah, much bigger than I said. That's the underpinning of our economy. And that's just in the States alone. That's where I think the real exciting growth of DeFi will happen as we get to bring these massive markets on chain.
Right. I would even add to that and say I personally think DeFi can't go truly mainstream until it can leverage option data, financial data and so on. And, for example, most loans today in the option world are under collateralized, but whereas in DeFi, you must put down $200 in order to borrow $100, which doesn't make a whole lot of sense to me. I'd be very excited to see Deco change this in a relatively short term, as Deco can provide credit data, for example, to enable credit-based loans rather than over-collateralized loans. And I'm also excited about the DID applications. It would be awesome if one day we can authorize through blockchain, proving properties about ourselves without revealing unnecessary information. Right? I want to prove I'm over 18. I just reveal one bit of information instead of giving away my home address for no reason, right? That's exactly what can be done with DECO, and I think that can happen rather soon.
Okay, cool. Yeah, I mean, it's crazy generally how much information one has to, or how much information beyond what is required for whatever application one has to leave everywhere these days, right? From opening up some account where you need to prove that you're a resident of a certain country, sure, but why do they need to know my address, as you mentioned, Fan? Or I need to prove that I'm beyond a certain age to maybe buy alcohol or cigarettes or whatever. But again, why do they need to know my exact birth date? And then this expands more and more to various other spheres of life as well. And especially, I think, in the digital realm, the amount of extra information that we share that we don't actually have to share for whatever business purpose is being achieved in any given business transaction is insane. And I think being able to bring control back to the user there and making sure that users only ideally share the minimal amount of information needed for the specific use case, but no more than that is super exciting. And I think being able to do that then in a legacy compatible manner too with DECO is really unlocking a lot of potential. And I'm super curious where this will go as well, and what applications we will be seeing here. Maybe even completely beyond DeFi and in realms that we haven't thought about yet, or that we're not yet aware of. So with that, maybe Ryan, you can tell us a little bit. You've been talking a lot, obviously, about Teller and what excites you there, right? But if you completely remove the financial aspect, is there some product category where you would be excited to see this being used, just from a personal perspective?
Yeah, I think from the point, there's three places. I think identity, healthcare, and then climate. We pour over so much of our information whenever we want access to something. That idea that you can summarize my birth date or my age into just a true or false is incredibly empowering, because no longer do you need to know that personally revealing information about me or judge me based on those characteristics. You can simply know that I'm within a category of yes or no. One, that's identity. I think two, healthcare is going to be completely rewritten. The world of data kind of aggregation today in healthcare is run by a couple major medical record holding platforms. And it's not easily accessible for the end patient to understand their data, see their data, and really have a confident analysis of it. That is going to give and empower us with our most proprietary information, which is what is our healthcare. That is going to be a revolution, I think, just in general, and how we perceive data and how we use data, especially about our personal lives. And then I think the third is, as the climate continues to change and evolve, and I think as a lot of people in the crypto space do want to have climate preserving powers and protocols and projects in place, we want to see that data in lifetime in ways that we can better serve the climate in trying to reverse the change that is going on, is becoming more drastic year on year. That's where I think DECO privacy preserving information will incentivize people around the world to share information about their general, regional, geographic position, and incentivize people to start making change within the climate. But we'll only know that through data. And part of the reason that we've been hampered at a lot of these points, be that identity or healthcare or enhancing and solving different issues with the climate, is because of this lack of data collaboration and data sharing, because there has been no reward to it. Now that you can make data private through DECO and you can share that collaboratively and get potentially paid for that, it will open the gates to innovation. In the same way that having a distributed ledger opened the floodgates for innovation within finance, I think we're going to see that in many different regions and jurisdictions and areas because of this idea of private data powered through DECO.
Okay. Fan, is there any areas that you are particularly interested in or that excite you beyond the financial applications?
Actually, Ryan just reminded me of another application we had in the DECO paper, which is personal marketplace, privacy preserving personal marketplace. Really the power of DECO, I think, can be summarized as enabling user to share the data well in a controlled way, and that aspect, in my opinion, is missing in the current data marketplace design. Right? If you want to go about and kind of sell your data and get profit from it, you want that control, and at the same time you want to prove the data is trustworthy so that the buyer can verify the correctness and make sure they are paying for legit and correct data. So so that's a really interesting application we kind of talked about in the paper, and it would be interesting. I'm glad to hear that Ryan also think that potential commercial there's potential commercial values there. Yeah, so that's something I think is also really interesting.
Cool. And I mean, I think it's worth emphasizing here, right? We are building Decode to be as general as possible. And so I think there's probably applications that will be enabled by Deco as we're building it that go even beyond what we have imagined so far and what we're able to imagine. Because once you let a global crowd of smart and enthusiastic developers build things on top of whatever platform you're providing them with, they usually come up with stuff that probably nobody would have predicted when the platform was first envisioned. So I'm personally also very curious to see what applications will come out of this that we haven't even thought of yet. I think with that, we're at time. And I'd like to very much thank you, Ryan, and thank you, Fan, for taking the time to join us today. Thanks for the great conversation.
Thank you for having me. Excited to have been here today.
Yeah, thank you for having me.
Thank you so much for that panel on Deco, Lawrence, for leading that, and we're really looking forward to see how Deco grows in the future. Up next to our final panel for the day. Really excited to have this fireside chat. Some luminaries in the space, moderated by an absolutely stellar reporter, Cami Russo. So we're here to talk about if you love it, set it free, the realities of decentralized power transfer. With that, I will let Cami introduce our guests, and we'll get started here in just 1 sec.
Hey, welcome everyone. Thank you, ChainLink, for this awesome conference. And I am so excited for this panel. It should be so interesting. If you love it, set it free, the realities of decentralized power transfer. And it really kind of captures the essence of the moment in DeFi that we're living, this push towards greater decentralization. And we have the leaders of two of some of the best examples of this. So Robert Leshner, the founder of Compound Finance, and Kane Warwick, the founder of Synthetics. Thanks so much.
Hey, Cami. Thanks, Camila. Excited to be here.
Okay, and I'm the founder of The Defiant, a content platform focusing on decentralized finance. Hopefully you are all subscribed to our newsletter and the YouTube channel. I should also say we are all members of White Hair Avatar Group, though you're a bit cooler. I mean, you're crypto funds. I'm World of Women, which is also pretty cool. Nice. But I just noticed that fact. So this is super interesting. So as a brief intro, Synthetics Foundation dissolved itself a year ago, handing over control to 3 DAOs, and likewise Compound tokenized governance last year, replacing the administrator of Compound Protocol and leaving its decision-making process to its community of token holders. This was a long process. It took a couple of years for both protocols. So we will be discussing why this decision was made, what the steps were to get there, and how's it going so far. First, though, because this is a Chainlink conference, I'll start with a nod to our host. So can we start off just by each of you talking about how you use Chainlink in your own protocols?
Sure. Yeah, I can go first. So, one of the biggest points of centralization in the early synthetic system was our proprietary oracle that was being run by the Synthetics Foundation. And, even before we got to the point where we were ready to dissolve the foundation, we knew that we needed to get that sort of central, failure point away from the foundation and out into some other process. And so, we looked around and thankfully, some smart people and the guys from Framework connected us, with Chainlink. We'd been kind of talking to them for a while, and we were like, okay, this is it. Like, we're ready to do this. We sat down, we talked to Sergey, and we talked to a bunch of the people on the team, and we were like, this is the path forward for us. And we were one of the first groups to kind of implement the Chainlink oracles, which was a huge step forward for us. Because at the time, this was something that we were basically maintaining, constantly, right? And so, I think, I think we were able to get away from that very centralized component that we had, and that was something that was a big step in removing the need for foundation that had to run all this infrastructure and had to have servers and uptime and all that kind of stuff.
Very well. How about for Compound?
Well, for Compound, this is actually going to dovetail with the theme of the conversation, which is governance. So Compound uses Chainlink for our price feeds. And this is actually a process that unfolded through community governance for us, which is really exciting. So, like Kane mentioned, this is something that started off entirely centralized. And for Compound, it went through really 3 stages. One was an entirely centralized price feed. The second was an open price feed, which the community could decide what the price inputs would be. And the third was, the community choosing to use Chainlink as the primary input into the pricing system. And so for us, we're as a community now using the Chainlink price feed. And this was a process that unfolded through the decentralization process.
Very cool. Okay, so yes, that does dovetail nicely. So back to the topic of decentralized governance. How did you come to the decision of giving up governance to token holders? Was this a plan for the start, or did you come to the realization that this was kind of the way to go as you were building your protocol? And yeah, maybe Kane, you can start again.
Yeah, so I think at the start of our project, there were a lot of people that were very skeptical about the approach that we took, which was to have this sort of rapid iteration. We had these proxy contracts that had a lot of control over the protocol. We could iteratively update the contracts and did so quite regularly. And there was rightly a lot of skepticism around that because there was a question of, well, who is doing this, right? There's this software foundation that has all this control. There was not the same level of sort of decentralization as you had in something like Ethereum, where there are multiple parties that were participating in this process. It was really just a software foundation that was kind of rolling out changes to the contracts, and there wasn't a lot of oversight in how that could happen. But we said from the beginning, there will be oversight. We will hand it over to the community. Token holders will take control. And the skeptics obviously were rightly had some questions at the time. But I think over time we've kind of been able to demonstrate that was genuinely our intent. We intended to do that from the beginning. We've kind of adhered to that, and I think in reality, where we've gone to now is far beyond what I think we contemplated at the beginning. We had an idea of something that would have some aspect of token holder control or whatever. The current synthetics governance framework is probably far more decentralized than I could have imagined back then when we were talking about giving some control to token holders in this process.
So interesting. So were you initially thinking that you or the team would retain some level of control and some parts of the organization would be open to token holder governance, but in the end, what ended happening is that everything is now up to token holders.
Yeah, exactly right. We thought that there would be some kind of like checks on power in terms of like token holders being able to like prevent certain things from happening, or like stage gates needed to, to kind of process things. But in fact, it's actually gone much further than that. So, we have a representative democracy. We've got a council, which is voted in by token holders. They make decisions on changes to the protocol. There's very little that obviously the foundation's been even dissolved, right? So that component no longer exists at all. But there was a sense that there would be like some level of power kind of retained from the core contributors, the people that were building the protocol. And in fact, there probably remains a little bit of control, but it's far less control than I think we anticipated at the beginning when we started this process. The token holders really do drive most of the activity in the network now. Obviously, there's people implementing the changes, but other than that implementation component, it's 100% controlled by token holders.
Got it. Super interesting. How about for Compound? Like, was this type of governance always a plan?
To build a financial market that would run for 100 years. And you can't have a centralized entity controlling something that's going to run for 100 years. I mean, most corporations on earth, even the biggest ones, are not 100 years old. And our analogy that we always used internally was that if Bitcoin were run by the Bitcoin Corporation, it would be worth zero. And so the goal was always to create an anti-fragile system that would outlast any member of our team. And so to get there, it was essentially mandatory that we would find ways to decentralize. It's the ability to remove human error. It's the ability to, remove, sovereign state level interventions. It's the ability to build a system that developers and applications can rely on, that it's going to be there, not just next week or next month, but like next decade. And so, we always knew that decentralization was mandatory. It was more a question about how to get there, when to get there, and what the steps would be, because there was never really a playbook that we were able to just take off the shelf to follow. We had to write the playbook, and now a lot of teams in DeFi can follow it, which is one of the greatest things we've done. And so, from Compound's perspective, we had to learn a lot of things in real time. We were able to observe some of the best practices and worst practices of other teams that were a little bit ahead of us in the process. We learned a lot from MakerDAO. We learned a lot from Synthetics. We learned a lot just from different experiments happening in crypto. But for us, we had to essentially design, a process of handing over control of the protocol to the community. And that became the Compound governance system. It's, I think a best in class system for voting on code changes to a protocol without any intermediaries. One of the failures we had seen elsewhere was, needing like a foundation or a middleman to even put things up to a vote. We wanted to design a system that was, completely open to improvement. And so this became the Compound governance system. At this point, a lot of other teams are able to use the governance contracts. We're seeing like Compound governance and the time lock and the voting style and the token itself being used everywhere. Open Zeppelin is using it as a standard library at this point. And this is, the end result of it is now there's like almost a generic governance system that we were able to create that others can benefit from as well.
Very cool. Yeah, white labeling governance. Yeah. It's a great point because both Compound and Synthetics are, some of the earliest DeFi protocols. So you really did have to write the playbook on governance. Like you didn't have much earlier kind of examples or kind of rules to follow. So what elements and structures did had to be in place for your protocols to get to where you felt comfortable delegating governance? I'll
go first.
Yeah, go ahead.
I'll take the pressure off of Kane. So the most important thing for Compound was knowing that if we were going to hand over control to the community, the protocol had to be in a state in which it was operating with stability, that there wouldn't be a bug discovered overnight that a community would have to respond to. What we wanted to do was have enough of a Lindy effect, knowing that if we handed over control, the community wouldn't likely have to respond overnight to any issues that would arrive, that any issues could be solved during like a 1-week governance process, knowing that the compound governance system is relatively slow by design. And so we had to essentially wait, at least a year from our last major code changes before rolling out governance. So really it was a lot of like, hurry up and wait and do nothing in order for it to be stable enough that we felt confident allowing the community to be the ones managing the protocol.
Okay, so basically making sure that the code was sound, that there were like no major bugs there.
That's right, because one of the biggest trade-offs of governance versus centralization is in centralization, you have the ability to respond and move extremely quickly. In decentralization, you lose some of that. And I think over time, the communities are going to figure out how to be able to move extremely quickly with decentralized governance and control. But right now, it's more of a trade-off. And so, before we moved over to decentralization and community control, we had to put it in a position where they wouldn't, have to, face like, as many technical risks.
Makes sense. How about like something about the community itself? Like, were there any like signs that you were waiting for to see whether the users or like the community was strong enough to handle that level of responsibility?
Well, we tried to ease the community into it. So one of the things that Compound did, which was relatively novel, which we actually haven't seen replicated elsewhere, but I think is a pretty useful model, is we essentially had an alpha test of public governance before we rolled it out to the entire community. So there was a 3-month period prior to the comp token being distributed to users where we tested voting on the protocol with a number of stakeholders, with like prominent members of the community. It was almost like a compound council in a way, like the Synthetics Council, but it was like, we found 20 or 30 people that were participating in running the protocol. And it was like an intermediary step from, a single team to the full community. And we were able to test a lot of the like proposal process and governance tools and ensure that everything was starting to run smoothly and that enough stakeholders knew how to enact changes that, once we rolled it out to a broader audience, there would start to be a muscle memory.
Cool. Okay. So making sure that there are no major bugs, running tests with a smaller group of users and making sure like all the tools worked and people knew how, like what they had to do. How about for synthetics?
To go back to an earlier point that Robert made, which I think is pretty interesting. The fact that there was very little in terms of governance out there, in terms of governance frameworks. Probably Maker was one of the few examples. There were some non-Ethereum examples that I think had gone even less well, but like Maker was like one of the few things that was like out there, right? I think the fact that there was so little in the way of a playbook or off-the-shelf components that you could use, and everyone had to kind of build their own thing, is one of the reasons why, if you look at the kind of older DeFi projects, their governance is so different. Like compound governance and synthetics governance, I think are quite different. It would have been amazing to me if the compound governance model, was there, right, as a piece of software that we could have used when synthetics started to, decentralize. We probably would have used it as well, I think, right, or use some component of it. But in fact, we were kind of building in parallel these separate systems, and the same goes for a number of other projects. So it is just quite interesting, I think, that today as a project you can kind of come and cherry pick little bits and pieces, and it's a much easier process. And we are definitely converging on something that makes sense. Obviously, there's always going to be trade-offs with different projects and what they're optimizing for, but I do think that most of us would have had a much more similar governance structure if we'd had the ability to kind of work collaboratively, through that process. But in terms of how synthetics governance played out, we, have always had this view of small iterative experiments. So we started off with like letting people, make really small decisions in Discord that were kind of inconsequential, right? Like, it was very trivial things, not even like parameter changes, just like things about, what we were all going to do or whatever. And we slowly added to that and handed more power over. And as we did that, we needed to work out new mechanisms for handing that, who was that power going to be handed to? How were they going to exercise that power? And so we slowly built out all the different little tools and things, and pulled some off the shelf, like Snapshot, for example, we used, and obviously Gnosis Safe, and a number of other components. But it was definitely a process that was iterative rather than us saying, okay, in a year's time, this is where we need to be. And, we're going to really think about like, what is that place and where do we want to be and go and build it. The fact that Compound was able to do that is kind of insane to me, right? Because like I make fun of projects all the time for trying to do that and failing miserably. And like the balance of probability says like Compound should not have been able to pull that off. And somehow they did. So it's a pretty impressive feat in my mind.
Thanks, Ken.
I was on mute. Okay. Interested in the point you made about how different current governance models are to synthetics and compounds, earlier ones. Where would you say kind of the new wave of like governance is going?
I mean, we are iterating closer to Compound, basically, right? Like we're iterating towards that where, we're getting to a point that a change is encoded in a contract, the contract is deployed, and then there is some sort of governance process that kind of ratifies that change, and then it's implemented on chain, right? Like it's a much more secure and safe way of kind of implementing changes. It's slower and it has trade-offs, but in terms of not needing to sort of cede power to some group of people that are administering a multi-sig that's making the changes and making a decision about which contracts are connected to, to what services or whatever, it's much, much safer because everyone can see it. It's transparent. You deploy the contract, you look at it, we all agree that is the contract, that's the change, and then we vote on just that specific thing. Again, direct democracy versus a representative democracy versus like some form of delegation, like there's flavors and nuances there. And I think we've gone much more towards like a very, representative democracy rather than like a delegated democracy. But in terms of how we actually get the changes on chain, we're much closer to Compound now and we're moving closer. We think it's a much better model.
Okay, because right now, and this kind of goes into the next question I wanted to ask, which is just getting into more details on how each of your governance models actually work. So for synthetics, is it that the final change is made via a multi-sig? Is that still the case?
Yeah,
okay.
It's still the case. Yeah.
Right. And so what you're saying is that you want that model to transition into something that is made kind of more on-chain? Exactly.
And our last two upgrades actually were done this way. It was still done by the protocol DAO, the multi-sig, but effectively there was a contract that was deployed. Everyone was able to review it before protocol DAO, implemented the change. But in the future, it should be possible for us to effectively have someone deploy that contract as part of the SIP, the Synthetics Improvement Proposal process, and say, okay, this is the contract change. It's on chain now. You can inspect it. And then the council turns up and says, okay, we've inspected that change. We're comfortable with it. And then they vote on it. And then, it's implemented rather than having some intermediary. And so I think that's the thing that Compound really got right. And I think it's a powerful approach and removes a lot of the kind of centralization and other risks that we have in other projects where there is a multi-sig that's implementing changes.
Wow, that's so interesting. So like what will be the process for synthetics to make that change? I imagine like it has to go through another governance vote.
Interestingly, like kind of, right? Like the change will have to be to give power to the Spartan Council to be able to execute a contract. So effectively what will need to happen is that right now there's a multi-sig. That multi-sig will need to transition to the Spartan Council, and they will have, at the moment, they have NFTs, which give them the power to vote. Those NFTs will give them the power to actually execute a transaction on chain. That will be kind of the next phase.
Oh, but like, okay. wouldn't that like just like switch one centralized body to another one? Like what's the difference between a multi-sig and the Spartan Council?
Yeah, so the Spartan Council is voted in by people, and there are fairly strong checks on power within the Spartan Council. So token holders basically vote for a council member, but they also have the ability to remove, to withdraw their voting power, right? And we've seen this happen a couple of times. So for example, if I voted for you, you're on the council, and you do something which I believe is against my interest, I can actually, on that one specific thing, pull my voting power away from you, which dilutes your ability to vote. And so if this, let's say there was a contract that was, highly contentious that was deployed, and the Spartan Council votes on it, and multiple people within the community are concerned about it, they would be able to withdraw their voting power, and that process would not be able to be executed. Whereas at the moment, the protocol DAO can just execute it. There's no check on their power. There's no way to stop them from executing something. They can just do it today with no oversight, really. The only oversight is that they've got some level of alignment because they're token holders, they've got a bond, there's some slashing, there's some other things, but it's nowhere near as powerful as having some direct execution mechanism like you have in the compound governance model.
Okay, that's interesting. And how many people are in the council?
There's 8 currently.
Got it. Okay. Okay, that's interesting. And okay, so for Compound, how does it feel like being kind of the gold standard of governance? That's pretty cool.
It's cool, but I think the best part about it is that we've built a process that I think is the safest and the most transparent and the most reusable by other teams. And I think the most gratifying part is actually seeing other teams getting to use the same code and not having to reinvent the wheel. A great example is I think the synthetic staking contract and the compound time lock are probably like the most recycled contracts in like DeFi. The best part is not like that we got to use it, is that everyone got to use it. Because that's what moves the space as a whole forward the most, is being able to have a multiplicative power effect. And the system itself is actually extremely simple. I'll just describe it. There's basically a 2-day review period for a code change. There's a 3-day voting period for the code change, and a 2-day waiting period before it goes into effect if it's passed. And you're voting on very specific parameter changes or contract changes that are all executable code. So there's never instructions for a foundation, change the logo on the website, or please go out and do X, Y, or Z. It's the code has to be written ahead of time and then it gets voted on. So it's a very methodical process that requires you to have essentially completed all of the work. Ideally had it, reviewed by the community and by peers. And it's a system that's, coupled with the fact that anybody can bring code changes. They don't have to get the sign off or approval of a multi-sig or somebody first. And so this has actually enabled some really cool things. It enables the community to sort of create their own proposals. A great example is there's members of the community who work with Chainlink to add new assets to the price feed. That's a beautiful thing to watch. And you get to see, the whole system evolving and upgrading without, needing anyone's permission or sign off first. And so, if people have ideas that, they want to use a new, price feed or a new resource or a new, Chainlink, verifiable randomness function or a proof of, reserves of wrapped Bitcoin or some other feature, the community can actually, put forth proposals to implement new features. And so, it's a disciplined process combined with, it being open and permissionless that I think is really, really strong.
Very cool. And then for the more superficial, if you can call them that, changes a logo on a website, that all of those changes go, there are, I guess, specific teams dedicated to all the other stuff that doesn't pertain to parameters in the protocol, right?
Exactly. It's governance just over the protocol itself. So there's other off-chain components that aren't governed by the comp token. So, the website is still run by Compound Labs. The goal is to completely open source everything and let the community run it. And we'll just point to the best IPFS hash. And we're almost at that final step where, we've handed over complete control of the protocol itself. And now there's like some things that we're still building or working on that haven't been like fully turned over yet. But the goal is to get to the point where, you know, even the website itself is run and owned by the community, and it might not go through the governance system, which is, you know, it's on Ethereum, it's Solidity based, you know, you're not, you know, voting on code changes to a website, but if the community just, you know, wants to maintain it on their own or run it on their own, they have that ability to.
Oh, very cool.
Yeah.
Okay, so it's been over a year for both of your protocols since you yielded control. What are the lessons so far? I know it's a hard one. Who wants to go first?
There's been lessons. So I think one of the lessons that that we've learned is building an engaged community is invaluable, right? And you know, Synthetics, I think, has had that for a very long time. We've had one of the most engaged communities in crypto. We've got one of the best Discords in crypto. If you don't have that, I think it would be a far harder task to kind of hand this control over, because who are you handing it over to? You know, what are their incentives? You know, is the incentive alignment there? So I think before you can even contemplate handing over control, you need to have an engaged and you know, sort of aware community, right? Like you need to do that community building, which is then, you know, an interesting question of, once you've done that and you've built this community and you've started to hand over power, where does the break point kind of sit between, for example, you know, in Synthetics, we have core contributors who are paid full-time to work on the protocol. They're paid by the DAO, so they're essentially paid by token holders to do that, but they have a purpose within the protocol. And one of the things that I think has come up for us this year is me having stepped back from kind of running the core contributors and you know, helping to kind of dictate strategy and all kind of, you know, a number of other aspects, that there are certain things that the community is probably not yet ready to take over. And certain functions that, you know, either were not handed over well, or, you know, or just maybe are hard to hand over. Like there might be some things that the community just can't do, right? And you actually need to appoint certain people to certain roles and ensure that those people are kind of maintaining those roles, right? So that's definitely something that I think that Synthetics has been dealing with. And one of the reasons why I came back and ran for the Spartan Council was to deal with some of the, you know, the inefficiencies and friction that we've sort of seen in this process. But like everything Synthetics, it's iterative, right? Like we try something, I step back, things catch on fire, I come back, I put out the fires, and hopefully next time we're in a better place so the fires don't start, right? Like that's kind of the process that we're going through.
Nice. Ken, I love how you're kind of like just like so open about what's going on. It's really
yeah.
Okay, so
yeah.
So what are like those roles that you think are harder for a community to initially take on?
Most projects have a leader, right? Or like some figurehead or some person that, like, you know, the both the community and the broader crypto community sort of associate, right, with that project, right? You know, Maker, it's Rune, right? Like if someone asks, like, I don't know if Maker is still run by Rune. Like, I don't know how much day-to-day control he has, but if you ask me, like, who is the person that I would look to be like, what is the purpose of Maker? It's Rune. I'm just gonna look there, right? And you know, it's Hayden with Uniswap. It's obviously Robert with Compound. But there's a big difference between being kind of the face of a protocol and controlling it, right? And being the dictator. And you know, that's, I think, the thing that all of us are kind of trying to work out in real time, right? Because we've never had a situation where, you know, like Travis Kalanick just goes, hey, like I'm handing over control of Uber to the Uber drivers now. And like, see you later, like, and just what, like, no, like, that's not a thing, right? Like, you know, like there's a CEO and that CEO runs the you know, the company, and there's no ambiguity there. Like there's zero ambiguity about like who is running, you know, obviously there's a board and there's corporate oversight and all kinds of corporate governance stuff, but realistically, the CEO of a company runs the company. Everyone knows it. They're both the figurehead, the public facing person, and also the person who ultimately controls what happens, right? And when you remove that and you hand over control to this diffuse group of people, how do you ensure that, I think people do need to kind of have some anchor point or some person or whatever. And who is that? Now, we've seen in the cases, things like Yearn, right? Projects like Yearn, I think have done a really good job where some community member has stepped up, like Banteg has stepped up, and people are now, well, it's him, them, a non-person, right? Rather than say Andre. Right. And so there are some examples of this going well, but it's a really hard process. And, I'm very curious to see how even Robert thinks about this, because at some point, Robert doesn't control Compound in the way that he did 2 years ago. Right. At what point do I stop caring what Robert thinks? Do I always have to care about what Robert, I care about, his CryptoPunk views, right? But at what point do I stop listening to Robert about Compound? I don't know. Maybe I always have to listen to him. We really genuinely don't know how these things play out over longer time horizons.
Such an interesting discussion. I mean, Robert, what's your take there about project leadership and what place does it have in a decentralized world?
Yeah, it's a great question. I mean, I think you're always going to have spiritual cheerleaders for a project, right? Myself included, Kane, everybody. If you founded something, even if you in a distant future don't have any financial stake in it, you're still a big part of it. A great example is Steve Jobs founded Apple and only held on to a single share of Apple, right? But still everyone knew that Steve Jobs is someone that was important, within the Apple construct, even if he had no control at all over, what they did or how it worked. And so I think over time, the founders of protocols become less important. Satoshi matters a lot less to Bitcoin today than he did, 10 years ago, he or she, right? And I think it's always a declining, path for the most part. But, I do think that there is some relevance and it will decline. And I think that's a good thing, right? I think it doesn't matter. No one 100 years later really remembers who founded, Ford and what he was like. They just know that there was a Henry Ford, and I think that protocols will be the same way, that in 100 years, people will be oh yeah, synthetics. Yeah, that awesome protocol that took over, all synthetic and derivative assets. There was this guy named Kane, but who knows what he was like, and I think that's a really positive thing.
That's cool. I think maybe the job of the leader is to make sure that some kind of high level goal and vision is instilled very deeply in all of the contributors, team members, and people kind of bringing the company organization forward, so that that's kind of what's passed on. And it doesn't matter, he can kind of still, they can be the face, but maybe it's the rest of the community kind of executing the vision that they set out to build. Okay, so this was a bit of a tangent, but a really interesting one. But back to the original question, Robert, I'm interested in your lessons from Compound governance so far.
Yeah, I mean, I think the biggest lessons from Compound governance so far is that, we designed a system that was, deliberately going to be a relatively slow process, because the value that we were trying to maximize was stability. When we talked about what we wanted when we were designing all this, we wanted, a system that wouldn't change every day. And I think we got that. I think it's possible that, we vaguely overcorrected in, this stability, because, it's also a system that I sort of wish in retrospect would be a little bit more experimental. I think synthetics is a, great example of a community that's always been extremely experimental, trying all sorts of things, all the time, seeing what works, throwing out the things that don't work, and adjusting and calibrating. And the Compound, community governance process isn't as experimental. So if there's one thing I would change, going back, it might be setting the initial parameters of governance, even for how long do you have to vote on things, to sort of infuse a little bit more experimental DNA into the process. But other than that, things have held up extremely well. Over the past year, we've seen a rate of governance proposals in which like the majority have come directly from the community, which was really cool to see. I didn't expect there's going to be such a high ratio of proposals coming just directly from developers, interested community members, VCs, alongside us. And so that's been a strong positive. And there's been about one proposal a week, on average since Compound Governance has launched. And so I've been impressed with the fact that just like it's been, generally not us, as Compound Labs, like driving any of these proposals forward.
It's funny, actually. I remember like in the early days, like first like couple of proposals or whatever, I was like, barriers to entry are too high here. Like no one's going to do this. Like, and you're like, no, like, people like they're working it out. And I was like, I'm very skeptical of like how many people are going to like go through the trouble of like understanding how to like write a contract that conforms to this thing. And I'm glad that I was wrong, but I do remember that conversation that we had, and you're like, no, it'll work. So.
Yeah. Well, that was a big experiment, just from us. Like we had to come up with a hypothesis and put it into motion and like, see if it works. And like, governance is a huge experiment that takes like years to play out. Like I actually think, one of the best governance communities is Maker. It has its own warts, but like in general, they've done a great job building like a governance community. And that's taken years, right? Like, and Synthetics has developed over years. It's also a great, community. So I actually think, the end state of what a governance system in a community looks like is measured maybe at like the 3-year mark, not the like 3-week mark of it going live.
Really? And when you mean like governance community, it's like the people making the proposals, writing the changes, like executing this.
Yeah, it's everybody involved in, moving a protocol forward.
Yeah. I wonder, like, one thing about on-chain governance proposals and having something that's kind of very, very specific. It seems like it just limits the amount of people who can participate because it is so technical. I wonder if the governance, like tokenized governance, will evolve into a place where there are different roles and maybe there's a role where there's just like a technical advisor who can kind of write proposals from non-technical members into code. I think maybe those kinds of new professions will start to emerge in Web3. I don't know. I'd like to see that from kind of someone who's not non-technical.
Absolutely. I mean, I think like, I think of like any corporation that exists today, like one day there might be like a decentralized version of it. Like, so, I use like Nike as an example. It's like, well, if Nike were like, a token run corporation, what would it look like? You wouldn't have everybody designing shoes, in the community. You might have some like ideas that come forth, but you probably wouldn't have people volunteering to do like material science. You'd probably have a couple experts, managing the material process. You probably wouldn't want, every customer to be weighing in on certain issues. And over time, you would specialize and figure out ways to specialize as a large decentralized community. So, I think like everyone votes on everything is probably, naive. And I think communities that succeed will figure out ways to move with like this open democratic foundation and build out specialized skills and tools and, experiences.
Right. And that kind of leads well into the next question, which is, I wanted to bring up this, I guess like one of the biggest criticisms with tokenized governance, which is that it creates this sort of a plutocracy where big token holders, project members with the most at stake in protocols have the biggest say. So I wanted your thoughts. Like, do you think this is an issue that needs to be fixed, or do you think that it's fair that large stakeholders have the biggest say in the protocols they're investing in?
Well, I'll start by saying that, you have the exact same behavior in every, public corporation in the world, where whoever has the most shares, gets to have the most control over the corporation, right? There's obviously, counterexamples where like some tech companies have founders that retain huge amounts of effective control through like dual class, like voting structures. But like in general, this is like the form of, corporate and protocol governance that is in effect pretty much everywhere, where the more you own, the more say you have. And I think that that's not necessarily a bad thing, because I also think it means that you have like the largest stakeholders motivated to see it succeed the most. The biggest disconnect will occur when you have the largest owners who put in the least amount of effort. I think that's something that's like a point of friction for decentralized communities, where people want to see the most ownership translate to the most effort. And I think we'll see lots of different, conversations in crypto over the next couple of years with these sort of like friction points. But I don't think, the correlation between having largest stake and the largest say is a problem. And I think it's actually okay. And it's not something to combat.
I think this is one area where we definitely disagree. I think Compound is not by far not problematic in this area, because I think the delegated component of Compound allows for people who maybe feel less confident in their ability to judge protocol changes, to delegate to someone who they feel is going to vote similarly to how they would like to vote and kind of respect their views. But there is definitely a plutocratic element to it, right? Like there's no question, right? Particularly when it comes to, there's like a social plutocracy as well, right? Where like high profile people or VCs or whatever get a lot of delegation. And so there is a lot of control in a small number of hands in Compound. Now, I think the fact that Compound has constrained what is governable means that's not so much of an issue, right? Like it's real, like most of these things are fairly binary decisions, right? Like, is this risky or not risky, right? And so I think in most cases there is general alignment in the protocol, but Synthetics has gone a very different way, and I think Synthetics has made a decision, not even intentionally, although we definitely never liked this idea of direct token voting. We did. There's always been a sort of social norm within Synthetics that like direct token voting, like Maker, just has like chilling effects and all kinds of problems that cause people to drop out who might be like minority stakeholders and have different views. And so the fact that we didn't have an on-chain governance module for such a long time, like Compound did, although we may have used the Compound governance module had it existed, right? So maybe I'm glad that it actually didn't exist back then. But the fact that we had off-chain voting and this rough consensus process that played out in Discord for a really long time, when we went to kind of make that more on-chain, the initial parameters that were chosen, the minority revolted. Like we chose a structure that actually was much more plutocratic, and the minority said, whoa, we're not okay with this. We had a lot more power in the old regime, and we don't want you to take our power away. And so we then made changes and we iterated and we kind of moved closer to something that would significantly curtail the power of whales. So now the situation is, if you're a whale within Synthetics, there's 8 council members. You can get one person, maybe if you split it across a couple of wallets, maybe you can get 2 council members in, right? But you probably can't get 5. Right, which would be what you sort of need. And so what we have is this distribution where, I think in the last epoch, I got 35% of the votes. A lot of people just defaulted to sure, let this guy run the place again, fine. But then there's a long tail distribution of votes that happen. And you end up in a situation where, the marginal voter can really move the dial on the 6th, 7th, and 8th seats, right? They do have a lot more power. And I think in general, that's allowed us to have something that kind of is a hybrid rough consensus with on-chain component in a way that most other protocols really haven't probably gotten right. I think there's a few protocols that have just gone to a multi-sig, and the multi-sig people just make the decisions. But I do think that we've somehow just through a random walk found ourselves in this position where we've struck a balance between whales and community members and one person, one vote, and $1 million worth of voting power, right? We've found a middle ground, and I think it's a pretty powerful place that we're in right now.
I agree.
So interesting. Yeah, go ahead, Robert.
I was gonna say I think it's awesome, and that like you guys have been able to find that and have been able to conduct like some social experiments to reach a middle ground, and I think that's like really empowering.
Yeah. I mean, we'll definitely continue seeing so many experiments in this area. Like there's quadratic voting. There's like Gitcoin did this airdrop where like a lot of voting power had to be delegated. I think Pull Together does something to limit the weight that individual token holders can have. So I mean, like, yeah, there's like probably one different governance system. There's as many governance systems as there are protocols. So we will kind of see which good models emerge from this. Interested to hear if there have ever been proposals that have gone against kind of what you wanted for your protocols.
I think I've voted against Robert before, if I remember correctly.
Contentious votes on Compound all the time.
Oh, cool. I think that's a great example of like this actually working. Like, yeah, if you can kind of expand on that.
Yeah, so I mean, I think the most contentious proposal we've had was around decreasing like the collateral factor for WBTC. It was like a huge asset on Compound. And, I was like extremely against decreasing the collateral factor because it was an incredibly important asset. And a lot of folks in the community wanted to see it decreased because they thought that, Compound was accumulating too much wrapped Bitcoin. Now, the irony is that we have a lot more today than we ever did back then. But, I thought it was going to be a disaster, and users would get liquidated because they wouldn't be paying attention. And it was an extremely contentious vote. I lost, collateral factor was reduced, there was only a couple users that got liquidated, we were able to let the news out and make sure people reduced their borrowing positions, but it was extremely contentious. It was an example of the community, like really digging in over like a scientific parameter, which was really cool to witness, but, I was definitely on the losing side.
Wow. How about you, Kane?
I mean, there's so many. There's a bunch, I think in the original proposal to change the inflation rate and monetary policy, I was really adamantly against it. We had this crazy Bitcoin halving like cliff thing that, I thought was a great idea back in 2018 or whatever when we implemented it. And the community said, like, this is dumb. Like, there's no need to do this. Like, we have the mathematics to like create curves, right? Like you don't need to have halvings. And so someone went out and they like, really aggressively like advocated it. And I was like, no, this is dumb. Like we shouldn't do it. Like we've changed it once. Like, I still had my Bitcoin maxi hat on back then, I guess, right? I hadn't fully let it go. Yeah, exactly. And they just kept pushing and eventually got to a point where like there was a vote. And the vote was like very strongly in favor of like, this is a dumb thing, let's change it. And they did. And I was like, all right. But eventually I came around to the point where I was like, all right, actually, like you are right. But, it was a good example of like rough consensus and, building consensus within a community, rather than having some like centralized choke point that, some person that could say, no, we're not doing this, move on, right? Like, let's do, like a CEO would have said the first time that was brought up in a board meeting or whatever, like, hey guys, I see this problem, like, let's do it. Like, a bad CEO would have just been like, no, shut it down. Right. And then it doesn't happen. Yeah. Right. So it's a much better and more open process when, people can build consensus in the community and override, even strong voices, I guess.
Yeah. And then I guess we need to be wrapping up, but that ties well with the last question I wanted to make, which is, this new model is just like so radically different than the old Web 2 model where, founders retain majority stake on their companies, users have no say. And now we're going into Web 3 where like the opposite is happening. Do you foresee like the next Facebook's, Google's, Bank of America's, like just huge global corporations, will they be DAOs in the future?
No, they're not going to be DAOs in the future. And either they're going to die to the hand of DAOs or they'll figure out a way to survive, but I don't see them adapting.
Yeah, agreed. I think they'll be wiped out by DAOs, but I don't think they'll turn into DAOs themselves.
So DAOs will be the next big global organizations of the future. I agree with you. Yeah.
Absolutely. Yeah.
Protocols and
Well,
DAO.
Yeah.
yes. This was amazing, guys. So thank you so much, and thank you, Chainlink, for having us.
Okay, let's
Thanks,
go.
Emmy. Yeah.
Thanks, Emmy.
Thank you.
What a great panel. Thank you all so much for coming, bringing the white hair crew, punks, and Kimmy's as well as a women of blockchain. Rory, I'm going to bring you on with me. Rory's going to join me here, and we're going to do a sign off. That's day one. Rory, we did it.
Yeah, unbelievable, Andy. I just want to say what an incredible first day of the conference. Just to kind of do a quick summary, we had announcements regarding fully launching the Keepers Network to the public for DevOps services and off-chain computations, announcing the cross-chain interoperability protocol, CCIP, enabling a truly cross-chain set of smart contracts. We heard first thing in the morning about Swisscom joining the Chainlink network as a node operator. Celsius is now using Chainlink price fees to determining the borrowing rates. Again, they're controlling $16 billion of TVL. Also, they're part of the new CCIP implementation. And that's just kind of, I feel like, what happened in the first couple hours. But in addition to that, I just want to say we had some fantastic talks, including our last one with some of the most influential thought leaders in the space. Again, shout out. Obviously, this is day one, not the end of day three. But special shout out to our MCs, Andy, Dustin, Lauren, today, along with the rest of the team that kind of helped make everything put together. Those that don't know, this is about a 4-month process to basically put something like this together. So just as much as I'm excited to get through the first day, I know we have 2 more fantastic days, and I want to make sure they're amazing and we give people a great opportunity and a reason to really stop in. Andy, would love to know kind of, what your thoughts were.
I got to give one more shout out to the community, the viewers, people who are attending and watching and participating. I see people on Twitter. I see people in the chats. You guys supported Lauren on the other stage, her first time emceeing. We appreciate you. We really do. Your support of us and what we try to bring to you to bring you into the ecosystem as well with us is just really inspiring. So that always inspires me. It was great to meet the team at Scurf and what they're building as well, the Smart Contract Research Forum. And kind of see all the cool stuff that's going on from the research side, from the enterprise side, from the DeFi side, from the DAO side now. It's all over the board. So, and again, it's only day one. There's 2 more days of this. What else could come? Well, I guess we'll find out, Rory. I'll be here.
Absolutely. Yeah, just to let everybody know kind of what to expect for day 2. I think the real biggest difference is we have a full developer stage. So we'll have the innovation stage going on where you're going to see, traditional keynotes, panels, very similar discussions to what occurred today. But we'll have the developer stage, a lot more interactive. You're going to hear from kind of the top sort of programs and software being used to build these kind of smart contracts, these new hybrid smart contracts. You're going to hear a lot from our developer evangelists and relations team as they basically take you through some really cool things. It's a great way if you're starting at 0, but you're interested. I think tomorrow will be a fantastic day for you to follow that dev track on the developer stage and just really go through the journey and probably at least at minimum understand some of the tools that you'll need to use to develop and maybe some of the tips and tricks that'll make you successful as you begin your journey. On the flip side, if you're an experienced developer, you're going to be hearing from the best developers in the space. So, these are people that are actually building the tools, that are actually coming up with the ideas and implementing these things. So I think there's something for you there as well. So again, I'm expecting a fantastic day 2. Andy, I believe you'll be joining us as well again to MC.
I'll be here all day tomorrow, all day Saturday. I'm ready, man. I'm hyped.
Absolutely. And so we'll do this. So again, 8 a.m. Eastern tomorrow is when we'll basically start with our innovation stage. Our developer stage starts at 9 a.m. Eastern tomorrow. I think we have some really incredible content. Can't wait to see you then. I'll be there. Thank you guys so much. Appreciate it. As always, love the support. See you tomorrow morning.
you.